Good Tuesday morning and welcome to Yahoo Finance Live. I'm Brian Sazi alongside Emily McCormick. Julie Hyman is on assignment for us this week. We are seeing some mixed action in the pre-market as traders eye the upward march in the 10-year yield, pressure on tech stocks, and another hot inflation reading. All three major indices right now, where things stand, they are in the green. Now, here are three things you need to know right now. First up, another brutal reading on inflation. We just got the latest March Consumer Price Index numbers, and the CPI saw a yearly increase of 8.5% year over year. Wall Street estimated that number to be closer to 8.4%. Month over month, that is an increase of 1.2% in line with economist estimates. We could break these numbers down even more with the CPI excluding food and energy prices, which came in at an increase of 0.3% month over month compared to the 0.5% increase estimated by economists. Joining us now to go over these numbers and what they mean to the economy, markets, and your wallet is our very own Brian Chung. Brian, so far the markets appear to be liking these numbers. We've seen futures strengthen after. Why would that be the case?
Yeah, well, what we're seeing right now is definitely in line with expectations when you take a look at that headline number from the Consumer Price Index. Again, this is just one measure of the way that the U.S. government sees price increases in this country, and that headline number coming in at 1.2% on a month-over-month basis. By the way, you don't usually tend to see more than 100 basis points of a month-over-month increase in this specific reading, which shows really just how unprecedented this high inflation tends to be. Now, of course, we also want to measure this on a year-over-year basis. So that clocked in at 8.5% on a year-over-year basis for the headline number. Again, this is covering the month of March. And when you parse out the more volatile components of obviously price increases, when you take out food and energy, what they call the core CPI, that clocking in at 6.5% on a year-over-year basis. And if there's one silver lining, it actually might be that core reading, because the street was estimating something a little bit higher than that, something around 6.6%. So actually that 6.5% core reading may have actually been a slight undershoot of what the street had expected. Now, when you unpack the components of this CPI report, obviously a big reason for the overall increase in prices in the month of March was gasoline and fuel oil. When you take a look at the specific month-over-month increase of 18.9% in the price of gasoline, over 20% for fuel oil. And this is spilling over into a number of other categories as well. When you take a look, for example, at airline fares, up 10.7%. Also take a look at car and truck rentals, up 11.7%. So all these categories that are travel related are also getting a tick up. And then owner's equivalent rent, you can see the shelter component that we're highlighting there on the right-hand side of your screen, up about 0.5%. That's going to be a stickier component because obviously those longer term leases and mortgages are going to affect prices over the next few years as well. So guys, broad-based inflation across the board. Haven't seen these levels since 1981. I like to highlight some categories that aren't necessarily increasing. Smartphones down 4%, sporting event tickets down 6%, and for some reason, fresh sweet rolls and coffee cakes down 1.7%. So at least there's that.
Definitely an interesting breakdown there, Brian Chung. But I'm also wondering, since you do watch the Fed so closely, what do you think this latest reading, this new 4-decade high that we got on inflation, might mean for monetary policy and what we might see in May from the Fed's next meeting?
Well, it's certainly giving Federal Reserve officials no comfort that really the only category that saw price decreases is fresh sweet rolls. So for the Federal Reserve, they're obviously looking to this report and saying, well, this just reinforces our view that we have to take away the punch bowl and the easy money that we've continued to print since the depths of the pandemic. They already had that first interest rate hike in March. It seems very likely the case that they're going to do that double bump, the king size bump of 50 basis points or 0.5% in their next meeting in about 3 weeks. Of course, the question is how much higher can yields go from here? We've already seen on the 10-year, for example, that rate going up by 100 basis points or 1% just in the last 5 weeks or so. And I did a little bit of data digging to see when was the last time we saw yields rise that high, that fast? And you have to rewind to the early 1980s. So it was 1982, the last time that we saw yields going up by more than 20 or 25 basis points in a few days. And that makes sense because what was happening in the early 1980s? Well, the same story with inflation, right? The CPI print that we got this morning, also comparable to 1981. That was the Volcker era approach and policy of dramatically ratcheting up interest rates to get ahead of inflation. So a lot of parallels to be drawn between that episode and this one that we find ourselves in right now as well.
Well, don't grab that sweet roll just yet, Brian. Hang with us because number 2 on our list is soaring Treasury yields. Turning our attention to the bond market, off of that hot CPI report, yields continue to creep higher. You have the 10-year yield hovering around 2.82%. That is the highest print since December of 2018. Brian, how? We're going to get commentary later on today. I believe it's 12:10 from Lael Brainerd, and her commentary last week, I would argue, has sent yields much higher since then. Is there anything that she could say today that might cool the move in yields, or she's likely to stay the course with her calls?
Yeah, it was absolutely the case that over the past, let's say, 2 weeks of trading sessions, the day where we saw the most volatility in Treasury markets and fixed income broadly was after the Lael Brainerd remarks, I believe it was last week. So she's going to speak again at noon today, and this will be the first kind of post-reaction to the CPI report that we've heard from the Fed governor. So you should expect to see a little bit more volatility headed into and then out of that speech. But look, what I've been hearing when it comes to Treasury yields at large is that there's no reason why the 10-year stops here. It's likely going to be the case that the next stop for the 10-year is going to be 3%, which would be another 25 or so basis points from where we are right now. And this makes sense when you consider that Federal Reserve officials, like the likes of St. Louis Fed President James Bullard, some have considered him to be an outlier, but he said interest rates probably have to be 3% higher than they are right now. And when you take a look at the 10-year as a proxy for where medium or longer term interest rates could be, that suggests that the Fed would not stop hiking interest rates at a 2.75% short-term target, which means if it is indeed the case that some Fed officials would like to see the Fed ratcheting rates another 300, 325 basis points, then the 10-year likely will want to reflect the fact that the Fed is not going to stop there. So seems like the bus is definitely still going on this. Whether or not we see the 10-year go even perhaps above 3% is very much up for debate, but it seems like there's no signs, at least for right now, that the fixed income markets will stop the trend that we've seen of the short selling and dropping of these fixed income instruments.
Well, Brian, you have indeed earned your sweet roll with a side of millennial-focused oat milk. Brian Chung, catch you at 11. Back on you.
Yeah.
Okay, catch you back soon, buddy. All right, and lastly on our list, a downer of a new B of A fund manager survey. Global growth optimism is at an all-time low. Recession fears surging in the world's investment community. According to that survey, the number of investors expecting the economy to deteriorate is the highest ever. Stagflation expectations jumped to the highest since August 2008. And Emily, this is just not a great report, but very much, I think, fits inside the context of what we're seeing with CPI continuing to be at high levels and the economy continuing to slow down.
Absolutely, Brian. We're seeing a lot of pessimism here from the fund managers that were surveyed here from Bank of America. As you mentioned, really, a lot of these findings are reflecting things that we've been noticing for the past several weeks now when it comes to Fed policy, when it comes to calls for a recession, for stagflation. As you mentioned, those expectations at the highest since August 2008. But when it comes to what fund managers are expecting the Fed to do you want to highlight that they now see the Fed hiking 7 times this year? That's up from 4 times in last month's survey. So this is really consistent with the Fed speak that we've been hearing from the likes of Lael Brainerd, from Mary Daly over at the San Francisco Fed, from what we've been really hearing from a number of Fed speakers when it comes to ramping up this talk of a 50 basis point rate hike in the near term and starting quantitative tightening here. So perhaps a little bit of a lagging response when it comes to what these fund managers are actually saying, but reaffirming, again, many of these trends. And then one other thing I want to highlight here is that investors are now the most net overweight ever for commodities. That was one of the other findings that stood out to me from this survey. And long oil and commodities is the most crowded trade. So perhaps no surprise given what we've been seeing with crude oil, with energy commodity prices overall. But we'll see how long this lasts, since we have seen a little bit of a consolidation here in WTI below that $100 per barrel level. Brian?
Yeah, I'll add one more here, too, just to stay on this downbeat nature of this report, Emily. A majority of investors at 64% expect the S&P 500 to fall below the 4,000 level before rising to the 5,000 level. So just a little nugget for you traders out there to keep in mind as you're digesting this type of report and, of course, that hot CPI print. But let's get back onto that CPI number. Let's bring in Tom Simmons over at Jefferies, who focuses on fixed income. Tom, great to see you here this morning. What your take on the CPI report, and what do you think it means to the bond market?
Hey, good morning. Yeah, so the CPI report, I think, actually has a little bit more good news in it than it appears right on the surface. Obviously, as we see these eye-popping numbers like 8.5% year over year. Comparisons with the late 1980s and the early 1990s when inflation was really running quite hot. There's a number of things in here that suggests that we're starting to see inflation peak and it will roll over in the next few months. We saw these really big increases in gasoline prices. Important to keep in mind that CPI for March, the reference period here was right after the Russian invasion of Ukraine. So really is capturing the most acute period of gasoline price increases. And we've seen them already starting to soften in the market a little bit in the few weeks since. The other thing is that services X energy, and if you strip out the airline component, that was actually a little bit softer as well than the last few months. Housing actually came in a little bit softer than the last few months as well. And goods X energy also are coming in a little bit softer as well. So, the consumer has been pretty well able to weather the storm here with inflation. Obviously it affects sentiment pretty negatively, and it's affected the markets, but we haven't really seen too much in terms of a deterioration in spending. And I expect that we'll continue to see the consumer be pretty resilient here in the next few months as well.
Tom, I posed this question to Brian Chung earlier, but do you want to get your take as well? Do you think this report and the breakdown by components, the increases or the decreases that we saw there, do you think that changes anything for the Fed?
I don't. I think that it gives them slightly better comfort in terms of the fact that, maybe they're not quite as far behind the curve on inflation as it originally appeared, but it doesn't change their imperative in terms of what they need to do in the next few months. They really do need to bring interest rates up quite a bit higher because it's clear that they got started way too late on the tightening cycle. The 50 basis point hikes that have been on the table here, I think they continue to be on the table. They're not going to look at this slight degree of deviation away from the recent trend as some indication that the transitory nature of inflation that narrative that they have been holding on to. They're not going to, go back to that at this point. They know that in order to get inflation down, they need to bring rates above the neutral rate at some point. And in order to get there, that estimate, according to the Fed, is somewhere around 2.5 to 2.75%. They need to get there in a hurry. So we're still expecting that they're going to be raising rates 50 basis points at the May meeting, as well as 50 basis points at the June meeting. If anything, this maybe starts to take off the possibility that they could have done 75 basis points at one of their upcoming meetings, or perhaps that they would have had to have done an intermeeting hike. Those things seem to be off the table because at least it looks like the upside risks for inflation are starting to fade a little bit.
So Tom, ahead of that May Fed meeting, do you see the 10-year breaking past 3%? And if it does, what does that mean to the stock market?
I think the 10-year has to go above 3% at some point. Brian mentioned earlier that it's this reflective of this idea that policy at some point is going to have to go above the neutral rate. It's the only way they're going to get inflation to start to go down, right? I mean, if they only bring policy up to the neutral rate, all that's supposed to do is allow the economy to continue to grow unimpeded, right? So in order to get things to slow down, in order to get inflation to go down, policy rates need to be above that 2.5 to 2.75% rate. And that means they're probably going to be the policy rate is probably going to be at least 3% at some point. So the market needs to reflect that. I think that the reason why it's been very slow to get there is that there is this sort of sense of pessimism based on previous experiences that the Fed either can't get up to the neutral rate, or when they do, they can't stay there for very long before the economy really starts to roll over. I think that there's a number of reasons for optimism that the Fed can engineer, if not a soft landing, at least a not so hard landing, just because of the strength of the labor market, the momentum in wages, consumer balance sheets are very, very strong. So I think the stock market, even though it will struggle somewhat with yields a little bit higher, should start to look at more of these consumer fundamentals as reasons for optimism that we won't see corporate profits deteriorate so fast, such that we should see a big sell-off. I think that the stock market will cool off a little bit, but I'm not particularly worried about some major event.
You mentioned consumer balance sheets. Do you expect that consumer spending is going to be able to continue being resilient, even if the rate of price increases slows from here? Because even if prices are rising at a slower rate, they are still going up.
They are still going up. We haven't seen it. We've seen a couple of reports from various credit card spending aggregators and the New York Fed's consumer sentiment or consumer expectations survey suggests that consumer budgets haven't really been, drawn back here, even as prices have increased. Obviously, there is a limit to which consumers can continue to do that. With prices going up, endlessly, obviously at some point they would have to pull back. I still think that point is still pretty far from here. The consumer still has a lot of accumulated savings from during the pandemic era, whether that's the result of stimulus that was never spent or just accumulated wage increases that haven't been spent either. And we've seen that across the spectrum, all the way up from the high end of the skill level spectrum down to the low end. And so, I think that there's still plenty of reason for optimism that the wage pressures are going to continue to be, in a positive direction. Because there is still a relative shortage of labor in the labor market, and so with more and more spending power coming from wages, I do believe that they'll be able to at least sort of keep up with inflation from here. We are talking about prices going up, but again, I think that there are reasons to believe that the degree to which prices are going to continue to increase from here is not going to be what we saw for the last 12 to 18 months.
But Tom, back-to-back 50 basis point rate hikes from the Fed to cool the inflation like we're seeing in today's CPI, doesn't that choke off the economic recovery?
100 basis points from here is still a relatively low level for rates. We would be at 125, 150 basis points for policy rate. I think that the issues that would affect the economy negatively, we're already seeing even without the Fed hiking. Specifically mortgage interest rates are up pretty significantly. I think that's an area of concern. But the consumer, like I said, they're already basically funding a lot of their consumption with accumulated savings, and that costs them zero, right? They're not borrowing a lot in order to fund their consumption outside of homes and autos. So I do think that there's a risk. Obviously, the Fed wants to slow things down a little bit. They do want to take some of that demand out. Just that's the only way you're going to get inflation to come down. The Fed can affect the supply side in terms of creating more inventory of these goods that are in short supply. So the only thing they can really do is start to kind of cool demand a little bit. But again, I think that these big increases are really just reflective of the fact that they've been a little bit too easy to this point. And we're not talking about, successive 50 basis point hikes for months and months and months. It's really just this adjustment in the short term that is then going to set them on a trajectory for a smoother increase in rates into the future.
Tom Simmons, Jefferies fixed income money market economist. Good to see you. Appreciate the post CPI insights. Talk to you soon.
Thank you.
All right, before we head to break, the risk-off tone in tech stocks appears to be extending to Bitcoin. Bitcoin prices dipped below the 40,000 level today for the first time since the middle of March. They have climbed back over, but still dipping below that key $40,000 level. Ethereum is also being hit with a dose of selling pressure, and we continue to watch Coinbase. Shares are down about 13% over the past 5 trading sessions. All right, straight ahead, more worrying developments on the COVID-19 front out of China. We'll have more on this next. As the latest COVID-19 outbreak in China worsens, the U.S. State Department has now asked some staff in its Shanghai consulate to leave the country. And all this comes as a new Omicron subvariant has been spreading overseas. Yahoo Finance senior healthcare reporter Anjali Kamani has the latest developments on all things coronavirus. Anjali.
That's right, Brian. About those workers in the consulate, that is for non-emergency workers in Shanghai, noting that because of the strict lockdown continuing now for weeks in the city, the largest lockdown in China since Wuhan in 2020, and ongoing testing proving that they are recording record cases on a regular basis. Just this past weekend, more than 26,000 cases in total, a majority of them still asymptomatic, so proving the point of what the Chinese are doing with ongoing regular testing. But that has caused a problem for those under lockdown. Access to food and medical care is really restricted. And so that is the reason why the U.S. has changed from a voluntary evacuation to mandatory for these non-essential workers. Meanwhile, as you said, there's a new variant. We already discussed that the UK had recorded about 600 or more cases of the XE variant, and that's a combination of the BA1 and BA2 variant, and that is now recorded in Japan as well. There have also been other reports around the world based largely on travel of those recorded cases. So just something to keep an eye on as we see whether or not this spreads, which of course brings us back here to the U.S. We just saw Philly getting ready to reinstate a mandate for those indoor public spaces, and that's after cases have risen more than 50% in 10 days, which was one of the metrics that they had set to start and restart masking. Something that we'll keep an eye on, of course, as we see how BA2 really travels through the U.S., whether or not it becomes a concerning variant. And that is something that health experts are kind of split on and are just waiting to see, because we're just off of this Omicron wave. There is still broadly protection built up within the population, a combination of course, vaccinations, boosters, and a natural immunity. So for right now, it could be a less threatening wave than we've seen in the past. But of course, all eyes on whether or not that continues. And we'll have to definitely see what happens in the fall when that broad immunity wanes. Back to you.
Yeah, Anjali, I did a double take when that news crossed on the Philadelphia mask mandate because, look, I think so many folks have settled back into some form of new normal life. But I mean, based on your reporting, are other states or other cities looking at reimposing mask mandates?
Well, it's definitely something to keep an eye on. As we saw, of course, with the gridiron, right, the event being sort of a super spreader, indoor spaces are still a concern, broadly speaking. As long as we continue to be in a pandemic, as long as we continue to be, within a range of large spreading, that's going to be a concern that states are going to have to be looking out for. Now, of course, we're not going to see anything come down from the federal level. They've made it very clear that it's sort of up to individuals and up to local level to decide that. So that's where we might see coming from. It might not even be states. It could just be even individual cities, counties, and regions. So it's definitely something to keep an eye on.
Indeed it is. Anjali Kamani, thanks so much. All right, coming up, CarMax shares are getting run over after reporting fourth quarter earnings, despite seeing revenue rise nearly 50% year over year. More on this stock, plus the opening bell on Wall Street after the break. Welcome back, and earnings season has officially begun. Emily, let's start here on CarMax. As I mentioned going into the break, shares are getting run over as they should be. A couple things that caught my attention from this CarMax quarter as we come up against that opening bell. First, they noted, Emily, they said a number of macro factors weighed on the quarter, notably how many cars they were able to sell, including declining consumer confidence, the Omicron-fueled surge in COVID cases, vehicle affordability, and the lapping of stimulus benefits paid in the prior year period. So many red flags in that little paragraph. It is alarming. Also alarming, too, they know that the allowance for loan losses was 2.77% in the quarter, up from 2.75% in the year-ago quarter. Why that is all worrisome, you really get the read here that consumers are under increasing stress, whether that's a large part of inflation, you name it, whatever it is. CarMax here, I think, giving very negative tells on the state of the economy.
Right, Brian, not a lot of good news here in CarMax's latest report. And I do want to point out that JP Morgan analysts were actually out with a note post-earnings results saying that they were surprised by the magnitude of headwinds leading to same-store unit growth of negative 6.5%. So again, those same-store sales down 6.5%. That was an unexpected decrease compared to what Wall Street had been expecting, which was flat to slightly higher on, again, those comparable store used unit sales. But overall, Brian, I think, again, seeing that used vehicle sales were really the disappointment here. Those were at $5.7 billion versus the $5.8 billion that was expected. Was still up 33% compared to last year, but again, weaker than expected. And CarMax also noting that selling prices went up in the fourth quarter. Those actually rose to about $8,300 per unit, or up 39.7%. So interesting report here from CarMax. So here's the opening bell.
There you have that opening bell on Wall Street. Lots for investors to digest. But of course, today, that big CPI print on the headline rising 8.5% over the past 12 months, a very large increase in inflation. That continues. But it was interesting, though, in the pre-market, you did see stocks strengthen a little bit off the lows after that CPI print. I think in large part, Emily, because the rate of increase did in fact slow month over month, perhaps feeding this notion that March inflation might have peaked. But let's stay on this inflation because it's going to be a major topic this earnings season. Like you mentioned, Emily, in your newsletter here, the morning brief, really enjoyed that read. I encourage everybody to check it out. It's on our homepage right now. But Albertsons, another company coming out here with I would say a squishy quarter, negative stock reaction, just like we're seeing with over at CarMax to its earnings, noting margin pressure in a lot of categories. And I think that's in part because so many food companies are trying to push through price increases. And you have the grocers like an Albertsons just unable to push through higher prices on consumers.
Absolutely, Brian. And when we take a look again at the stock reaction here, I think a lot of that had to do with the commentary that we saw in Albertsons' earnings report as well. The company saying, quote, "We expect the economic environment to remain uncertain as we navigate the current geopolitical environment, the COVID-19 pandemic, labor challenges, supply chain constraints, and the current inflationary environment, including increasing energy and commodity prices." So as you point out, all of these things are factors that companies like Albertsons are trying to pass on to the consumer. Unclear how much leeway they're actually going to have in actually doing that, since many of these price increases have already taken place. But again, a negative stock reaction here. That stock down about 5% in the early minutes of trading today.
And on the positive side, a top trending, ticker on the Yahoo Finance platform is CrowdStrike. Yet again, it perked up a little bit on our platform last week. But Goldman Sachs, Emily, out with an upgrade on CrowdStrike, saying that the company is showing strong execution in an already elevated demand environment. And keep in mind, last week, CrowdStrike came out last week at a key investor conference, said they want to hit $5 billion in annual recurring revenue by 2026. To me, at the time, that reiterated a lot of the bullish comments that CEO George Kurtz told us in the latter part of March, just given how his business is trending here to kick off the year.
That's right. And Goldman Sachs analyst Brian Essex writing, quote, "Strengthening secular demand trends and an outlook that continues to improve." That was really behind this upgrade here. And also this price target increase. Goldman now raising that price target to $285 a share from $241. And I think CrowdStrike, Brian, is really a good example of not all tech stocks, not all stocks in one sector in general are created equal, but especially when it comes to a lot of these technology and growth names that have been coming under pressure so far this year on concerns of valuation with the Fed embarking on a series of interest rate hikes. And if we take a look at how CrowdStrike shares have been trending, they have been moving higher so far in 2022. They're up nearly 6%. As you can see here, a number of these cybersecurity stocks really trending in a positive direction. Some of this also has to do with investors placing bets that cybersecurity software companies are going to be seeing increased demand given the war going on in Ukraine by Russia. So potentially some positive tailwinds here for CrowdStrike and for some of these other names as well.
And going back real quickly on food, Beyond Meat shares, Emily, are on the move here. Perhaps this product release might help Albertsons put up a better quarter here. You're seeing Beyond Meat expand its meatless nuggets to 8,000 locations. Those locations, Albertsons, Sprouts, Amazon-owned Whole Foods, CVS, even Kroger. I'm kind of excited, Emily, about walking to a CVS store and seeing Beyond Meat. I now have more of a reason to go into CVS instead of buying eye cream.
Absolutely. Well, I do have to say that I'm a little bit more partial to Impossible's products as opposed to Beyond Meats, but I definitely get what you're saying. We are seeing a positive stock reaction in response to this news here from Beyond. Also going to be coming to Kroger. All those locations will carry the item by the end of April. So we'll see ultimately what this does to Beyond's retail segment, the grocery space. Of course, we have been seeing a little bit of a rebound in the food services, those restaurants, those takeout spots for Beyond Meat during this reopening here, but potentially something that is going to help bolster that part of the business that relies on grocery store sales as well.
Yeah, I'll mention lastly, too, looks like 2 wins so far for Beyond Meat in the past 2 months. Of course, you had this news, them spreading to 8,000 more retail stores for these meatless nuggets, but also they just launched their plant-based beef jerky, which I'm starting to see in supermarkets. It is quite tasty. All right, coming up, there is one way for President Biden to fight inflation. Yahoo Finance senior columnist Rick Newman has unearthed that way, and he'll join us next.
The opening bell rang on the New York Stock Exchange just a few minutes ago, and stocks are trading in the green and rebounding from yesterday's losses. For a deeper dive into the market action this morning, we have Yahoo Finance's own Jared Blickery standing by on the exchange. Jared?
Well, good to be back, Emily. And it's been 7 trading days since I've been in here, and I thought it'd be interesting to take a look at what's happened in the interim because we are off the highs since that nice rally that we were getting a few weeks before that. So on the Wi-Fi Interactive, you can see we have indeed fallen off. It's been about 11 to 13 sessions now, depending upon the index that you're looking at for that particular high. And then we'll take a look at some of those movements on the heat map basis in a second, but just want to point out the VIX a little bit elevated here. You can see coming off of those lows where it dipped just below 20, if ever so briefly a couple weeks ago. Also seeing the bond yield scream ever higher. Here's the here's a 5-year off a little bit today, 9 basis points. Actually, that's quite a bit, but you can see it has been screaming higher in the meantime. Similar story for the 10-year. For all the talk about yield curve inversion, what it really, I think, really counts is what's happening with the 13-week T-bill, because that is a very, very shortest end of the curve that tracks the benchmark that the Fed is actually trying to influence, and you can see that is screaming higher as well. So 0.76%, quite a far away from the 30 years 2.77%, or the 10-year just below that, but that is what we are tracking. Now, if we take a look at what's happening inside the market today, here's the Nasdaq Composite, but let's take a look at what's happened over the last 13 days. You can see as yields have been screaming higher, that growth stocks, not surprisingly, the mega caps have been taking a back seat. That accounts for a lot of the weakness there. The chip stocks really taking it on the chin. You can see Nvidia down 21% over this time period. Also showing in the sector action, the greatest outperforming sectors over this time period, since the market has generally been going down, has been utilities, staples, real estate, all of those up more than 5%. So I think pretty telling that that is a very defensive posture for the market. Not surprisingly, tech, that is XLK, that is down the most over this time period. And just wanted to also kind of lean into what's been happening with that Bank of America Global Fund Manager survey that I'm really glad you guys were hitting on. By the way, this is our leaders board that I'm looking at. And as I said, the chip stocks really taking it on the chin over this time period. But just looking at what the greatest tail risks to the market are right now in terms of the people who manage $1 trillion worth of wealth, they're looking at a hawkish central bank, recession risk, inflation risk. All of those are the top 3, all of those very much related. And you got to think with the Fed hiking 50 basis points, are they being conservative enough, guys?
Jared, I'm going to channel our former colleague, Adam Shapiro, on this one. Help us understand, given some of those concerns you mentioned from the B of A survey, we have increasing recession risk. We have a 10-year moving towards 3%. And by and large, though, the S&P 500 is still not too far removed from record highs. I mean, what gives here?
Yeah, I think it's going to be a very frustrating market because the market has been given a little bit of a respite with respect to the Ukraine-Russia conflict. But I get back to what Jim Bianco has been tweeting about over the last week, that the Fed has been very adamant, telegraphing that it's willing to hike 50 basis points, not at the next meeting, not only at the next meeting in May, but after several meetings after that. So I think the new norm is the Fed is going to hike aggressively 50 basis points per meeting until something breaks. What could also cause something to break even before then is the balance sheet tightening, and that's been my biggest concern for months here. If the Fed implements this balance sheet tightening, and that is in fact what kind of breaks the market, because the market is very illiquid right now. There's not enough backstop in terms of liquidity to fund what's going on in the bond market, and the bond market is just screaming risk, risk, risk right now. So yeah, the S&P 500, it's an average of 500 different stocks, could climb to record highs, but I don't think we're going to see much meaningful movement beyond them, because this is, I think, set to be a very frustrating market as market participants just try to price in what the Fed is actually going to be doing this year, which I think the Fed has telegraphed they're going to be more hawkish than not.
Jared Blickery, it's great to have you back, and thank you so much for that breakdown. With inflation rising at the fastest rate since the 1980s, there's at least one thing President Joe Biden may be able to do to rein in prices. Yahoo Finance's own Rick Newman is here with more. And Rick, tell us, what could be done here by the Biden administration on inflation?
You remember those Trump tariffs that he imposed on imports from China and some other countries? Well, they're still there. Biden has not changed anything about those Trump tariffs. He could, though. And there's some new research from the Peterson Institute that says if Biden were to remove either lower some of those tariffs or remove them completely, it could lower inflation by 1 to 2 percentage points. And maybe that does not sound like a lot, but taking inflation down by 1 or 2 percentage points could be $800 or $1,000 in savings for the typical family. We import about $2.8 trillion worth of stuff a year. That is a ton of stuff. About half of that stuff comes with no tariffs, but the other half does come with tariffs. And the president can lower those tariffs. So it's something he could do. I don't think he's likely to do it because it would conflict with some other priorities he has, but it is a lever he can pull.
Rick, I will gladly take that 1%. That's money I can reinvest in my golf balls for the summer season. But why not do it? Why wouldn't that be a big political win for him and a good headline of him trying to attack inflation and going against stuff that Trump put in?
Yeah. So one of Biden's priorities is more domestic manufacturing. And I think that has a lot to do with why he has left those Trump tariffs, especially on Chinese imports, in place. If you lower tariffs or remove them, you're essentially making imported goods cheaper, and it's harder for U.S. manufacturers to compete then. And we know that it just costs more to produce stuff here in the United States. So I think that's one big reason. Biden also, considers labor unions to be an important constituency for himself. Labor unions favor the type of protectionism that Trump did, putting tariffs on imports to make them more expensive, to give U.S. workers a bit of an advantage. So Biden would be undermining some of those things. And I think he has to ask himself, what's the bigger threat at this point? Is it going to be that inflation just torpedoes his presidency, or that he might do some things that some of his constituencies don't necessarily like? So for now, this is something he's not doing. But if inflation gets worse, who knows? Maybe he'll change his mind.
All right, Yahoo Finance's own Rick Newman, thank you again so much.
Bye, guys.
And before we head to break, we want to bring you our stat of the day. Earnings season kicks off this week with results from JP Morgan, Wells Fargo, and Goldman Sachs. And it's shaping up to be a different earnings season as companies get hit by surging inflation and geopolitical risks. S&P 500 revenues are projected to grow 10.8% in the first quarter, while earnings are seen rising by just 4.7%. One sector that may show bumper profits, though, is energy. The energy sector inside the S&P 500 is seen posting earnings growth of 238% for the first quarter. And the source for that is Credit Suisse's Jonathan Golub. And straight ahead, a big week for earnings, as we just mentioned. We'll break down what to expect with Citi Global Wealth's Kristen Bitterly next.
Market seems priced for a temporary slowdown, but not recession or boom, points out our next guest. But despite that lingering optimism, hedges against a moderate correction may make sense for the risk-averse and the fully invested. Kristen Bitterly is the head of North American investments at Citi Global Wealth. Kristen, good to see you as always. Before we get to some of your calls, I think you highlighted something very good in our digital green room just now. Isn't it surprising to see the markets rally off a headline inflation print of 8.5%?
It's interesting because I think when you actually break down this 8.5%, it was in line with expectations, right? So in theory, the market shouldn't be reacting. But now we've all become experts in CPI prints and we're really getting into the details, whether you're an economist or not. And so I think actually breaking down that print, what do we see? Well, when we look at oil, when we look at the price of gas, when we look at the price of food, that was expected due to what's happening in the Ukraine and all of those disruptions in terms of supply chains from a commodity standpoint. But when you get into core inflation, that's where we came in below estimates. And so this idea that some of inflation could be decelerating or that we may be getting closer and closer to peak inflation, that's taking some of the near-term pressure off markets. But keep in mind, one CPI print is not going to change the trajectory of the Fed. So maybe a little bit of ease for markets, but not for the Fed.
And Kristen, you've laid out three potential scenarios here for U.S. economic activity from positive to negative. We have robust, resilient, and recession. I'm wondering, how does this morning's CPI print and the economic data we've been getting most recently feed into any of these three narratives and bolster one of these cases?
I think it basically just increases the probability of resilient, which what we tried to do about 2 weeks ago, we received a lot of questions from investors about what are the potential trajectories from here. A lot of people are talking about a potential recession. And so we tried to break down what are the potential outcomes for markets and for the economy. And we said robust, resilient, and recession. And so robust being at about 20 to 25%, resilient being our base case, and then recession being around 20 to 25%, but something that we wouldn't see out until at least 2023. And so what we're looking at from a resilient standpoint is that we would see growth slowing, but not in negative territory. We're going to see that across earnings growth as well as broader economic growth. And so the key thing here is if we say that the highest probability is either in this resilient market, which we would expect kind of single digit type returns. We're not talking about anything like we've seen over the past couple of years. How do you want to be positioned? And the key there is really quality, both in your equity portfolios as well as your fixed income portfolios.
Even still, Kristen, a lot of folks are waking up right now. They see this red hot inflation reading again, and they see a lot of folks come on with us, talk about increased recession risk. What stocks do you sell in this type of environment, just given all the risks that in many respects are rising right now?
I think, so you could look at it, what do I sell right now or what do I really lean into? And I think the argument here is on quality. And we've been talking about this not just over the past couple of weeks, but really over the past couple of months. This is something that we started in Q4 of last year, where we said this is no longer COVID driven with like COVID winners, COVID losers, any type of quick snapback trade. We want to lean into the parts of the market where you have quality. So these are large cap companies who have taken advantage of the low interest rate environment to really shore up their balance sheet. And they're returning capital to investors in various ways, either through growing their earnings, growing their dividends. And we've seen a lot of action on the share buyback side as well. And so this earnings season becomes one of the most important earnings season because it's going to give you a lot of insight into which companies, especially given the forward guidance, which companies have that durable demand, which companies have that pricing power. And remember that even in decades like the 1970s, where we had extreme inflation, large cap quality US equity shares were able to double their share price over that period. So that's the pocket of the market where we're confidently either staying invested or getting invested.
And speaking of earnings, you've mentioned that first quarter earnings estimates are too low, while estimates for the second half of the year are too high. Starting with the Q1 results we're about to be getting, why do you think there's more reason for optimism than the street is currently pricing in?
And so I think there's more reason for optimism when we look at it overall, right? So you just commented a little bit earlier on the program when it comes to energy and specific sectors that are going to do quite well on the back of Q1. We've also seen a really strong consumer coming into this year. So this idea that some of the economic data that we're seeing from a consumer standpoint, from an employment standpoint, is actually quite robust. So we haven't seen that pullback in demand quite yet. So we could see some nice activity within earnings. And remember, they were revised coming into this first quarter. The key, though, is going to be when does this inflationary pressure really flow through into earnings? And that's going to be in the second half of this year, which again is the pivot within our portfolios towards those larger cap quality companies. And again, I bring this back to both in fixed income as well as equities, who can actually withstand those types of pressures, because there will be pressure, even though we may have gotten a little bit of relief in markets based on the inflation print and what's showing in core inflation. But when food prices are high, gas prices are high, that's driving consumer behavior and are going to impact certain sectors.
Kristen Bearley, head of North American investments at Citi Global Wealth. Always good to see you. Have a great rest of the week. And we'll be right back.
Some breaking news coming out in New York City. Multiple people were shot at a Brooklyn subway station this morning, and several undetonated devices were found, according to officials. NYPD said they are continuing to investigate the incident and urging passengers to steer clear of 36th Street and 4th Avenue in Brooklyn's Sunset Park neighborhood. We'll bring you more details as they come in. And this morning in markets, we're seeing green across the screen across the three major stock indices. The S&P 500 up about 1.2%. The Dow Jones Industrial Average up just over 300 points, or 0.9%. The Nasdaq Composite, the leader during today's session, up 1.9%. So we are continuing to see a rally underway, a rebound from the losses that we saw yesterday, even after this morning's CPI print showed inflation rising at the fastest rate since 1981, again, on the consumer price side of the economy. 2020. Then taking a quick look here at the sector action inside the S&P 500, we have energy, consumer discretionary, and information technology, the outperformers during today's session. Again, echoing what we're seeing with the Nasdaq Composite, the outperformer. And then on the flip side, we have healthcare, utilities, and real estate, the laggards in the S&P 500. And coming up, oil prices are on the rise as the ease of COVID restrictions in Shanghai settles demand concerns. We'll discuss on the other side of this break. Welcome back to Yahoo Finance Live. I'm Emily McCormick here with Brian Sozzi. Julie Hyman will be back later this week. The market's been open about 30 minutes now today, and stocks are trading higher after this morning's red-hot CPI inflation report. And here are three other things we're keeping on our radar. Spacs are sputtering. After a blowout year for Spacs in 2021, blank check company deals this year have fallen to the lowest level since 2020. More on the Spac drought in a bit. Plus, sales up, earnings down. That was the takeaway from Conagra's latest full-year guidance, as demand at the food giant stays elevated, but inflation weighs on profits. We'll have more with Conagra CEO Sean Connolly later this hour. And for the same price as a gallon of gas, you can get your hands on a dozen Krispy Kreme donuts. We've got more on the company's new pricing strategy coming up. But we start this hour first with more on the market action. And for that, let's head over to the Yahoo Finance Interactive board for a deeper dive. As we can see here on the board, we're really seeing a rally in some of the technology stocks that had been hit during yesterday's session. Really a rebound here, especially in those mega cap FANG names. I want to zero in on some of the dark green that we're seeing on the screen in Tesla. Tesla, for example, up about 4.5%. Although if we take a look over the past 5 days, that stock's still down about 6.6%. So again, really speaking to the pressure that we've been seeing in some of these high-flying growth names over the past several sessions. Then, of course, taking a look at some of the semiconductors, we had our own Jared Blickery talking a little bit about the rebound here that we've been seeing as well. A lot of green across the screen. And in the Chinese names, a similar story here, especially when we take a look on an equal cap weighted basis. A big rebound here that we're seeing despite the fact that China continues to be grappling with its biggest COVID outbreak since 2020. And then taking a look at the commodity space here, again, a big rebound in the risk assets overall. We're seeing Brent crude oil prices up about 5.7% during today's session and about 3.5% over the past 5 days. And when we take a look at crude West Texas Intermediate crude oil prices, I should say, also up nearly 6% during today's session and closing back in on that $100 per barrel mark. And on that note, I do want to stick with the topic of the energy markets and bring in our next guest on the program. Damian Corvalin is Goldman Sachs Head of Energy Research. Damian, thanks for joining us this morning. Crude oil prices have still been elevated, but have certainly come down since WTI topped $130 per barrel last month. What do you think is the path of least resistance here for crude oil in the near term?
Hi, Emily. Yeah, we've seen a large retracement. We think the next move is higher. If you think about the move lower, you've had 3 headwinds recently. The lockdowns in China, which reduce mobility, hence oil demand. The large SPR release from the US government. And finally, when you look at Russian exports, not as big a decline as initially appeared. So that's provided some short-term relief. But keep in mind, right, the market has been now in a nearly 2-year-long deficit. We're at record low inventories. And all those headwinds are transient. So we really haven't resolved the significant underinvestment. And that's why prices need to recover. We'll probably see short-term volatility, but I guess from this level, our view is the next move is indeed higher.
Damian, do you still see $125 a barrel?
Hi, Brian. Yes, that's our forecast for the second half of this year. So how do you get to such a price level? Well, when you decompose the oil market or any commodity market, you have 3 adjustments. You have supply elasticity, so producer responding to higher prices. Second, you have inventories. And third, and typically last, you have demand elasticity, demand destruction at higher prices. What is key in today's environment is you don't have 1 and 2. So you don't have supply elasticity. Shale is growing, but that does take time. OPEC is not doing anything in excess of its plan. Second, inventories are record low, so you're really down to having to reduce consumption. Now, we're not saying we're at the point where we need a recession, a collapse in oil demand, but we do need slower demand growth than would have occurred at lower prices and without the Russia sanctions. So I think that's the core of how you get to 125. Now, as you saw just the last few weeks, there will be volatility and there is risk potentially to the upside once the loss of Russian exports become clear and more persistent.
And Damian, we've seen, since we last spoke, I think we can argue that the Chinese economy is slowing down, large part because of these new lockdowns related to COVID. What does that mean to the demand environment for oil?
So, China has an efficient lockdown policy in terms of reducing oil demand, and we're seeing that today, right? Their local demand is probably down 2 million barrels per day. So that's, 2% of global oil demand, which is sizable. But keep in mind, right, we had always assumed that Omicron eventually would go to China and would lead to rolling lockdowns. And they're probably their most acute now. If you look at Hong Kong, for example, or the recent headlines out of Shanghai, we don't expect those to last for 6 months. So, we expect that to be this kind of short-term, call it 3-month headwind. Maybe it's rolling lockdowns. But still, doesn't resolve the fact that you've been in a deficit that is now structural. What do I mean by that? Well, oil demand was record high before the lockdowns. Oil investment has been depressed for the last 3 years. So as those lockdowns fade, then you go back to the initial problem, which is persistent underinvestment, and that needs higher prices.
And Damian, switching gears here for just a moment, later today, President Joe Biden is slated to visit Iowa and announce that he will allow U.S. gas to be sold with a 15% rather than 10% ethanol blend to help bring down prices paid at the pump. Is this going to have a meaningful impact on U.S. energy markets?
It likely will be quite small. The first primary hurdle is retail gasoline stations are typically reluctant to sell high ethanol blends from a liability perspective. Most cars historically were not suited for such higher blends. So you may see it in some regions in the Midwest where you have more flex fuel cars, for example. But again, it's a marginal adjustment. It really doesn't solve the inherent issue, which is a record long, record large deficit on a global scale.
And Damien, I was reading a good note by Jan Hatzius, the chief economist over at Goldman this morning. Now he's not calling for a recession, but he did highlight how an overheating labor market is raising recession risk. From your camp in commodities, what would a recession in the U.S. mean to oil prices? Where do they go?
I think the key, ultimately, any recession is bad for pro-cyclical goods like commodities. What history shows, however, is the path to a recession typically actually sees commodity outperform every other asset class. Now, keep in mind, right, when I think about equities, this is an anticipatory asset valued over 20 years. Slower economic growth, higher inflation are bad from a valuation perspective. Commodities, however, are a real asset. What matters to them is today's supply versus demand mismatch. And when you're late cycle, so heading into a recession at the economy level, typically that's when those shortages are highest. Consumption levels are high. In fact, they're so high that the economy can't grow at the same pace as previously. So from here, if we were to have a hard landing, which may be driven by labor inflation, it probably is also coming with higher commodity prices. And that's your textbook allocation, right? At this point of the business cycle, one should be overweight commodities to hedge against inflationary pressure and to benefit from the appreciation that is coming with a strong economy, overheating economy.
All right, we'll leave it there. Damien Corvalin, Goldman Sachs Head of Energy Research. Thank you so much again for your insights this morning. Coming up, losing steam. We'll share why Spac activity is hitting its lowest level since 2020 after the break. Honda is revving up its electric vehicle targets. The Japanese automaker plans to release 30 EV models globally by 2030 and spend $64 billion on research and development over the next 10 years. In a bid to compete with Tesla, Honda also wants to set up a production line just for EVs in North America. The company also plans on obtaining special batteries from General Motors made to power electric cars. Making money in the metaverse, Facebook parent company Meta will start testing features allowing creators to sell items within its virtual reality game Horizon Worlds. Select users can sell products ranging from access to a VIP section of the metaverse to virtual items like jewelry. The Verge reports Meta will take a cut of at least 25% of any sale after App Store fees. The game is accessible on the Oculus VR headset, which Meta also owns. And a behind-the-scenes look at Warren Buffett's deal-making. Regulatory filings revealed that the Berkshire Hathaway CEO only needed 2 weeks to put together the company's $11.6 billion acquisition of Allegheny, the largest purchase for Berkshire in 6 years. Interestingly, the deal showed how much Buffett dislikes Wall Street bankers, as merger documents show Buffett slashed the price for the insurer to account for the advisory fee from Goldman Sachs. The Allegheny deal is expected to close in the fourth quarter. And Brian, I know you have some thoughts on this deal as well. What's your take on all of this?
Two quick takes. First, Warren Buffett was in New York City in March to get this deal done, Emily. He did not hit up his friends here at Yahoo Finance. I'm a little disappointed in Mr. Buffett. But number two, only in Buffett land, Emily, where you can get a deal done of this size in 2 weeks.
Absolutely, Brian. And, you know, we should also point out this isn't of course, it is one of the largest purchases that we've seen in a number of years here for Berkshire Hathaway, but not the only deal making, the only purchases that have been happening here for Berkshire Hathaway. The firm's also been buying up shares in Occidental Petroleum, new equity stake in HP. So a lot to be watching out for here with the Oracle of Omaha, Brian.
It is indeed tough to be a billionaire. All right, staying on deals, Spac activity has fallen to its lowest level since 2020, according to new data out today. Yahoo Finance's Alexandra Simonova has the details. Alex.
Well, Brian, the Spac party that raged on Wall Street last year officially appears to be coming to an end. The market for Spacs, or special purpose acquisition companies, has gone through some cool down periods here and there, but last quarter, the volume of public offerings through these blank check companies reached the lowest level since 2020, before what has been called the Spac Renaissance began. According to data from PitchBook, only 78 Spac listings were issued in the first 3 months of this year. This is sharply lower than the first quarter of 2021, which saw roughly 300 Spac IPOs. The median deal size on Spacs this year also fell to half of what it was last year. There was a major drop-off in activity for de-SPACs as well, which are companies merged with publicly listed SPACs, only about 30 such deals compared to 81 in the same period last year. The slowdown comes as investors more broadly have turned away from more speculative parts of the market, which has caused an overall rout for these types of companies that are often overvalued and not yet profitable. PitchBook pointed out that de-SPACs specifically have significantly underperformed the S&P 500 generally in recent years, but with losses really accelerating into this year. And some of the big names of companies that went public through these types of mergers are electric vehicle maker Lucid, which was down about 47% this year as of yesterday's close, and the sports betting company DraftKings, down about 40% year to date at yesterday's closing bell. Guys.
So I think the natural follow-up question to this and seeing this data, this drought in SPAC deals, is what is driving this relative lack of deal making so far this year?
Well, Emily, a number of factors are dealing a blow to the SPAC market. The first is just the overall underperformance for these types of companies in these current market conditions. And the second is the market correction that we saw this year has led investors to reprice some of those hefty valuations on pre-IPO companies, the same way that companies pull traditional IPO plans during negative pricing environments. It's likely that plans for new SPAC listings and SPAC mergers have also been delayed until there's more clarity in the markets. And then, of course, also dealing a further blow during an already tough period for SPACs is the SEC, which has proposed rules that would strip the advantages that SPACs have over traditional IPOs. One of those proposals includes stricter disclosures on future projections for these types of companies. Guys.
Yahoo Finance's Alexandra Simonova. Good to see you. We'll talk to you soon.
Good to see you as well.
All right, still to come, BlackRock's Tony DeSpirito is out with some important new calls on the market. Tony joins us on the other side of the break. We continue to highlight big calls on Wall Street here on the morning show, and there is a new one we want to spotlight. Investors should prepare for a longer run regime shift in markets as the low rate environment transitions to a new world order. It's a good word of our next guest. Tony DeSpirito is BlackRock's CIO of U.S. Fundamental Equities and the portfolio manager of the BlackRock Equity Dividend Fund. Tony, great to get some time with you here today. So walk us through this regime shift. What does it mean to investors?
Sure. I think it's a really big deal, first of all. And let me describe what I mean by the regime shift. Post the global financial crisis, we were clearly in a very unique regime relative to anything we had seen in history. Consumers were really licking their wounds. They were unemployed. Their balance sheet was in grave need of repair. Their homes were underwater. They had lost money in the equity markets. And same with companies, as well as banks, importantly. And so what we saw was a period of very low growth and very low inflation by any historical standard. And I think that really came to an end with the pandemic. And so during the pandemic, we obviously shifted to a new regime that was obviously characterized by stay-at-home, tech becoming very much more important, also incredible stimulus, more stimulus than we've ever seen when you think about monetary and fiscal policy combined. And now we're in a new period, a new regime, I'll call it the post-pandemic regime, where actually consumers are in great shape in terms of their balance sheets. Their home prices are up 20%, stock market's up, unemployment's at 3.6%. So the economy is in really strong shape. And instead, the problem isn't low growth, but rather higher inflation. And so we are entering a new world of higher inflation. Now, I don't think we're going to stay at these high inflation numbers that we're at today. It's going to moderate, but we're still going to end up at a higher point of inflation than we saw over the last 12 or 13 years post the global financial crisis.
You make a great point in your note that you sent us, Tony, that it is getting complicated to be an investor. And I hear you on that. Look, we had the CPI print this morning, 8.5% on the headline, and stocks are rallying off of that type of print. It's not what you would have thought at first. So then how do you position your portfolio for this next decade?
Yeah. And so when I think complicated, I actually think that's good. That's good for fundamental investors who are seeking an edge. And we're seeing that today in higher dispersion of stock returns. They're definitely elevated. And so I think you got to really focus on a couple of key issues. One, costs are inflating. So which companies are most impacted by that and which ones aren't? Highly automated companies, for example, are not going to be as impacted by cost increases as ones that are very service and people intensive. So that's one. But then there's a second order question, which is, okay, given the impact of cost inflation, does this company have pricing power? How strong is its ability to raise price? Are there some moats? Is it a unique product, et cetera, et cetera? So that's an important investment question. And then the third order question is what's priced into the stock already? Is there hidden upside or hidden downside? And this is just fertile ground for individual stock pickers.
Where does tech fit into a portfolio now with this new regime, especially given how much they ran up during the pandemic through last year and given the sell-off in many of these names that we've seen this year?
Yeah, so I think it's a fascinating area. It's certainly a big area, an important area of the economy. There are definitely some stocks that I would call COVID hangover stocks that were their prospects were dramatically accelerated by what we saw in COVID, but they're now coming back to normal, right? So there's a group of companies that look like that. But there's also a group of companies, when you think about labor costs and wages inflating, tech is effectively, in many cases, a labor-saving device, all right? It's a productivity tool. And so there are a lot of tech companies that are going to experience actually increased investment in technology because of the need, because of higher wages, higher inflation. And so I think you're really seeing a bifurcation of names.
Tony, every day we seem to be just talking about the rise in yields, rise in interest rates that are likely coming, 7 to 8 hikes this year, perhaps, who knows? But do you suspect there will be some form of day of reckoning for markets at some point? Could be later this spring, could be this summer. At some point, you would have to think the markets adjust for this land of higher rates.
Yeah, so one of the interesting things is the market never fully priced in super low rates. Now, how do I say that? We run a model where we compare the earnings yield on stocks, so think of an inverted PE ratio, and compare that to the yield on bonds. And what we saw was when bond yields went really low, the equity yields, the earnings yield didn't follow them, right? Meaning the equity risk premium rose. And so based on our models, stocks have been very attractive throughout this period of time. And rates would actually have to go as high as 3 to 3.5% before you'd start to say, okay, bonds and stocks are equally as good, right? So there's still a lot of room for rates to rise from here before I'm worried about stock market valuations.
And when you think about the macroeconomic backdrop and what we're going to be seeing over the longer term, of course, heading into the pandemic, we had inflation sub 2% for years. Given the hot inflation print that we saw this morning, where do you see inflation ultimately leveling out here? And how does that factor into how you're thinking about this new regime as well?
Yeah, look, there are plenty of things about the current environment that are just abnormally high. I mean, I'll call it used car prices, which are actually starting to finally roll over. They were up 40% year over year. That's not normal. And in fact, used car prices are going to start to be a negative driver of inflation, actually, because once the supply of cars catches up to demand, you'll actually start to see used car prices coming down, for example. So I think it's important not to look at the headline, look at core, but then within core to look at more sticky measures. And so we look at the Atlanta Fed measure of sticky CPI. That's more in the around 4%. And so what we see is inflation coming down to that 3 to 4% range between the Fed actions and the fact that just sticky CPI isn't nearly as high as what you're seeing in the headline. And of course, inflation in general is just good for stocks. I mean, that's the history. Equities have done very well during inflation. They've done well even when the Fed is raising rates. That's the chart that you're showing now. And so I do think equities continue to be the best place to be when it comes to inflation and rates that we're seeing.
Is recession talk, Tony, anywhere? Are you talking about this amongst your teams? Are you positioning for it at all, or we're just overblowing it?
Yeah, so I think it's important to be talking about it and to be thinking about it. I think it's way too premature. Even if you look at the inversion that happened last week, it was short-lived. And even then, inversions don't spell recessions for usually, stocks continue to go up for another 24 months. So I do think it's early, but it's not too early to be building greater resiliency in your portfolios, right? So don't panic. A recession's not imminent, but do think about building more resilience in your portfolio. And the ways you do that is to up the quality, to buy companies with healthy balance sheets, strong free cash flow, good businesses with good moats around them. And then when we think about a portfolio, we always think in terms of a barbell. Cyclicals on one hand, non-cyclicals, more stable stocks on the other hand. We have over the last, since the pandemic, really tilted towards the more cyclical stocks. Today, we're moving that tilt more towards the stability stocks, particularly healthcare, because a lot of the stable stocks are already priced up. I mean, utilities, very expensive. REITs, very expensive. Whereas healthcare, it's stable, but it's also attractively priced. And so that's been, in my fund I run, that's been my favorite go-to stability sector.
Good words of wisdom. We'll leave it there. Tony DeSpirito, BlackRock CIO of U.S. Fundamental Equities and the portfolio manager of the BlackRock Equity Dividend Fund. Thanks so much, Tony. We'll talk to you soon. All right, coming out with its stock under some pressure, Krispy Kreme is frying up, or is it baking up? Or whatever it is. I'm going with frying up a savory new promotion designed to get more people into its stores. We'll have a hot take on this next.
It's time for Sazi's Take. And today, Brian, you're talking about gas prices and donuts. So tell us, what does Krispy Kreme's new promotion have to do with prices at the pump?
Indeed, Emily, this is a fast food focused Sazi Take today. So Krispy Kreme, have to give them a shout here. Another clever promotion, another clever traffic driving promotion, I should say. So from April 13th through May 4th, Krispy Kreme will sell a dozen original glazed donuts. That is their trademark item they sell for the price of a gallon of a regular gas. So as of right now, the national average for gas is $4.11, and there I am eating that glazed donut. So if you were to walk in there this week, you can get a dozen Krispy Kreme glazed donuts for $4.11. Now, normally these dozen donuts would cost you about $10. So all in all, a pretty good deal. And this comes at a time as the company, and like many other restaurants, are battling high levels of inflation. We just spoke with Krispy Kreme CEO Mike Tattersfield a couple weeks ago. Here's what he told us on that front.
The average user visits a Krispy Kreme 2.5 times a year, right? So when they're going to use this, it's about a celebration, and it's about a shared experience. So pricing is not the number one feature that someone's walking into Krispy Kreme to order the dozens. What they're looking for, particularly when they're looking at those occasions, is does the product match their expectations?
So, Emily, this is very likely a home run type of promotion for Krispy Kreme. It's catchy as you know what. It is a good deal, and who doesn't love a good donut when you can get it for more than 50% off? My take, no surprise, here it is. Tee it up. It is
Sazi's Take.
Yum! Very simple. To get a donut at a 50-60% off discounted price, that is great. Also, Yum too. It could drive a lot of traffic to Krispy Kreme stores at a time when its stock is under pressure and the street is probably not appreciating what the brand does, and the fact that it's probably going to grow units at a 10% plus annual clip for the next few years. But while we are on fast food, Emily, I'm just going to stay hot here, going to roll right through it. Got to mention Baskin-Robbins real quickly, now owned by Inspire Brands. They were originally, it was Baskin-Robbins, Dunkin' Donuts under one roof. They were acquired by Inspire for $11.3 billion in late 2020. They're out with a new logo, Emily, and I think we have it here on the screen, a little side-by-side image on the right-hand side of the screen. That is the new Baskin-Robbins logo compared to the one we have known and loved for many, many years on the left. Now, I was talking to one Baskin-Robbins corporate insider, and apparently they are trying to focus more on just going back to their heritage as a brand. And here's my take. Simple. Another one. Here we go. Hate it. Hate it. I do not like this logo. I think this is another corporate chieftain just trying to get or trying to signal to consumers that it's something different. They're not different. Baskin-Robbins sells 31 flavors. They're ice cream. That's why we go there. We love them. We're not going to go to you to buy very expensive coffee. In many respects, I can go to Dunkin', which is in the same store as Baskin-Robbins, and spend $8 for a cold brew. Don't like the logo.
Well, Brian, to be fair, I feel like a lot of us tend to not like logo changes, name changes for companies in the immediate aftermath of these changes going into effect. Maybe it's something we'll get used to. Perhaps they'll change it again down the line, and we'll wish that they had actually left it at what they just changed it to. So we will see on that front. But going back to your story on Krispy Kreme, of course, pegging the price of a dozen donuts to the price of a gallon of gas, definitely going to be interesting to see how sales trend for Krispy Kreme over that period. Again, that runs from tomorrow, April 13th through May 4th. So if you want your $4 and something cents box of donuts, make sure you head over to your local Krispy Kreme. All right, you'll be first in the door, Brian. But switching gears here, all eyes are also on Apple. CEO Tim Cook spoke today at a key privacy conference. Yahoo Finance's own tech editor Dan Howley has more on this. And Dan, what were some of the big takeaways?
That's right, Emily. Tim Cook spoke basically about how the iPhone and Apple stand to lose, as well as Apple and iPhone users stand to lose when politicians push forward their antitrust legislation that they're working on right now. Essentially, this is a privacy conference, and Tim Cook went up and said, yeah, but what about that antitrust stuff that's going on? And really what his argument was that the antitrust laws that are being considered in Congress would make people less safe by opening up Apple's App Store and the ability for consumers to install apps outside of that store. Now, the antitrust legislation that's being considered right now really has to do with Apple's ability to charge app developers the 30 to 15% fee on the sale of all of their apps. What he kind of equated it to in this speech was opening up the stores and making them more available to abuse. And really, what he's discussing is the idea of side loading, which is the ability for people to install apps outside of just the App Store, being able to go to a website and install an app. And you can do that on certain devices right now, Android, for instance, although there is a pretty scary looking warning when you do that. But you can also do that on a Mac laptop or a Mac desktop or a Windows computer. It's only on the iPhone that we really see this kind of block for people to do that. And Tim Cook basically saying at this privacy conference that it's important, an important means to protect people's privacy. But, it also happens to pocket them that 30 to 15% when app developers are forced to use that app store. So really, he's talking about two separate things, but trying to put them together. And that, yes, Apple does offer superior security to the likes of Android and Windows. But part of that has to do with the fact that Android and Windows are the most popular operating systems in the world. People tend to get their updates on iOS devices much faster, which patch holes that malicious apps could be abusing to then steal people's data and target individuals. And the antitrust issue is just kind of an aside. And obviously, this has been part of Apple's strategy going forward. They've been doing this since the Epic trial, basically saying that if the antitrust laws are put into effect, then Apple has to allow people to install apps on their iPhones outside of the App Store, then that will open those phones and those devices up to security problems. So it really is a way for Apple to kind of say, look, you're hurting consumers by putting these antitrust laws forward, not hurting Apple's ability to collect that 30 to 15% fee. But it really just seems like it's hurting Apple's ability to collect that fee.
And Dan, broadening this out beyond even Apple, how would some of these antitrust proposals, how would these affect some of the other big tech companies as well?
Yeah, it would have the same impact on Google or Google's parent Alphabet. Really, both companies essentially do the exact same thing with their app stores. They prevent people or largely prevent people, I should say. Google, again, does allow you to install apps from third-party sources, but you have to enable that in the settings menu. And again, there's that scary notification saying that, installing apps from unknown sources could have XYZ impact on your device, or you could download malicious software. So it kind of attempts to push people away from doing that. And both stores then have that 30 to 15% fee that they collect. So it would impact both of them equally. The bigger question is, though, how could this impact other things like game consoles, for instance? I could purchase things on a game console. Does that mean that I have to then only purchase them on the console, or can I open that up to a larger spot? Yes, there are physical games that I could buy, but when it comes to downloading, which we're seeing becoming more prevalent, it really is the only way to download games is through these different game stores. So does that then open up, other sources to these kinds of issues? And that's something that I think we're going to have to see when this legislation is really, hammered out. But I think as far as Apple and Google go, it's the exact same outcome for both of them. They would have to open up their app stores to allow people to install apps anywhere they want. And that means circumventing those fees.
All right. Yahoo Finance's tech editor, Dan Howley, thank you so much for that report. Up ahead, the CEO of frozen food and snacks giant Conagra Brands stops by for a chat on all things big food. Stick with us.
companies of all sizes are having difficulty outrunning the outstretched arms of inflation. Big food makers, of course, are on that list as they battle through inflationary pressures in commodities and worker wages. On the positive side, Big Food is still seeing elevated demand for food eaten at home, a trend that really picked up during the height of the COVID-19 pandemic. Let's talk more about these trends with the CEO of frozen food and snacks giant Conagra Brands, Sean Connolly. Sean, always great to get some time with you here. I want to start off a little bit on off the beaten path here. You noted in your quarter that sales of meat snacks, I imagine that's largely Slim Jims, they were up close to 22% in the quarter. Do you think we're going to see a broader snacks business revival here as people go back to the office?
Well, our snacks business has been on fire for about 2 years now as we really started innovating and getting behind it with some inventive marketing. And as you point out, the Slim Jim business and our Duke's meat stick business has just been absolutely on fire. So snacks is definitely very strong right now, even in the face of inflation and some of the price increases that you've seen. But it's not just our meat snacks business. Our popcorn business has been particularly strong in our sweet treat area. We've got some great new products in Duncan Hines. Of course, Ready Whip is always a sweet treat that people love. These are all businesses that have been growing robustly. And as we come out of the pandemic and we see the at-home eating and cooking behaviors proving to be much more sticky than some originally forecasted, snacks is right there in the mix. Why? Because people are getting their entertainment at home. And when you get your entertainment at home, you need snacks.
So very true. Sean, you mentioned inflation. As a veteran of this industry, of the food industry, have you ever seen inflation at these levels or even approaching these levels? And when does it start coming down?
Well, I've been doing this 30 years. And, as a manufacturer, you realize that inflation is part of the deal. You got to deal with it. It doesn't do any good to complain about it. You just have to deal with it. I can't say I've seen it at quite this acute a level or as persistent as it's been. But these are typically cycles. I think the key is, what do you do when you're facing the adversity? And as I said last week at our earnings call, you have to have strong brands and you have to have strong innovation, because that will enable you to take the actions necessary to try to recover some of the compressed profitability that you experience when the inflation first hits your P&L. And that's what we've done. We've taken that and we've seen our brands perform very strongly and continue to grow dollars and in many cases even grow units. And what that's showing you is that even at these modestly higher price points, in the context of the inflation that people are experiencing more broadly in their lives, the array of products that we're offering consumers are still a superior relative value versus other choices they have. And really, when you get this environment where this inflation is this acute, people are trying to maximize their household balance sheet. And what they really evaluate very carefully are the high ticket items. And one of the high ticket items is the expense they have eating away from home. And we've seen that has been one of the factors that has kept the in-home eating and cooking behavior very strong, even coming out of the pandemic.
Sean, this is Emily here. Where are you seeing the most cost pressures right now? Is it in labor, the meat and agricultural inputs, or elsewhere right now?
We have a vast portfolio, and we've seen just about everything we buy inflate over the last year plus. But in the most recent period, I would say the most acute areas have been our meat protein business, our dairy business, and our transportation expenses as well. You've all heard about a shortage of trucks, a shortage of drivers, et cetera. For the last 6 months, those have been the areas I say that are most acute. Some of those areas are areas that are difficult to hedge. So you're dealing more on the spot market. And so you do experience steeper inflation.
And Sean, you talked a little bit about this. I think the word you used is waves. So you've taken your first wave of inflation-related price increases. Now there's another wave coming, if I'm correct. How much is that wave? And have you seen any consumers balk at some of these price hikes?
Well, we've actually seen multiple waves already, and we've actually had to price for multiple waves. And we're seeing a new wave hit in our fourth quarter this year, and we will take additional inflation-justified action that will start to benefit our P&L in the first quarter of our new fiscal, which begins in June. And as we take these increases, we have to watch volumes very carefully, because we have to understand elasticity of demand and understand what the consumer response has been. And the response thus far has been quite benign in terms of elasticity of demand and consumers trading out or trading down. In fact, our business remains incredibly strong, which is why we believe consumers are seeing these products, even at a modestly higher price, have superior relative value. If you look at 3 of our businesses, Healthy Choice, Bird's Eye Voila, and Slim Jim, as you pointed out, these are three of our largest businesses. We've had significant inflation on there, and we've taken significant justified actions to try to recover some of the compressed margins there. And not only have we seen the business remain strong, those volumes are up in the absolute in terms of unit volume on three of our largest brands. So the resilience of our portfolio is clear, and that is not happening by accident. A big part of that is this is a company that has orchestrated arguably one of the largest innovation transformations of its total portfolio over the last 7 years. So consumers are finding these new innovations. These are modern products. They're provocative. Yes, they're at a modestly higher cost, but they remain an extraordinary value, and that's why they're performing so well.
Speaking of products, Sean, it looks like you're making an under-the-radar move or a more aggressive move in the plant-based meat market. What products do you have coming out there, and how big is your overall plant-based portfolio?
Well, plant-based trend has been a big thing for the last couple of years, and we've remained very focused from the beginning, putting most of our energy into our frozen space. We are the company that pioneered the kind of resurgence of frozen and said it's really not about the temperature state, it's about the food. And we've got to have high quality food there, and we've got to have the right kind of varieties. One of the varieties that's really hot in the last couple of years is plant-based meat alternatives in the frozen section. And of course, we play there with the Gardein brand. So we have continued to improve the quality of our plant-based Gardein innovations. Last year, we launched a lineup called the Ultimate lineup with Ultimate Burgers, Ultimate Chicken. And for grilling season this year, we've got the Ultimate Sausage line coming out featuring the new bratwurst. It is a phenomenal product. It's like cooking a regular bratwurst on the grill. Brian, I encourage you to try it for this upcoming grilling season. It's fantastic.
Oh, hey, sign me up, Sean. I'm ready to rock and roll. Lastly, before we let you go, you did tease an I guess an investor day on July 28th. Anything we should be looking out for there? Are you going to put out some 5-year targets or anything like that?
Well, the first thing you should look out for is we're going to move that date to July 27th because I think other companies have a bunch of earnings calls on the 28th, so that won't be the best date. We're now shooting for the 27th. What we typically do there is for investors that aren't familiar with our story, first we'll ground them in who we are, where we've been, and how we've really changed the company. But of course, we're going to talk about what's to come, what's to come in terms of growth, what's to come in terms of margin expansion. And ultimately, what investors always want to know is what does it add up to and what's the new algorithm and the new outlook?
Well, just feed them some of that plant-based sausage and give them some numbers, and we'll take it from there. I'm sure they will enjoy it nonetheless. Conagra Brands CEO Sean Connolly, always good to see you. Have a great rest of the week.
Take care.
All right, coming up, it has been a tough start for new Starbucks CEO Howard Schultz. More on this next.
The tough start for Starbucks interim CEO Howard Schultz continues. Starbucks' stock was just downgraded to neutral from buy at Citigroup. Analyst John Tower also lowered the firm's price target to $91 a share from $120. Now, Brian, I'm heading right over to you on this one. There have been a lot of challenges at this company in recent months. Just back in February, Starbucks already said that it was seeing more costs due to training expenses, isolation pay for workers. It's been dealing with a union battle. What are your thoughts on this downgrade?
Listen, this is not, I don't think this is the start that Big Howard Schultz wanted to see. He started on my birthday on April 4th as the new CEO, interim CEO over at Starbucks. So far in April, Starbucks shares are down 11.3%. And I hear what John Tower over at Citi is saying. He's a longtime restaurant analyst, used to be at Wells Fargo, one of the most credible restaurant analysts on the street. So when he downgrades shares of Starbucks, despite the weakness we have seen in April, you have to take it seriously. Now, Schultz, this week, he's been getting negative headlines. The New York Post reporting that he told a Starbucks worker at a town hall that was pushing for a union effort, quote, "If you hate Starbucks so much, why don't you go somewhere else?" So all in all, not a good start for Howard here. Likely when the company reports earnings in a few weeks, it's going to be a challenging quarter because a lot of the risks that John highlighted in his note, chief among them, inflation. But again, Howard Schultz just has to start just showing that he's not some form of tone-deaf fat cat executive here and try and connect better with these employees and Wall Street too, for that matter.
And of course, all of this has translated into a lot of pressure on Starbucks shares themselves. If we take a look at where that stock has been trading for the year to date, down about 31%. That compares to about 6.8% decline in the S&P 500. So certainly some underperformance there. And of course, even in the past month alone, we have seen Starbucks down about 3% compared to a 5.7% increase in the S&P 500. So the pressure continues really over the past several months now, whether you're looking at the year to date or the past month alone. And of course, just highlighting a couple of other pressures here for Starbucks. You have, of course, the fact that China, some key cities, including Shanghai, going into lockdown and renewed restrictions taking place because of that COVID outbreak. Of course, that is an important geographic region for the company. And if we look at where those comparable sales had been in the prior quarter, China comp sales down 14% compared to estimates of 9.3%. So we'll see where this trends in the latest quarterly results coming out in the next several weeks. But again, a tough couple of weeks here at the beginning for Howard Schultz, Brian.
And Emily, there's only so much they could charge to offset this inflation. Our producer Val, I think she gets an $8 coffee with Oatly in it. This is an expensive coffee. At what point do you push back and just make your own stuff at home?
It's a good question, and I think something a lot of these restaurant companies, including Starbucks, are having to ask themselves. So we'll see what shapes up next here for that company. But we want to get one final check of the market before we turn it over to our next hour of programming. Let's take a look at the three major stock indices trading solidly in the green, even after this morning's hotter than expected consumer price index, showing an 8.5% increase in that headline number on inflation. But that's going to do it for Brian Sazi and me this morning. We'll be back at 9 a.m. Eastern tomorrow. But for now, we're handing it over to Akiko Fujita and Brian Chung to take you through the next hour of trading. Don't go anywhere.
Welcome to Yahoo Finance Live, 11 a.m. here on the East Coast. I am Brian Chung alongside my esteemed colleague Akiko Fujita, here to hang with you for the next hour of trading. A lot going on this Tuesday morning. It is, of course, inflation day here in the United States. But let's take a look at where markets are trading as we are an hour and a half into this trading session. The Dow, the S&P 500, and the Nasdaq all up in the green. The Dow up 0.4%, S&P 500 up 0.6%, and the Nasdaq up almost 1%. As we did get CPI numbers on inflation. Of course, keeping an eye on the U.S. 10-year Treasury as well when we take a look at yields on that front, actually tilting down a few basis points to 2.71%, was somewhere close to almost 2.8% yesterday. But again, still much higher than it was just a month ago. 30-year yield also getting a little bit of price action, down 3 basis points. And of course, also watching oil. Take a look at prices getting higher in the commodities space as we see actually WTI crude oil and Brent crude oil back above $100 for the first time since the last week of trading, up $6 for both Brent and WTI. But of course, the big headline this morning, inflation. Prices in the United States increasing by the fastest pace since 1981 on the headline number, 8.5%. When you strip out food and energy, 6.5%. On that CPI, Akiko, prices continuing to rise in this country.
Yeah, it's interesting to see those the moves we saw on those bond yields you just highlighted, Brian. You know, when we saw that move on the back of this report, obviously the headline number, it is the fastest gain that we have seen since 1981. But it does feel like investors finding a little relief in the core number, obviously stripping out food and energy. And when you look at the number here, it is at 6.5%, but 0.3% gain month on month compared to the 0.5% you saw the previous month. And you have to wonder if, investors are looking at this saying, well, maybe those price increases, at least the rate of those increases, are starting to abate.
Yeah, and for what it's worth, I mean, people are pointing to some specific components of this report to say it's possible this could be a peak. When you take a look, for example, at used cars and trucks, this has been a major component of focus through the inflationary figures that we've gotten since the middle of last year. Actually, used car and truck prices decreasing by 3.8%. But when you look across the board, it's not just gasoline and the commodities related increases that were driving a lot of the March gains. That was certainly a big part of it. But all the adjacent categories have seen that bleed through as well. When you take a look, for example, at airline fares up 10.7%. You and I have both noticed that, as we had in our conversation with Helene Becker yesterday. So obviously, Akiko, commodities very much remaining a part of the picture. The Biden administration trying to pin this on the war in Ukraine, that has certainly had an effect. But look, we have to remember the inflationary pressures that we saw actually preceded the beginning of the Russia-Ukraine conflict at the end of February.
Yeah, and Brian, you just talked about ticket prices going up. Obviously, we've heard from airline executives, including Robin Hayes over at JetBlue, talking about having to cut back on some of those routes because of the high fuel prices. But if you look at gas prices right now, things have started to come down. I was just looking at the numbers out of AAA today. The national average for regular gas is $4.09 a gallon. You compare that to $4.32. That's where we were a month ago. So that's some sign of relief. Whether that can be sustained is a whole nother question. And of course, as you said, the Biden administration really trying to get out in front of the messaging to say we are acting on this. And today, we're going to see the president travel to Iowa to announce he's suspending this federal rule that essentially prevents the sale of gas blended with higher ethanol content. Average is about 10%. The president is saying that it can go to 15% this summer. That's typically a time when that type of blend is not allowed, quite simply because it's a dirtier fuel. It means more emissions, more smog. But the president saying that this move will enable gas prices to come down. The White House is saying about 10 cents a gallon.
Yeah, and for what it's worth, again, Brent and WTI, the price has come down over the last 4 weeks or so, but it has not bled through to the prices that people are paying at the pump. But Akiko, I mean, just to kind of remove ourselves from the technical terminology of CPI year over year, month over month, I mean, Americans are feeling this. And when I have conversations with my friends and my family, they're all noticing this. And the one thing they always point out is the increasing price of gas. So even though you have some economists, I've seen so many notes in just the last 2.5 hours saying, it's possible this could be the peak here, but I could imagine a scenario where the headline CPI number comes down. Maybe core CPI is going to come down actually faster because energy prices come back down. But at the end of the day, if people are still paying relatively elevated prices compared to where it was, let's say a year ago, that's going to be a very painful pinch, especially on those lower income households that spend a higher share of their income on these energy prices. So again, even if this is the peak on a number-wise basis, I feel like the issues that Americans are really concerned about is not necessarily going to abate immediately at that point in time. But let's get a little bit of a deeper dive into this report with an expert who's been watching the data throughout this pandemic recovery, and that is, of course, Beth Ann Bovino over at S&P Global Ratings, chief U.S. economist. Beth Ann, it's great to have you on the program this morning. Simple question here. Do you feel like this really high print that we got this month is going to be the top, or should we expect to see perhaps double digits in the coming months?
I see this as near top. My concern is that some of the we did see the impact on commodities, both you mentioned gasoline and some other things. A lot of that was driven by the Russia-Ukraine crises, but some of the components that some of the commodities that Russia exports to the U.S., which either are blocked or sanctioned, also feed into other prices. You mentioned cars. Cars also rely on palladium from Russia, neon from Russia. That stuff is not going to be coming through anytime soon. That to me says the supply chain disruptions that we're feeling in cars and other production areas are going to still be felt, meaning that path to come down is going to take a long time.
So Beth Ann, don't want to make too much of just 1 month here, but it sounds like your forecast stays here, even if some investors today are reading this number as a peak.
I would say it's near or at the peak, but look, we're at 40-year high. Could it be 43 next month? Possibly so. It's still going to hurt whether it's 43 years or 40 years, and that's the issue. How will consumers respond? Will they start to close their pocketbooks? Will they start to save more? Concerned that they won't have anything left of their dwindling nest egg? Those are concerns that we see, and of course, this is going to keep the Fed very busy as well.
So I guess when we take a look at future reports, what's going to be the focus? The expectation appears to be that, well, the commodities-related bump that we saw in March might not be as high as in the April reports. When you look at things like, for example, shelter, owner's equivalent rent, we're showing that right now, up 0.4%. These are increases that are likely to be stickier because of the nature of being locked into a lease or a mortgage. How important are those factors for those future reports?
I think those. So when we talk about the Russia-Ukraine crisis, you can see now that that has exacerbated all pricing pressures. But your point is well taken. That it's not just an international story; it's a domestic story as well. When you look at housing, the home prices have been reached extreme highs. You talked about shelter; that also was extreme, based on people coming back to cities after the COVID-19 crises. So that means upward pressure, another squeeze on household rents. And when you talk about wages, yes, wages are at record highs, but when you factor in prices that have climbed even higher, in real terms, wages are negative, and we don't see that changing anytime soon. That's going to be a squeeze for the households going forward.
There's always this question of demand destruction. At what point do you reach that threshold where consumers say, we're no longer going to buy X, Y, and Z? We're talking about food and oil as primary drivers of these price increases. What are you seeing in food specifically? I'm looking at the number here, up 11% from the previous month.
When we look at the CPI readings, one thing that I take into account, you mentioned core prices, which are core, I guess, is at 6.5 year over year, well above the 2% target for the Fed. The CPI doesn't take into account the substitution effect, meaning don't buy steak, buy chicken, which is relatively cheaper instead. So that means there's a little bit of upside on that. But even if you factor that in, even if you take into account the substitution effect, bringing it down a little bit, that is still 3 times the Fed's target. In terms of households, what we could expect to see, the one positive side, they are sitting on a lot of savings, and that's not just on the high end; it's also on the lower income spectrum as well, giving people cushion. But we know paying these high prices at the checkout stand mean that that cushion will start to wear down, and that's where I see consumers starting to slow. I think they're going to start to move basically into starting to trade down for other things, but then you could start to see them slow down and start to shut their pocketbooks as well. That's probably a story for a few months out, though.
How about the goods to services story? Because there was that argument that, well, as people maybe stop staying at home buying things online, as they go out into the economy, they'll spread their expenses and kind of go into categories that haven't seen price increases. But this report showing that services prices increasing at 5.1%, that's the biggest pace since, or fastest pace since 1991. Is that a concerning narrative for you?
Well, I guess the good news is it's a lot lower than what was for used car sales, which I think was over 30% year over year. But what that means is that so the upside. Think about it. The food, the food that goes into those restaurants, it goes into the menus that restaurant makes, has also gone up. Restaurants are pushing that forward. What you could expect to see, and we did think we were going to see a kind of an adjustment in the consumption basket, meaning that everybody was at home, bought up one home or second home or even a third home, had to fill it with lots of stuff. That does reach a saturation at some point. You would expect to see people moving away from goods purchases to services as people got out some more. So we would expect to see that. And of course, what you also signaled is that inflation is everywhere, not just in goods and certainly not international. That's just going to be another squeeze. I think people will still be going out. Again, they do have some cushion, but I think they'll be just more circumspect about where they spend it.
Yeah, thinking a little more about what the plans are on the horizon here. Beth Ann Bovino, chief U.S. economist at S&P Global Ratings. Good to have you on today. Coming up after the break, the clock is ticking for Russia as the country is expected to default for the first time since 1998. We're going to break down what this means for investors as sweeping sanctions hamper the Kremlin's ability to make payments in dollars on foreign debt. We'll be right back. Western sanctions are continuing to weigh on the Russian economy, with the country defaulting on its foreign debt after attempting to pay it down in rubles. This comes just days after S&P downgraded its assessment to repay its foreign debt. And Brian, worth noting, there is a 30-day grace period, but Russia already threatening to take legal action here.
Yeah, well, we know that all of the Western sanctions on Russia have greatly impaired the country's ability to repay its debt. But we need to kind of take a look at the timeline here just to kind of keep track of exactly what's going on here. Again, all of this concerns Russia's ability to repay the government debt or Russian bonds that people around the world buy. So there are a number of foreign bondholders that had signed on for foreign currency issued debt. So on April 4th, there were payments due on US dollar denominated Russian bonds. And this is important for a second. I'll just leave that there for now. But there's a 30-day grace period on how the Russian government can kind of make those payments whole. Now, they made those payments on time, but apparently they paid these bondholders in Russian rubles instead of US dollars. So they have a few weeks to get that straight, maybe fix that and pay them in US dollars. But keep in mind, there's that May 25th date that's coming up at the end of next month, in which case the US government is no longer going to allow any American bondholders to take any sort of Russian payments at all. So this is a cascading effect, and you're already seeing the ratings agencies say, look, we don't feel confident in Russia's ability to make these payments, even those that were paid in rubles. They would not be able to convert those currencies into US dollars. So the S&P Global Ratings team turning this into a selective default on Russia. Keep in mind, the other agencies have actually technically suspended further coverage because of EU sanctions on the agencies themselves. But again, something very close to watch here because Russia might not be able to pay its bills in the coming months.
Yeah, and Brian, what's interesting is we've been watching so much the impact of Western sanctions on the Russian economy, but the Ukrainian economy also struggling as well. We saw the World Bank come out and say that the Ukrainian economy could shrink by as much as 45% this year. We saw that interview in the Financial Times today with the finance minister. They're saying we need immediate financial relief. Yes, we need weapons. Yes, we need arms here to help fight against Russia in this next phase of the war. But in addition to that, they are also hurting financially as well. And so it's interesting to see the trajectory of these two economies that are caught in this war.
Yeah, and we have to remember the ruble dynamics here. I'm not going to go into a full-on Yahoo U because our viewers would probably fall asleep. But the point here is that the U.S. economy, the U.S. Treasury, a number of other countries as well have effectively sanctioned the Russian central bank and the ability for them to access any sort of foreign reserves that they have. Now, keep in mind, the Russian ruble, when they defend it against, let's say, for example, short selling, they need to rely on other baskets of currencies like the U.S. dollar to make sure that they can keep the value of their own domestic currency afloat. And that's why you saw the Russian ruble devaluate so much when the U.S. Treasury first announced sanctions on the Russian central bank. Now, the Russian ruble has recovered quite a lot since then. That's because of internal capital controls that Russia has imposed. But of course, the question is, how long can they continue to do that? Because they've already had to burn through a lot of the U.S. dollars and other reserves that they had on their books to begin with. So we don't know the extent to which they've relied on that because the reporting of it has been a bit thinner than it was before the Russia-Ukraine conflict. But look, at the end of the day, this is all about the ability to defend your currency. When we talk about the Russian government paying their bondholders in a currency that's not the US dollar as they were promised, this is a big deal. This is like if you Venmo requested me, Akiko, and instead of paying you back in the dollars that you had asked for, I just gave you a bunch of Turkish lira or Zimbabwe dollars or something like that. I couldn't imagine you being particularly happy about that.
Well, and the bottom line here, though, is that these sanctions were intended to pressure Vladimir Putin to basically think twice about this next phase of the war. That hasn't had that intended effect. He's made it pretty clear that he is continuing with what has been the initial mission for Russia and not necessarily backing down as they really refocus on the Donbas region. So the Russian economy is certainly struggling, but that hasn't necessarily had an effect to curb Vladimir Putin from his military actions. A story we're going to continue to watch, of course. But coming up on the other side, the secret toll of for-profit colleges, we are breaking down a new report that reveals the unexpected price tag for some universities. That's coming up ahead. Well, 1 in 8 Americans have student loan debt with a grand total of $1.6 trillion. New data, though, points to the fact that the toll has fallen disproportionately on students who attend for-profit colleges. And our very own Arti Swaminathan is here with that data. Arti, it's a real contrast here when you look at the two sides.
Hiko, it's really nice to see you. So when you think about what kind of schools that these people are going to, you know, that transparency is really important, right? So if you are a non-traditional student and you're thinking about what college to go to, very often you kind of choose the college that is nearest to you. And this is according to new research from researchers from Cornell, from the Federal Reserve of New York. And it is really striking to see how much more you're paying because you're going to a for-profit college. If you take a for-profit college, a 4-year degree versus a community college, you're going to pay about $3,300 more. And if you choose a 2-year course, say like welding or like barber school, and you go to a for-profit school over a community college that's kind of further away from you, you're going to pay $6,000 more in debt. So when we zoom out and think about student loan forgiveness and what are we forgiving, we need to also think about why these people are taking on more and more of this debt. And it is really, again, it's a convenience thing, right? Like if you see a school, an ad, University of Phoenix, DeVry, you sort of gravitate towards these options because you are familiar with them. But going to a community college might actually save you thousands of dollars more. You're less likely to default if you take on less debt. If you go to a for-profit school, you kind of increase the likelihood of default by 11 percentage points. So information is really key before you take on debt, before you choose your school. But during periods of recession, especially when people are out of work, people are desperate to pivot, people just really want to fill gaps in their resume, they make, you know, they don't really spend as much time on this thing, which is sort of why we need to think about improving all these things.
Arti, it's Brian here. Great to see you. I wanted to ask about the government pressure on these for-profit colleges. There's been some chatter about maybe them cracking down on the way that these kind of universities can extract a little extra tuition out of them. Is the government going to do anything about that?
So what is interesting is during the Trump administration, we saw a sort of a very heavy leaning towards for-profit schools. Some of the government officials that were in the Department of Education had come from for-profit schools. So there was this pullback during the Betsy DeVos era against regulation. But now with the new administration, with the new head of the Consumer Financial Protection Bureau, with the FTC, all these government regulators are paying more attention to, okay, how much debt are these students taking? Are the job placement rates making sense? So there is really a concerted effort to look at outcomes. So it's going to be very interesting to see if they're going to be cracking down. The FTC has already put 70 schools on the watch list saying if you misrepresent job placement rates, we're gonna come after you. So it's going to be very, very interesting to see when enforcement actions will be taken. Obviously, they take a little bit of time. You need to do a little bit of investigation. So that's why, we've done stories about in the past about a crackdown that's coming. So it's going to be very, very interesting to watch.
All right, Yahoo Finance's Arti Swaminathan. Great to see you again. Talk to you very soon. All right, coming up on the other side of the break, we are going to take a look at shares of Bed Bath & Beyond ahead of their earnings. An analyst will join us next to explain why he predicts the numbers will be horrific. Yes, you heard that right. Plus, we're going to take a closer look at GameStop chairman Ryan Cohen's influence on the company. A lot to talk about. Stick with us. Folks, the smell in the air of spring also comes alongside earnings season. And tomorrow we're going to hear from some big companies, including Bed Bath & Beyond, which many of our viewers will know has taken on a little bit of a meme stock vignette over the last few months and quarters. Let's bring in Anthony Chukumba, Loop Capital Managing Director, with more on this. Anthony, it's great to have you on the program this morning. You've got a spicy note about Bed Bath & Beyond ahead of the earnings tomorrow. You have a sell rating on this stock. You think the target is somewhere around $10. Tell me what you expect to see in those earnings.
I mean, I think the numbers are going to be very, very, very terrible. I think that comparable store sales were probably down in the high single digits, maybe even low double digits. I think they had a very brutal holiday selling season. Now, one of the keys really is going to be their guidance for 2022. Current consensus that they're going to earn about 64 cents a share. I think that's nonsensical. I'm at 25 cents a share. And quite frankly, I think there's downside to my estimate. I mean, this is a company that has lost a lot of market share, has lost a lot of relevance with consumers, and it's really difficult to get those things back.
I mean, $10 a share, significant downside from where it's trading. We just showed it at $18.91 right now. What do you think drags it down?
So I think at the end of the day, at some point, investors are going to have to start dealing in something I like to call reality. Look, there's this notion that this company can be taken private. That doesn't make any sense. It's already way too levered, and the fundamentals are terrible, and interest rates are rising. There's this notion that Bye Bye Baby is worth maybe more than the entire company. Once again, I did a very detailed analysis of that. Bye Bye Baby is not worth anything close to the entire market cap of the company. So I think at some point, as the saying goes, in the short term, the markets are a voting machine, and long term, they're a weighing machine. At some point, the stock price has to reflect the fundamentals of this business, and the fundamentals of this business are terrible.
Okay, so then on that point, it sounds like you're going to be dialed in very closely to the earnings call. I mean, the strategy for Bed Bath & Beyond has been kind of set out in the shape of perhaps, reinventing their stores. Perhaps we've seen that in the Manhattan location here where I stopped by a few weeks ago. I mean, is any of that important? I mean, what is the biggest story if there would be some turnaround that might incentivize you in the future to perhaps raise your price target? What would you like to see out of the management from this company?
So therein lies the problem, which is that they're already doing all the things that I would have wanted them to do, right? So let's rewind a little bit here. A couple of years ago, a trio of activist investors got involved with Bed Bath & Beyond, and they were saying all the right things, right? You should sell your non-core assets. You should rationalize your merchandise assortment. You should do more private label. They did all those things with this new CEO, relatively new CEO, who came in with, big credentials, used to run merchandising for Target. None of it has worked. The patient is too far gone. I call this JCPenney 3.0. The reason I call it JCPenney 3.0 is, remember, JCPenney 1.0 was when Bill Ackman got involved with stock. He brought in Ron Johnson, the guy who had founded the Apple stores. That didn't work. JCPenney 2.0 was a couple of years later when they brought in Marvin Ellison, longtime Home Depot executive. He's now running Lowe's, doing a great job there. That didn't work. I just think that the patient has stage 4 cancer, so you could bring in, a reincarnation of Sam Walton. It'll be too little, too late.
You're just getting wound up. I can see it, Anthony. There's a common thread between Bed Bath & Beyond, the stock you're talking about now, and then, of course, GameStop, which is a stock you used to cover. I know you no longer cover it, but Ryan Cohen, I'm looking at your note here, and I'm thinking how many times you said the emperor has no clothes. What do you mean?
Well, what I mean by that is, look, I'm not taking anything away from Ryan Cohen. He has at least 3 zeros in his net worth more than I do, right? He founded this company, Chewy. He sold it for $1 bajillion. But let's just rid ourselves of this notion that somehow he's the next Warren Buffett, because he's not, right? Look, he bought a big stake in GameStop. He became the chairman. He brought in all these executives, brought in all these board members. The stock went up a ton. But have the fundamentals of the business gotten any better? Any better at all? The answer is no. And by the way, the stock peaked at $483. It's now down to about $150. Same thing with Bed Bath & Beyond, right? He bought this stake in Bed Bath & Beyond. He brought in these board members, but in his letter, he said, oh, you could easily take this thing private. Oh, no, you can't. He also said, hey, the market cap of Bye Bye Baby is more than the entire market cap of the company. Once again, no, it's not. So let's just rid ourselves of this notion that he's the next Warren Buffett, because he's not. The emperor has no clothes.
Okay, Anthony, just to kind of push back on that, though, I mean, some could argue that, yeah, even though Ryan Cohen is going about a different way of doing this, he has encouraged the stock to go up. Yes, it's definitely fallen from the highs that we've seen, but I don't think anyone 3 years ago would have predicted that GameStop's shares would be where they are right now. And they've tried to use that as a financial maneuver to improve the position that the company is in. So when you look at actions like scooping up 100,000 more shares of the company, I mean, given the circumstances of GameStop and its ridiculous story over the last 2 years, is it maybe not that bad what Ryan's been doing?
Look, the only thing that he's done where I applaud him is he took advantage of, the meme stock, moronacy, and I don't know if that's a word, maybe I made that up, but I think you know what I'm getting at. And he did issue more shares, and so so basically they took advantage, and they basically gave themselves a financial cushion of to live to fight another day. But I'm just talking about the actual fundamentals of the business. Have the fundamentals of the business improved? And the answer is clearly no. And so until I see some evidence at Bed Bath & Beyond, I'm just not going to buy it. I mean, call me a boomer. That's fine. I mean, I have to look at the fundamentals of these businesses, not on what's going on in Reddit message boards.
I mean, you as an analyst need to look at the fundamentals, but isn't the reality that these stocks, whether it's Bed Bath & Beyond or GameStop, just haven't traded on the fundamentals? And to your point, do you think they should lean in on the meme trade like we've seen from, for example, Adam Aaron over at AMC?
So, let's just, you can easily do this. Pull up the stock price charts for Bed Bath & Beyond, which got caught up in the meme stock stuff before, for GameStop, for AMC, for Cost, for, Newegg. I mean, yeah, these stocks go up a ton, but then they come back down because at some point, there just aren't enough of these, sort of meme stock traders in the world to support these valuations long term. And at the end of the day, I mean, that's, at some point, these companies' stock prices are going to reflect the fundamentals of the business. They just are. And if they're not, like, I hate to say it, but we're going to all be looking for new work.
Well, I certainly hope not. But I want to ask just kind of the big picture question here. You've been doing this for a long time. I mean, the investing landscape and the story and the narratives that we're following in 2022 are very different than they were in 2018, 2017 because of the prevalence of this retail trader and Reddit boards, for example. Is it on net good or bad for capital markets as an analyst when you watch these types of things?
So, look, I want to be very careful about the way I answer this. Look, I think that it is wonderful, absolutely positively wonderful that you have more and more people, getting involved in the stock market at an earlier age, right? I mean, this is how you build wealth. This is how you save to buy a home, save for retirement, save to put your kids in college. But at the end of the day, there's a difference between investing and doing it in a sort of reasonable way and, going on a message board and, talking about, diamond hands and, to the moon. I mean, that's not investing, that's gambling. If you're going to do that, go to the casino. At least there you get free drinks. So, look, I like I said, it's wonderful that retail investors are doing this, and we're seeing more and more of them doing that, particularly retail investors of color, quite frankly. But, like I said, there's a difference between investing and gambling, and this is not investing, it's gambling.
That's why we like to have you on, Anthony. You never hold back. Anthony Chukumba, Loop Capital Managing Director. Good to have you on and hope to have you back on the show again soon. Coming up on the other side, Bitcoin strategy shakeup. We're going to take a closer look at how lobbyists are going state by state to help advance crypto legislation in the absence of concrete federal regulations. Well, as federal regulators look to shape policy around cryptocurrency, some state lawmakers are rushing to get ahead, in some cases with help from the crypto industry. Lobbyists for crypto firms are expanding their footprint. And our next guest recently set up shop in Albany, New York, in an effort to shape a slew of crypto-related legislation. Let's bring in Kristen Smith, Blockchain Association Executive Director. And Kristen, it's worth noting that you do represent more than 80 companies in this space. It's an interesting strategy here because we've been so focused on the federal side of things, which always takes a little longer to take shape. What's the thinking behind going after state lawmakers or working alongside state lawmakers?
Well, there have been some states that for a while now have been trying to move policies forward to make their state more attractive for both Bitcoin mining investment, but also other parts of the cryptocurrency industry. And, you know, a lot of the regulatory issues do lie at the federal level, but there's a lot of work that the states can do to make it more attractive. And so, you know, there have been a lot of individual efforts at the state level, and there are a lot of small organizations that have been working very hard. But at the Blockchain Association, we wanted to help contribute to this firepower and have decided to start with New York, just given that that is such an important state across the nation. So really great to see sort of that, you know, the competition among states to make it more attractive. And, you know, the process at the federal level is going to take some time. So if there are things we can do at the state level, we want to engage constructively there.
Yeah, Kristen, it feels like on Capitol Hill, there's still a lot of kind of knowledge gathering that's happening. So maybe a little bit faster moving can be done at a local level. But give us a little bit of insight into exactly what you're talking about here. Let's say, for example, in New York, what are the types of policies that you feel would kind of further accelerate the development and usage of Bitcoin in the Empire State?
Yeah, well, so New York is an interesting state because if you look at the local level, you have Mayor Adams, who's incredibly pro-crypto. If you look at the federal level, you have Kirsten Gillibrand in the U.S. Senate, you know, who is an emerging leader along with several members of the House. The state level is a little bit of a mixed bag. You know, we have a bit license in New York, which is a pretty robust process that really needs to be streamlined in order to allow more companies to have a bit license. Right now, that process is very long in order to get the right licensure. We're also seeing some state legislators have concern about the energy consumption of mining and are moving quickly to pass bills. So what's going on with New York is actually more of a defensive play, but there are other members in the assembly that are interested in learning about this. I think that what's, you know, the key to crypto policy, whether it be at the state level or at the federal level or, you know, even internationally, is you can't get good policy without having an informed policymaking community. And so what we want to do at the Blockchain Association is work with local companies in New York and others, you know, stakeholders in the crypto ecosystem to make sure that policymakers, regardless of what level they're at, to become more educated so that they can make sound policy choices. It's when these things try to get moving quickly without the right background knowledge that we often have legislation or rules that have unintended consequences. And so we would like to avoid that with New York.
Kristen, how much of this localized approach is about trying to influence from the ground up to pressure lawmakers at the federal level, whether it is New York or Wyoming or a place like Texas? You know, in many ways we have seen in other industries like marijuana, for example, where it is the local policy that shapes the federal policy ultimately, because at some point you've got enough states who have some type of guardrails in place.
Yeah, well, listen, it's interesting because most of the on-ramps and off-ramps to cryptocurrency today are regulated at the state level with state money transmitter license laws. And those were sort of the early licensures that crypto companies would seek out. I do think that there is a case that there could be a federal alternative down the road. This is certainly something that has been part of the discussion around how to regulate stable coins. You know, there are some issues, like when you look at securities laws, that really clearly do fall within the federal the federal remit. But if you think about states like Wyoming, Wyoming was very, very pro crypto. Early on, they've passed several bills that have become law that have really made Wyoming an attractive place for crypto companies to do business. That has actually translated to the federal level, because if you look at like Senator Lummis, for example, from Wyoming, she's a huge fan of Bitcoin. And that's because her local Wyoming legislature was interested in it first. And so a lot of it is about sharing awareness, about showing that there is political support. You know, the crypto community, I think, is incredibly powerful in that they're very organized, they're very passionate about what they're building, and they're not afraid to pick up the phone and call their legislator or their congressman or their senator when something goes on. And so I think that that one of the most powerful things is the state is just helping to bring that education level up, because oftentimes it's those state legislators that end up making their way to Washington.
Kristen, and then lastly here, I want to ask about who else you're engaging, because as you're kind of having these discussions at the state level, it's more than just those legislators that you're talking to. I imagine you want to engage with, for example, the Department of Financial Services on the regulatory framework there, as well as the state banking regulators on anti-money laundering, know your customer kind of rules there. How difficult is that? Because you don't want this patchwork to be put together where the compliance in one state is going to be a little different than in a neighboring state, for example.
Yeah, no, it's a little bit daunting. I mean, you've got treasurers that are interested in getting involved. You've got attorneys generals that need to have more education. You have governors. There are a lot of different actors, like you mentioned, within the state. And, for us, we're really starting with New York first at the Blockchain Association. But as I mentioned, there's a wonderful network of smaller organizations within the states that have really been doing a lot of the work, to date. And so we don't want to compete with them. We want to support those efforts and coordinate with them. I think one of the things that's great about the cryptocurrency industry is that for the most part, they've really sort of banded together and realized that, we need to have as many people working on these issues as possible. So it's not a competition. It's trying to figure out how we can add our policy expertise or some of the expertise with our membership to existing efforts that are really, sort of organically being built up at the state level, and be, additive to that process and not try to replace the existing efforts that have been in place.
Kristen Smith, Blockchain Association Executive Director, thanks again for stopping by the show. We'll talk to you again soon.
Great. Nice to see you, Brian.
All right, time now for our chart of the day. We're going to take a look at the crypto space, staying there, and we want to talk about NFTs, specifically those Bored Apes that you've seen, part of the Bored Ape Yacht Club. The price of these have shot higher over the last year. In fact, right now, these images are going for about 110 Ether. That's the y-axis here. That's about $333,000 US at the moment. We know that they're planning a metaverse, but get this, Coinbase apparently going to produce not one, not two, but 3 films based off of the Bored Ape Yacht Club. And Akiko, you can feel however you want to feel about NFTs or Bored Apes specifically, but maybe this is just part of the broader trend for these financial stories getting turned into live action. I mean, there's so many movies and TV shows now about some of these big narratives that have been catching the eye in the likes of Yahoo Finance, honestly.
Yeah, this feels pretty consistent with the brand, though, right? When you think about, number one, not necessarily that it's a trilogy, but how it's involving the NFT community to shape what this film is going to look like. Number one, we're hearing that those are going to have a say in the plot of the film. You can submit potential characters that could be considered by real-life Hollywood casting directors. So I'm not necessarily opposed to that. I'm still thinking about that price that you just mentioned, though. Did you say $330,000?
$333,000 US in fiat, of course. It's only 110 Ether. So I don't have that money. If I did, I would be saving it for a space flight anyway. For your space flight.
I'm all for it. Better to have the space flight than
I can't even think of though.
I like the experience.
A movie trilogy though. Like, what was the last trilogy that I've seen that I actually thought was good? Lord of the Rings, honestly, because the Star Wars, the latest Star Wars ones really stunk. Ugh.
I have not watched. I'm trying to think of the last trilogy I watched. I did not watch the Star Wars
I feel like
trilogy.
it's not a thing anymore. You know, like ever since that era of like the Harry Potter films and the
You know, it brings people to the theater. I'm not sure we're the demographic, but if you look at the box office, I mean, just look at ticket sales. It does bring the crowd out at a time when we're talking about what's going to bring people to theaters. I mean, those trilogies do well, right?
Yeah, we'll see. Again, I don't know when these movies are going to get made, but we will see what's going on that front.
I'm
but
watching.
maybe
I'm going to watch
team
it.
outing. We'll all go see the Bored Ape Yacht Club films, all three of them. We'll leave that there for right now. Coming up on the other side of the break, working from home can feel like working around the clock for some Americans. Our latest Yahoo Finance Twitter poll reveals how employees feel about the pressure to stay dialed in while driving. That's ahead. Well, there's been a 20% increase in car crashes compared to pre-pandemic levels. And interestingly, work might have something to do with it. Travelers out with a study a week and a half ago showing an alarming number of American drivers distracted while behind the wheel. Apparently, 42% of respondents say they take work-related calls, texts, or emails while driving. And we asked the question on our Twitter poll. You can see the results here. We asked, do you feel pressure to do work behind the wheel? And interestingly, about 60% said no, 40% said yes. And we were talking about this among our Yahoo Finance team here on the 11 a.m. show. And people were a bit surprised that the yes wasn't a little bit higher here. So let me just put you on the spot, Akiko. When you're driving down the 10 in LA, going west, do you ever take work-related slacks from me or our 100%. Team?
Yeah, I mean, I am one of those drivers who thinks they can balance calls and driving. But what I'm curious about is that, you know, to me, calls are just kind of the bare minimum here. You know, what happens when you get a Slack or you get a text message, you're sitting in traffic and you're slowly moving and yet you could be there for 40 minutes. To me, a 40-minute gap of not responding is not acceptable. So then I respond. I sort of just put one hand on the phone and try to, I mean, I'm admitting to it, but I am one of those that feels the need to reply.
I don't have a car in the city, but I'm just imagining Akiko in her big SUV in Los Angeles, driving, answering Slacks. Although I will say that our producer does expect us to respond to Slacks within 30 to 40 milliseconds. So there are high stakes there.
Well, and I think that's across the board. I mean, one of the numbers you didn't point out necessarily from this Traveler's Risk Index is that the majority of business managers, 86%, expect employees to respond to work-related communications while outside of the office during work hours. I mean, I will say also the news industry probably is not a good indication of what the protocol should be. I mean,
No, it's not.
As long as I've been in this business, it's 24 hours on call.
I mean, across industries, though, it has been the case that the work-life balance has definitely blended because people are no longer in the office anymore, right? So these type of digital communications, texts, Slacks, emails, calls are much more prevalent in the current work kind of structure than they were even in 2019. So even though people aren't necessarily expected to be on the clock at like 2 a.m., I mean, if it's 5 p.m. and you're just driving to the store to go grab something real quick, that's definitely going to be a situation where you might be in this contingency of people feeling pressure to answer the phone calls. But again, yeah, go ahead.
And Brian, this is where technology comes in, right? I mean, how many times have I tried to talk into my Apple Watch so that I can dictate what I want to say? I've had fights in the car with a Siri before. So, you know.
Not with me, by the way. Other coworkers.
All right, that does it for Brian and I in this hour. One last look here, all three major indices in the green as we head out. We'll see you tomorrow.
At the fintech space with Jeff Cantwell, Wells Fargo Managing Director. Jeff, good to see you here this morning. So this entire space, along with tech more broadly, has really been battered year to date for various macroeconomic happenings. Of course, the rising yields, tech stocks don't like that. Why are you saying now is the right time to buy?
Well, first of all, thanks for having me. When we look at the fintech space right now, the fundamentals look solid. I mean, they look strong. We think companies that we launched coverage on, they're leaders in the space. And generally speaking, they're driving three key trends that we think are sustainable, which are digitization, modernization, and many of them are focused on consolidating vendors for their customers, which are businesses and consumers. So overall, right now, we still see a strong environment out there. I think that the companies have put out, pretty upbeat guidance for this year. And overall, those trends that we're looking at and, that have been driving the space are likely to sustain. They're not going anywhere. So right now, based on where the valuations are in the space, we think it's a good time to be looking at fintech. And there's a number of companies that, again, are leaders in this space that we think are undervalued at this time.
Jeff, in your note, you talked about 5 themes that will matter most to fintech over the next decade, and one of those was fintech as a service. What do you mean by this, if you could expand a little bit more, and which companies do you think are best positioned to capitalize on that growth dimension?
Sure, absolutely. So when we look at the trends of digitization, modernization, and consolidation, there's 5 companies, really. Bill.com, Block, Flywire, Shopify, and Toast. And what they're doing right now is they're thinking really critically about the businesses that they're serving. And they're realizing that as they're digitizing and as they're helping to modernize them, one of the biggest things that they can do that really adds value right here is help consolidate vendor relationships. And what that means is providing not only payments or not only software, but also value-added services. And so if you look at a Bill.com, for example, what it's done quite well, in our opinion, is focused on software and then built around that. So their small business customers that they're serving oftentimes need not just the software subscription that helps them manage their business, but also a payments piece as well that helps them pay their vendors and help them run their operations more fluidly. Block is a great example as well. Block has built a very strong physical point of sale platform, and then over time they've kind of supplemented that with online services such as Weebly, which is now Square Online, invoices, payroll, and so forth. So those are the types of trends that we think are sustainable. Those are the types of trends that we think will be in demand from businesses as we look out over time. So again, we have a nice entry point right now. We think that these stocks are undervalued, frankly, and as they grow and as they continue to expand with their businesses, that will be what drives the stocks ahead.
Jeff, on Block, let's stay on that name because Jack Dorsey is still leading that company. He's still on the board of Twitter for a little while longer. How concerned are you that this debacle over at Twitter with Elon Musk just diverts a lot of his attention away from what Block is trying to do and impacts their business?
Certainly gets a lot of attention. It's a great question. Our view is, Jack Dorsey is focusing more and more on Block over time, right? And so that's a good thing for Block. I think right now where the company is in a good spot. The Square business, which has been their merchant-facing business, ultimately, is coming out of this pandemic looking stronger than it was before going into the pandemic. We show that in the data that we can see for traffic to squareup.com. We look at that closely. And what we're noticing is it was at a certain level going into the pandemic, and then it bottomed right during the lockdowns of early 2020. And then coming out of the pandemic, that traffic strengthened and it looks much stronger and on a sustainable kind of higher level at this point. So, frankly, with him focusing more time on Block and more time, on that side of the business, it should, help those trends kind of sustain themselves. Cash App, again, is in good shape, frankly. Obviously there's been a big boost from Bitcoin and so forth, but they're also focusing a lot more on monetization away from that, in terms of other value-added services. So we think that there's two tailwinds behind that company right now. And frankly, with Jack, looking more at that side of his, his two tweet, ecosystems between Twitter and Block, it should be a good thing. And then overall, we also think that, as he's doing that, frankly, he'll have more time to focus on Bitcoin, crypto. And so again, we're positive on that, trend as well. So I think that the company should be in good shape going forward.
Another stock you cover in this space is Shopify, and that company announced today it was planning a 10-for-1 stock split, but also approval for a founder share that would give the CEO a 40% voting power. How should investors be thinking about this move?
Well, I mean, typically speaking, just looking across the space, stock splits are retail friendly, right? When we think about Shopify, what we're looking at right now is what type of growth can they get on the other side of this vaccine, right? We had a hyper growth phase for them during the pandemic, and right now they're kind of coming off of that. But overall, the company still looks strong. I think ultimately those are more market dynamics. We tend to focus on the fundamentals, and I think fundamentally the company remains in good shape. What we're seeing again in the data is a number of merchants are coming to the platform even as we come out on the other side of the pandemic. So I think that overall where this company is right now is in good shape. We think they can grow north of 30%. That's revenue this year and next year, which at these levels looks attractive. Again, I think that they're another company that's a leader in the space, and overall we remain positive on fundamentals.
Jeff Cantwell, Wells Fargo Managing Director, with a bullish call on the fintech space. Have a good rest of the week. Joining us now to discuss everything crypto is Krispy Fund's Managing Director and Senior Portfolio Strategist, Jake Hanley. Jake, good to see you here this morning. Crypto, Bitcoin specifically, is well off their highs, but again, a lot of optimism around ETFs. How do you think the rise of Bitcoin ETFs and other crypto ETFs will influence the space moving forward?
Yeah, well, thank you for having me. I think it's going to be a continued story, an exciting story for cryptocurrencies in general, and also for investor participation on regulated exchanges and platforms. We've certainly seen a move with the Gensler head of the SEC towards further regulations. And I think that's adding some comfort in the industry for investors, but also for financial advisors, folks who are fielding phone calls all the time from clients interested to get involved and looking for advice and ways to do so. And so I see this as another step forward on a potentially very long and exciting journey, but certainly one that is everyone's top of mind as far as how to get exposure in regulated markets.
Well, and Brian was mentioning earlier, Krispy had been focused really on agricultural futures funds. Commodity prices overall have really been on the rise this year. So why was crypto and Bitcoin the next move here for your firm?
Yeah, hi, Emily. Thanks for the question. We know futures markets. We are operating in the 33 Act landscape with our agricultural commodity exchange traded products. And that's a different landscape than the traditional 40 Act fund structure. And so there's a little bit of a niche expertise and know-how there. And so being that we understand futures markets and the 33 Act space, we saw this as a way to get involved in, again, an exciting industry.
Jake, should I be blaming Reddit traders for the fact that my wheat bread is not costing me more?
No. Simple answer, no. To give you a reason, there's a multitude of reasons, but the easy one for everyone to understand is that wheat markets are enormous. The wheat futures markets are enormous. And the wheat fund, the ETF, has done well recently. If you look back on March 4th, we had our single largest day where about $184 million came into the fund. And we were in the wheat markets that day purchasing wheat. The May contract, we hold 3 different futures contracts, but the May futures contract that day traded over $2 billion. And we were only buying about $54 million that day. And so on the biggest day in 2 gram wheat ETF history, you could see we were still just a drop in the bucket as far as the wheat futures markets go. Investors looking to get exposure to wheat, corn, soybeans, sugarcane, they do that to participate in futures prices, not influence them. These markets are huge, and so retail investors cannot influence these wheat futures prices.
Well, and as you point out, Russia and Ukraine together comprise about 30% of global wheat exports. These higher prices do reflect these supply and demand imbalances. So on the supply side, are there any levers that could be pulled to make up for some of the supply coming from Russia and Ukraine and, affect a bearish move in the prices of wheat and wheat futures?
Yeah, Emily, that's a fantastic question. And, I'd like to point out that on a global basis, the world's supply to demand inventory levels, are better today than they were 10 years ago. All right. And we were talking about, food shortages. We saw the Arab Spring, which was bread riots and so forth. And so things can get difficult here, but we are in a better position today than we were back in 2011 and 12. That said, you can look to South America right now, Argentina and Brazil. It is very likely that farmers dedicate more acres to wheat there in this crop season and certainly moving forward. And I think that's addressing some of the angst that the global trade has with the fact that we're trying to reroute these trade systems that we've had in place for a long time. And when you're talking about 30% of global wheat trade coming through the Black Sea region, well, so long as that remains volatile, there's going to be some very, very close people are going to want to plant wheat in other places. Let's just put it that way. So I expect to see more wheat acreage in South America.
Well, that is in fact good for the outlook for my wheat bread indeed. All right, we'll leave it there. 2 gram Funds Managing Director and Senior Portfolio Strategist, Jake Hanley. Treasury Secretary Janet Yellen has caught the attention of many in the crypto community. Yellen said in a new talk, the U.S. should, quote, support responsible innovation while managing risks. Let's talk more about this with Jalak Jobanputra, Future Perfect Ventures founder and CEO. Yahoo Finance cryptocurrency reporter David Hollerith is here as well. Good morning to you both. Jalak, I'll start with you. Let's lock in on those comments from Secretary Yellen on managing risks. How might regulation from the government help manage some of the risks in the cryptocurrency community?
Good morning. Thanks for having me here. I view Janet Yellen's comments as overall positive for the sector, and that there's an understanding that the sector is not going away. I've always believed we started Future Perfect Ventures in 2014 when Bitcoin was niche and often considered a negative and the realm of nefarious activity. We've come a long way since then to the point where major regulators around the world are recognizing the positive elements of this technology and how the transparency and efficiency that crypto technologies such as Bitcoin can provide. So always believe that there would be regulation when this sector and the industry grew to the point where there were a lot of users. And so I believe it's a net positive. I mean, there are those in the sector that don't want to see any sort of regulation, but in order for the sector to grow, I think we are going to have to be regulated, and it's important that the regulators understand what this technology is about.
Yeah, Jalik, David Hollerith here. I had sort of more of a venture-focused question, which was, after sort of going to this Bitcoin conference, which was obviously focused on Bitcoin, I've sort of noticed that the VC funding investment for crypto projects is typically higher in other ecosystems than it is for Bitcoin. And I was just sort of curious if you would explain more, or if you maybe if you didn't see that trend.
Hi, David. Great to talk to you. I do believe that historically, so in 2014, there really was only Bitcoin. Ethereum hadn't ICO'd yet, so we didn't have this explosion of other cryptocurrencies when we launched Future Perfect Ventures. And then that changed pretty quickly in 2016 and 2017 with the ICO boom. But what we're starting to see is innovation happening back on Bitcoin. We certainly have seen it play out as a store of value, as a hedge against inflation, as we've seen these expansionary monetary policies around the world over the last couple of years. But at the end of the day, Bitcoin is the most secure blockchain that exists right now. It has not been hacked. And a lot of developers are understanding that and seeing that and wanting to build new solutions for payments, for lending and borrowing on the Bitcoin blockchain. We also have seen a number of NFT platforms, NFT projects that historically, I'd say over the last year, have been based more on Ethereum and to a lesser extent, Solana and Tezos. We're starting to see more being built on the Bitcoin blockchain. And so I think that's positive for that blockchain and the industry as a whole.
Jalik, this is Emily here. What areas of crypto and blockchain are you most excited about investing in as a VC right now?
Hi, Emily. So this goes back to our conversation in the beginning about regulators. And I think one of the things that regulators want to see, and I, as an investor and avid user of cryptocurrency, want to see is security, ease of use. Just like the internet in 1995, 1996, it was clunky. It took sometimes felt like days to download one application or one email. And we're kind of in that phase of crypto now. To buy an NFT, we have to go to MetaMask, we have to buy Ethereum. There's not full security around some of these storage facilities that we have. So we're very interested in investing that picks and shovels of making sure that the next billion people that come online and start using crypto don't worry about losing their crypto and their hard-earned money. And then taking that one step further, I mentioned borrowing and lending on crypto. And once we have crypto as an asset, how can we leverage that and use it in ways beyond just spending it, which fosters or enables taxation. Can we use it as an asset like we can a home? And so I think we're in the very, very beginning stages of what all of this innovation and these applications are going to be. And so we have two funds behind us, invested in a lot of the infrastructure that enabled a lot of this. But this next stage is how do we bring this to the billions of people that don't currently have access to any cryptocurrency?
Jalak, lastly, crypto has long had a diversity problem. I think back to a couple years ago, a lot of these crypto conferences, you would see photos of men driving up in G-Wagons and Lamborghinis. Have you started to see increased diversity in the space?
Absolutely. And we saw this in the early days of the internet too. Once you start to see a broader range of applications, you start to see more people getting engaged and interested in the sector. So, I remember my first Bitcoin conference in 2013. I was the only woman in the room. That rarely happens these days. I mean, it still happens in some board meetings, but we're seeing more and more engagement. I mean, we have a long way to go. If you think about finance, historically hasn't had a lot of women, and really the genesis of Bitcoin and crypto comes from the finance world. So we have that working against us. But as we see more proliferation of applications into media and healthcare and other sectors, I'm seeing more women start to get engaged. And I'd like to see more female investors also. We were the first female founded venture capital fund, one of the first venture capital funds in the space. And that's certainly starting to change. And that's fantastic to see.
Indeed it is. All right, we'll leave it here for now. Jalak Jobin-Putra, Future Perfect Ventures founder and CEO, and Yahoo Finance's David Hollerith. Thanks both.
Let's bring in Brian Deese. He's White House Director of the National Economic Council. And Brian, good to talk to you today. We know the president is expected in Iowa tomorrow to talk about the actions the administration has taken to try and curb these food prices or global prices that have gone up. What's the message as Americans brace for yet another rough report come tomorrow?
Well, we certainly expect tomorrow's report to be elevated, and it will be where we see the impact of Putin's invasion in Ukraine. We know, and we have been tracking, that invasion has created a global supply shock in energy and food and other commodity markets, and that impact is being felt and played out over the course of March. So we expect to see that in the numbers tomorrow, and our message is pretty clear. The president is going to do everything in his power to try to provide some relief on those prices. And the actions the president is taking are already having some real impact. He announced the historic release of oil from U.S. strategic reserves and then brought the world together around a coordinated release from oil-consuming nations. We've seen the price of oil come down 10 to 15% since those announcements. The president will be in Iowa tomorrow talking about additional actions we can take. But this war has consequences, and Putin's price hike is being felt at the gas station. That will be reflected in tomorrow's numbers.
Hey, Brian, fellow Brian here. I want to ask just kind of about the aggregate picture here, though, because, the inflationary story was happening in the United States prior to the Russia-Ukraine conflict. So even though that's likely to exacerbate the prices that we'll see reflected tomorrow, Americans are still trying to figure out how much of the macro picture from the stimulus from both the Fed and Congress contributed to the price increases that we're seeing. So how's the messaging going to be delivered with regards to that overall picture and kind of maybe how other types of macro policies play into it?
Well, look, prices are elevated here in the U.S. They're elevated all around the world because we are in a globally supply-constrained economy, and we're now dealing with the added shock to the supply side that have come from the war in Ukraine. We're seeing elevated inflation across the euro area, some of the highest numbers ever recorded there. I think what's important as we look at the question you're asking about the American economy is to recognize that we are well positioned to address this challenge from a position of relative economic strength, and that is because of the strength of our economic growth and our labor market recovery. So we're seeing some of the strongest growth anywhere in the world. We're seeing the strongest labor market recovery anywhere. Those are really powerful attributes that we have going into this challenge to try to come out on the other side. But at the end of the day, prices are too high, and American families are feeling that, and so we need to take every action we can to try to make things more affordable, provide some relief as the Fed acts the way that we anticipate it will on the monetary policy side. What we can do on the fiscal policy side is try to make things more affordable and gives people some relief here in the interim period.
Brian, let's talk about oil, because you did just allude to that record release from the Strategic Petroleum Reserves. This is, of course, not the first time he's tapped into SPR. And we have seen in the past that there has been temporary relief, but those lower prices have not necessarily been sustained. What does the White House see as the next necessary step to try and bring prices down for a more sustained period? Over in Congress, we've heard everything from a gas tax holiday to a windfall tax being floated around among Democrats. Is the White House supportive of any of those policies?
Well, this release from the Strategic Petroleum Reserve was truly unique in a couple of respects. The first was in the magnitude. 1 million barrels a day. That was a commitment from our administration to put 1 million barrels a day onto the market to try to address this supply shortage that we have because of Russian oil coming off the market, coupled with an effort by the International Energy Agency countries to put another 60 million barrels a day, or close to another 1 million barrels a day on the market. So that's between 1 and 2 million barrels a day going onto the market to try to address that. The second is duration. The president said this is going to sustain for 6 months, which acts as a bridge. We know U.S. producers are bringing production back online. We know that they will be up by about 1 million barrels a day by the fall. So this Strategic Petroleum Reserve release acts as a bridge. It's unique in both those respects. We haven't used the Strategic Petroleum Reserve in that way previously in our history, and I think that is why it's important and significant. In terms of additional measures, we're looking at everything. The president will be talking about some of those measures tomorrow in Iowa. We're not taking anything off the table when it comes to helping American families, but I would note that we're seeing the impact of those reserve releases in the market now, and we're going to continue to look at anything that we can do responsibly to try to build on that.
We have certainly seen the supply constraints exacerbated among semiconductors as well, in part because what's happening with Ukraine and Russia. But this is an issue that happened well beyond that. And we've heard the president increasingly frame this as a national security issue, trying to make sure that more of that production, the manufacturing, happens back home here. And yet we're talking about a 3-year, 5-year, 10-year timeline. What's the thinking at the White House about how you address this issue in the meantime?
Well, it's a great question, but I would say this. The sooner we get started, the quicker we will have economic and national security on our side. Look, this is a national security issue. We've gone from producing roughly 40% of the global semiconductors to 12%, but importantly, the share of the advanced leading edge semiconductors that we produce in the United States is zero. Zero today. We're entirely reliant on foreign producers for those leading edge chips. We have to change that equation. You're right. The only way to change that equation is to build capability in the United States. And that is going to take some time. But we would have been better off if we started that last year, and we'll be better off if we start now rather than waiting months and months into the future. We have a bill in front of Congress. We saw some really important progress at the end of last week with both the House and the Senate appointing conferees to get together to try to hash out that final bill. But the message the president will be underscoring is both for our economic and our national security. We got to resolve those differences, get that bill to his desk. The sooner that happens, the sooner we can start to build that strength back in our own semiconductor capability.
And then, Brian, lastly, I want to ask about some of the news that was made this morning from the White House regarding Vice President Harris's efforts to try to address medical debt and the burden that that imposes on Americans. Now, can you walk our viewers through exactly what that means? It's understood that it's going to relieve some of the reporting of how that medical debt affects credit scores for the ability of Americans to take on further debt, but it's not full-on forgiveness, is it?
No, I will be over with the Vice President later this afternoon. We're really excited about this announcement. Look, medical debt affects a broad swath of Americans. About 1 in 3 Americans has medical debt. But medical debt is not like other forms of debt. In almost all cases, most cases, you don't choose to take it on. It happens when you have a health event happen in your life. And medical debt is not a very good predictor of future credit quality as well. So we're going to take a couple of actions today. The first is to review comprehensively all of our credit programs to help make it easier if you're looking to get a mortgage from the FHA or the VA or USDA. Not having the medical debt that you might have be a barrier to you getting access to that mortgage. Likewise, if you're looking to get a small business loan from the SBA, the Small Business Administration, not having medical debt be a barrier for you to do that. And also, crucially, the VA, the Veterans Administration, will announce new steps to make sure that low-income veterans who are currently eligible to actually have their medical debt written off and forgiven can actually take advantage of that. Today, many low-income veterans are eligible for that relief, but they can't get it because the process is too complicated. We're going to simplify that to make sure that those veterans get the relief they deserve.
Brian Dees, Director of the White House National Economic Council. Thanks so much for stopping by Yahoo Finance this morning. Appreciate it.
Let's bring in Helene Becker. She's Cowen's Senior Research Analyst. And Helene, I have to say, I was looking for a flight over the weekend and was really surprised how much more it costs than where things were just a few months ago. When you listen to these capacity cuts that are going into effect because of a number of shortages, what does that ultimately mean from a cost perspective?
Well, thanks for the question. Costs are going up and fares are going up. That's the bottom line. Not only are jet fuel costs going up, New York Harbor is over $7 a gallon, and it's the highest in the country. Everywhere else in the country, it's about $3.50 a gallon. And obviously, or maybe not so obvious, but JetBlue gets a significant percentage of its jet fuel in this market. 80% of their flights or thereabouts touch New York and Boston. So they're here, they're being affected, specifically them. But we also have an issue with pilots and not only pilots, but an overall labor shortage. Almost any airline not named American, Delta, or United is losing pilots. And the attrition rate that we've heard ranges from a low of high single digits to as much as 25% for some of the smallest airlines. And that is putting pressure on route networks, and it's causing airlines to have to cut back in order to deliver a reliable product to the consumer.
Helene, it's Brian Chung here. So having said that, it sounds like the outlook is not going to improve anytime soon on the availability of cheaper fares, but also avoiding a cancellation of your flight. So when do these pressures alleviate, in your view?
Well, thanks for the question, Brian. So here's what we're hoping. We're hoping that the schedule reductions will enable the industry to deliver a product that's reliable. The summer months are always difficult because of pop-up thunderstorms, and that's what hurts schedule reliability more than almost anything else. And then second to that, I guess I'll put different variants of the coronavirus that cause not only us to get sick, but crew members to get sick, and that causes some unreliability. But our thought is that on the labor side itself, especially with respect to pilots, we are in a multi-year shortage of pilots for now, and we think it's going to last to the end of at least till the middle or end of this decade. We just don't have enough to replace those retiring. We estimate that between the passenger airlines and the freight airlines, including FedEx, UPS, Amazon Air, we probably need to hire between 7,000 and 8,000 pilots a year for at least the next 4 to 5 years. And there aren't that many people who are qualified to be a commercial airline pilot. And so this shortage of pilots is going to last for a long time, and it's a limitation on growth. And then the other issue, I'm sorry, go ahead.
Well, what's the other issue?
Oh, the other issue is capacity availability, getting aircraft. Boeing is behind deliveries on 787s. They've had issues with the 737 MAX. And then you have the Airbus A320neos that are behind schedule on deliveries too. So not only do you have a shortage of labor, but you have a shortage of aircraft as well.
So Helene, really quickly, we're talking about this just a few months out from one of the busiest travel months of the year. We've heard so much about Americans wanting to go out and travel again because of what's played out over the last few years. What does it ultimately mean for those travel plans if we're hearing about airlines cutting back on capacity months before that?
Well, two things. The first issue is going to be rising airfares. We think airfares are going up on average about 7% a month for the next 3 or 4 months. And then, of course, on the other side is the consumer, with not only airfares going up, but everything is going up. We have this huge inflationary problem in the United States right now with gasoline at the pump going up, with their food inflation and so on, rent and so on. We're really worried about demand destruction as we get through the summer. So maybe July and August will have a really good summer. And then we'll start to see that impact, the higher fares impact demand as we go into the fall.
All right, Helene Becker, Cowen Senior Research Analyst, thanks so much for the outlook. We'll be hunting for hopefully cheaper fares soon. Thanks so much.
time for KC3. That is, of course, Yahoo Finance contributor Kevin Cirilli joining us every week on Monday to discuss the 3 things to watch in DC. And Kevin, we just were talking to Brian Deese earlier in the show about this semiconductor bill. This is, of course, one that has put aside billions of dollars in subsidies to manufacture back home. A crucial week this week. What are we expecting?
It really is. So just before lawmakers headed out for recess, they announced the conference committee. There's more than 80 members that are going to be on the conference committee. In the Senate, it's split evenly amongst Republicans and Democrats. But in the House of Representatives, obviously controlled by the Democrats, there are significantly more Dems than ours on the conference committee. But this has significant implications geopolitically. I thought you heard that in your previous segment. The Senate version of this bill has $52 billion for semiconductor chip research, $45 billion to strengthen supply chains, and $160 billion for research and innovation. Now, the White House had said just last week that if you look at last calendar year, the semiconductor chip shortage actually shrunk GDP by 1%. And it's really tied up not only in US-China relations, obviously Taiwan playing such a crucial part in the semiconductor chip manufacturing chain, but also in US-Russia geopolitical risk and tensions. In fact, Commerce Secretary Gina Raimondo had said just the other week that should China rather provide semiconductor chip software and innovation to the Russians, going against some of the sanctions and restrictions that have been in place, that the US was prepared to send a signal to China. So a lot of maneuvering around this semiconductor chip issue. But, look, Republicans and Democrats view this as a key tenet of bipartisanship, and quite honestly, probably the last major bipartisan bill that could get to President Biden's desk before the midterm elections.
Kevin, it's Brian. I want to shift gears over to the digital dollar. We know that there's been some conversations down in D.C. among Federal Reserve officials as well about the possibility of a digital greenback. What are you hearing in terms of movement on that front? Because the Fed's made it kind of clear they would want Congress to sign off on that before they actually get going on doing such a thing.
It really feels like they're just researching right now, but there's a lot of talk up on Capitol Hill amongst Republicans and Democrats about the best way to go about this. I think that lawmakers, candidly, have been a little bit slow in order to get into the digital currency space. I was struck by the comments that Treasury Secretary Janet Yellen made at American University last week, in which she said, if we can pull up that quote, she had said that this is going to be something that they are going to be looking into. She said, quote, "I can't tell you yet what conclusions we will reach, but we must be clear that issuing a CBDC would likely present a major design and engineering challenge that would require years of development, not months." So she's putting the timetable as years, but definitely a huge step that the Treasury Department's looking into it. A lot of folks feel in the geopolitical space that China has just been out front of this from the ahead of the United States.
Kevin, we can't let you go without talking about your home state. What's playing out there? The midterm elections, obviously, we're looking ahead, but Dr. Oz trying to fill the seat that will be left by the retirement of current Senator Pat Toomey. Where do we start?
Where do we start? Well, let's start with the latest, which is that former President Trump has endorsed Dr. Mehmet Oz for the primary, which is next month in Pennsylvania. And then he's going against Dave McCormick. Now, Dave McCormick, his wife is the former Deputy National Security Advisor in the Trump administration, Dina Powell, also a longtime Goldman Sachs executive. And if this isn't further evidence that this Pennsylvania Republican primary race is going to be a key test of just how strong a Trump endorsement is or is not, many top staffers from the previous administration, including Hope Hicks, are actually working for Dave McCormick on this Republican primary. So Pennsylvania is a fascinating state. I'm not just biased in saying that, because it's one of 2 states that President Biden picked up in 2020 that Republicans still hold on for. So if Republicans want to extend gains in the Senate, Pennsylvania is one that they would hope to win. But wow, Dr. Oz getting that Trump endorsement and really pouring a lot of political gasoline on the Pennsylvania Republican primary race.
And that is, of course, Delco that's behind you, right? Although not to scale, because Delco's not as big as the whole country of Italy, I don't believe.
No, I appreciate that, but I will say that I'm actually going there the second half of this week for Easter, and I cannot wait to have some Rita's water ice and to have some Wawa coffee and to just really, yeah.
Water, there it is. Kevin Cirilli, Yahoo Finance contributor. Thanks so much. We'll talk again soon.
Joining us now is Nicole Bachot, who is the Zillow economist joining us here today. Nicole, great to have you here. I'd love to get some of your insights, particularly around the housing market and where buyers have the best opportunity to get homes right now.
Yeah, so we're seeing intense competition continuing throughout this spring in much of the country. Really we're seeing, a lot of folks shifting towards, more affordable homes, especially as interest rates are going up. We're likely going to see a lot of competition around those starter home prices as, it offers a little bit more affordable options for people now that rates are so high. We're going to continue to see demand really accelerating throughout much of the Sun Belt. That's been the hot market for most of the last 2 years. A lot of our coastal expensive metros have, not been able to keep up at quite such high, year-over-year appreciation levels, but still those markets are a lot more expensive. So there's not really very many opportunities for, super cheap markets that the buyers are going to be able to get into. We're seeing a lot of competition everywhere.
This is typically one of the biggest and long-term investments that people, households, families can get into on the real estate front. And so with that in mind, with high prices perhaps barring some people from being able to execute on those purchase plans, how much more of an economic impact does that create longer term?
Yeah, absolutely. We're going to see a lot of people maybe taking a step back from the for sale market as rates are rising right now and staying in the rental market for longer. That's going to continue to push rental rates up. Nationally, rents are up over 17% year over year, which is a really large number for, when you're going to re-sign your lease. That's hundreds of dollars a month that a lot of people are now having to fork over in addition to their existing rent payments. That's going to take a big bite out of people's budgets as they're, maybe trying to save up for a down payment in the future. We're going to continue to see rent prices going up as demand for that rental market stays elevated, particularly single family and larger rentals. We're going to see a lot of demand in those areas as well. So this is going to put renters in a really challenging position to be able to try and save up to afford housing while they're facing these really high rental rates.
Just for the added context of this conversation, perhaps you can compare and contrast the difference that we're seeing right now in existing homes that are on the market for sale versus some of the new homes that are struggling to get the necessary, not just inventory online, but the parts necessary to actually build out the homes as well as part of the supply chain headwinds that they've been facing.
Absolutely. New construction was down for, over a decade following the Great Recession, which really led to the big inventory drop that we've been seeing in recent years. Builders have started to really ramp up and are trying, at their best rates to really meet the demand that we're seeing. But as you mentioned, supply chain shortages are really disrupting their ability to get those homes onto the market. Even a couple of months delay for the typical new construction home, it is months later in the market that those homes are finally, reaching the buyers that need them. At the same time, existing homeowners have been really unwilling to sell throughout much of the pandemic. A lot of uncertainty of their next housing choices, their long-term work from home guidance, or what that looks like. And so we're going to continue to see inventory, taking a big hit. Hopefully, as we move into the spring, we'll likely see, March inventory numbers coming back up, both in terms of new construction and existing homes coming onto the market. And so that will help to, help later on this year to help soften those price growth.
We've heard about new ways of building homes, everything from 3D printed homes all the way to, and our colleague Rochelle had introduced us to Boxable, which hopefully we'll be able to get on the program in some future days. But when we think about the new ways that homes can come to fruition, to really eliminate some of those supply chain headaches, does this kind of create that next inflection point for the new types of homes, especially on the low income side, that we're seeing able to be created and that much more quickly and added to the market?
Absolutely. Previous surveys that we've done of experts in this field have shown that, adding more inventory is really the best and fastest way to help to reduce the price growth that we're seeing and really create affordable opportunities for people. Whether that comes through relaxing zoning regulations, which would be more on the policy side, or technological advancements, that's really going to be a key thing to watch as we're looking forward in the coming years for the market to return to, whatever the level of normalcy is going to look like then. Inventory is really going to be the key player.
It's been such a pleasure to have this conversation with you, Nicole. Would love to have you back to continue the conversation, especially at this a very important time for the housing and home sector as well. Nicole Bouchot, who is the Zillow economist, joining us here today. Appreciate it. An old set of irons that Tiger Woods used, they sold for over $5 million at Golden Age Auctions. Ryan Carey is the Golden Age Auctions owner, and he joins us now. Ryan, thanks for taking the time here with us today. First and foremost, walk us through the verification process for the club's reportedly incorporated incorporated image matching. This process did, and then a lie detector test as well. What other authentication measures are implemented for an auction listing of this price and historical significance?
Yeah, we had to really dig deep on this one. This is not the level they usually have to go through, but we knew how historic these items are. We knew it's set for record price. We didn't know it go for $5 million, but yes, back in 2010, the first time these were sold, the owner of them passed a polygraph test. He was Tiger's right-hand man. He's the one that worked on Tiger's clubs. He delivered them to Tiger, a new set, and Tiger gave him this set. So we really wanted to button up that chain of custody there. And then the kicker really was the photo matching. During this auction, we spent hours and hours and hours on Getty Images, on Google, just trying to find, what images we could find that matched these with Tiger, and we were successful. We didn't know we would be, but we could match up rust stains from the photos of Tiger playing these events to the actual clubs we were selling. So it was a special moment for golf, and that's why we broke the record price.
An iconic set of clubs that he won his first majors with. But what do you make of this controversy that Tiger has said, nope, those clubs are in my garage?
Well, the good thing was Tiger said that back in 2010. Right. Photo matching has come a long way. Imagery and the internet's come a long way. So I understand what Tiger's saying. We have them matched photo-wise directly in Tiger's hands during the 2001 Masters and other events. So if there was any doubt, we were able to solve that. And that's when we saw the bidding just take off, when we made that happen.
Okay, and so when we think about how we can perhaps avert any confusion in the future, there's been a ton of conversation around where non-fungible tokens, even for sports memorabilia that is one of a kind, where that can, in the authentication process and the validation process, provide a way forward from here.
Yeah, you're spot on with that. That would be huge, where you could track these items for the rest of history. There's very few pieces of memorabilia that you can be relatively certain will still be collected 100 years from now. And I believe these clubs are one of those. As long as the game of golf is being played, someone will want Tiger Woods' irons from 2000, 2001. So if you could have some blockchain technology tied to these so that chain of ownership can now be tracked for the next century, that would be amazing.
Yeah, I imagine some would like to get their hands on the last set that he won the Masters with in 2019. Now, the prior record for golf memorabilia was surprisingly less than $700,000. So this didn't just break a record, it smashed it. What is the golf memorabilia market? Is it growing, or is this just kind of a one-off given Tiger Woods and where he is in terms of being an icon globally?
Yeah, so I think we caught this perfect storm where the rest of memorabilia and collecting has just taken off. COVID made, I don't care if it's cars or comic books or baseball cards, they've all skyrocketed. Golf was probably undervalued already. And then when that happened, we've been lagging behind. So everyone has all of a sudden been talking about golf's undervalued, golf's undervalued, golf's undervalued. And then with Tiger Woods coming back, Tiger Woods also, he's cemented his legacy. His history is complete, and people are realizing they like to collect the GOATs. They like collecting Mantle and Ruth. They like collecting Brady and Michael Jordan. Wait a minute, what about Tiger Woods? So the big collectors don't have an exposure to Tiger Woods memorabilia, and all of a sudden we come along with the best set of modern golf memorabilia in existence.
I imagine there's not a ton of demand for my Steve Stricker signed flag then, but perhaps I'm still a big fan of his. Anyway, thinking as we move forward from here, the fact that you don't have Tiger signing a ton of autographs now for the future of the game to create even more demand within the golf memorabilia as part of the broader sports memorabilia landscape, what kind of partnership does that require? It's one thing to have clubs of this stature, but it's another thing if you don't necessarily have players that are interested in getting into that sports memorabilia landscape.
Well, see, the other leagues are doing a better job. Major League Baseball does a phenomenal job. The NFL does a very good job. Golf, the PGA Tours lag behind there because there are a lot of kids out there that would love to own an item from Justin Thomas, Morikawa, Scotty Scheffler now bursting onto the scene. And so there's no great way to do that right now. And that's, I think, what's next is that the PGA Tour and the golf collecting industry will really rally behind the players so that, kids these days and adults can own a piece of the people they watch on TV every week.
And it was a remarkable weekend for Tiger Woods. Maybe someday we'll see those clubs hit the market because that 46-year-old just opened a few eyes. It was remarkable. Ryan Carey from Golden Age Auctions. Appreciate you, sir. Thank you.
In this episode of Influencers, venture capitalist and domain money CEO, Adam Dell.
You can invest today in the banking system of tomorrow. And that's a very exciting investment opportunity for retail investors. If you are solving a fundamental problem with a technology solution that appeals to the end customer, that's a pretty good formula. I've been very fortunate to have a front row seat to one of the great entrepreneurial success stories in our country's history, and couldn't be more proud of my brother and what he's done.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Adam Dell, venture capitalist and the founder and CEO of a new trading platform, Domain Money. Adam, great to see you.
Good to see you, Andy. Thanks for having me.
I want to ask you all about Domain Money, but first of all, I've got to ask you about the crazy markets this year, both in crypto and in equities. What the heck is going on?
Well, market volatility is one of the things that is inherent in our market, right? Whenever you have such a large inflow of capital into a discrete number of assets, you're going to have significant swings. As Warren Buffett likes to say, the market is a voting machine in the short term and a weighing machine in the long term. And as I look at the long-term trends, some of the free cash flow sources that are being spit out of some of the larger tech names, I'm quite bullish on their prospects going forward. And as it relates to cryptocurrencies, where we're focused, I look at the fundamental underlying components of blockchain technologies and their contribution to our financial markets, less from a speculative standpoint and more from a core market function, a core financial function. If you look at, say for example, Visa. Visa moved about $10 trillion worth of transaction volume around the planet last year. Last year, Ethereum alone moved 11 trillion. And so that just gives you a sense of the scale of the impact of these technologies and what impact they will have on our broader economy. I'll give you another example. Money markets. A few years ago, the number of dollars involved in DeFi money market protocols was less than $1 billion. That's a 2018 stat. This year, it's over 200 billion. And so the growth of the financial utility of these underlying technologies is undeniable. And as they become more widely adopted in commercial use cases, again, unrelated to speculation, I think you're going to see a significant growth in real revenue and real cash flow coming out of these technologies.
Yeah, I hear you, and I want to ask you more about those technologies, but just sort of again back to the macro environment, because say, first of all, with the tech stocks, they've just been such winners in so many ways in our economy, but the driver here right now is higher interest rates. Does that concern you?
Well, I mean, interest rates have been so low for so long that there's a whole generation of investors out there and market analysts who believe that this is the norm. And obviously, on a historical basis, interest rates don't stay this low. And so I think, given the true cost of capital and the fiscal responsibility that is incumbent upon responsible central banks to employ, interest rates inevitably need to go up over the long term.
And with regard to cryptocurrencies, blockchain aside, people are talking about Bitcoin, and they've sort of positioned it, Bitcoin and Ethereum, other cryptocurrencies, as either a hedge or not correlated to equities. But right now, it looks like those currencies are correlated to equities. What's your take on that?
Yeah, I think that is a reflection of the maturity that the crypto markets are going through. These assets are now more broadly held across a larger institutional base. They're now held across a larger retail base. And so downward pressure in the macro market invariably will impact crypto as well.
All right, let's switch over to Domain Money. Your new company, is it pretty new? And what is it? How old is it?
So we launched today.
Oh, it's new.
January 25th. So we have thousands of customers on the platform today. It is a robust, sophisticated investment solution for both stocks and crypto. We provide a number of differentiated features that we think distinguish us in the market. Chief among them is our signal product, which goes really deep down the data rabbit hole around the underlying fundamentals associated with these crypto assets. I'll give you a few examples. We analyze the Twitter fire hose as well as other social channels, and we provide a proprietary social sentiment score where we basically provide positive, neutral, negative ratings on the social sentiment of underlying assets. Another thing we do is we track the flow of funds on exchanges, so tracking the on-chain and off-chain activity of underlying crypto assets, which is indicative of sentiment and price volatility. A third thing we do is we track project health. We look at the overall quality of the management team, the number of GitHub submissions, and we present all of these insights to retail investors in a very consumable and easy to understand way. So those are some of the things that we are doing at Domain that are unique.
What about the timing of this all, Adam? I mean, with the Fed, probably raising rates a number of times this year, we were in this incredible bull market, particularly during COVID, where there was all those stimulus checks coming into people's pockets, and then they were going out to broker dealers and spending it. Are you heading into sort of a wind coming in your face?
Yeah, well, I mean, short-term market swings are not really the thing that we pay a lot of attention to. We spend much more of our focus on the long-term trajectory of these assets. And as I mentioned, there are some incredibly powerful forces that are driving real cash flow out of a number of the investment projects, the investment classes that we're looking at, particularly as it relates to DeFi protocols. And so we're very encouraged by the underlying trends that we see. A lot of people look at the price of Bitcoin or the price of any given crypto asset over the last couple of weeks and say, gee, this doesn't look really good. I look at something very different, which is that, a couple of years ago, there was virtually no transaction volume moving around the world to empower NFT transactions. Last year, it was 23 billion, okay? A few years ago, less than $1 billion in DeFi volume. Last year, 200 billion. 11 trillion in transaction volume on Ethereum. These are profound trends that are not going away just because of the short-term volatility in the financial markets.
And speaking of those profound trends, Adam, and you mentioned you worked at Goldman, you mentioned Visa. What is your take on these legacy institutions? Are they going to get consumed by these trends? Or are they going to co-opt them? Everyone always talk, oh, Visa and MasterCard are dead because of electronic payments. And of course, they benefited like crazy. But now there are questions about those companies, for instance.
Yeah. Well, we've been honored that we were selected by MasterCard to be part of their Smart Path program. What I've seen from the Visa and the MasterCards of the world is that they've really wrapped their tentacles around anything and everything related to blockchain technologies, because they, like many smart investors, see the opportunity set and what it can mean for improving the efficiency of our banking plumbing. The bigger story, though, is what these technologies will do to allow consumers to both borrow and lend on their assets. That game is going to change profoundly because of blockchains, and represents for consumers a real opportunity to make real yield on their assets or borrow at a much more market-driven rate rather than one available from their credit card or from their personal loan provider.
Wait, explain to us how that would work, Adam.
Well, if you look on a number of the DeFi marketplaces where you can borrow and lend, you see rates that are much lower than what you would get from a credit card or from a personal loan provider out there in the market.
But aren't those companies just trying to garner market share? Isn't that a money-losing proposition? Or is the margin on crypto so much lower so that it is still profitable?
Well, it's a true marketplace where rates are a function of what someone's willing to pay, rather than, a fair bit of regulatory constraints and controls that prevent true market rates from being accessible to anyone. The average consumer can't access a money market in the same way that an institutional investor can. And crypto represents an opportunity for those markets to be opened up to anyone.
That was the metaphor I was looking for. That's great. Okay. And speaking of regulation, though, you provided me with a nice segue. The Biden administration is reportedly preparing, I should say, an executive order for release coming up soon that will outline a comprehensive government strategy on crypto. Is it a good idea for the White House to get directly involved here?
Well, we welcome and invite regulation into this industry because it's an important step in its maturity. I point people to the fact that China's efforts to try to clamp down on this activity had virtually no impact on the overall value of the market or trading activity, for that matter. And it just shows you that information wants to be free and markets want to be free. And so I think it's incumbent upon the United States as a leader in financial systems and in financial markets to think through the policy decisions around what is a stable digital currency, how do we bring this nascent market into mainstream financial functions, while at the same time protecting investors from the things that are scary and may not be as above board about this industry. And obviously, in any new industry, those players emerge. Andy, you and I remember the early .com period where there were hundreds of companies, many going public without a clear business model or any line of sight to positive cash flow. And yet, despite all of that noise, an enormously valuable set of companies emerged that redefined the very fabric of our economy. And the same dynamic will exist with blockchains and crypto. We're in the middle of a Cambrian explosion of diverse projects and initiatives that are being tackled by engineers using these technologies, and some subset of those will become the very building blocks of the next generation of our banking system.
Would regulation impact domain money?
We've worked hard to ensure that we are following the letter of the law as it relates to regulation, because we want to represent this industry as it matures, rather than being part of the fringes of the Wild West of the industry.
Right. My understanding, Adam, is that you said, quote, the notion that individuals are rational actors is a false one. They are emotional animals and they make financial decisions based on emotion. So is that true? Okay, good. Glad we got that right. Do trading platforms like yours, though, then have an obligation to protect users from themselves?
Well, I believe it's our obligation to inform the consumer and provide them with as much information as we can to educate them about making rational investment choices. We really stress on our platform education, transparency, and time-tested investment strategies. So we talk a lot about dollar cost averaging. We talk a lot about portfolio theory. We talk a lot about market fundamentals. What is the market size of this technology? What is the product market fit? What is the management team? What is the business model? And what is the viability of that business model over time? Rather than things that are meme and momentum driven. And so while I can't protect individuals from making bad decisions, I can help inform them. And so our goal is to achieve that for investors.
I want to ask you about wealth inequality and financial services, because of course the wealthiest Americans still own the vast majority of equities. And it's probably true about crypto, although I'm not really informed. I'm just guessing. Maybe you know the answer to that as well. How do we address that? Is that anything that concerns you, Adam?
Well, the most interesting opportunity for blockchain technologies is opening up of markets to a broader set of our members of society that don't have fair access to a financial relationship that allows them to live their lives. Borrowing money, earning interest on deposits, those core components of our financial system are available to people who have bank accounts, who have credit scores. And blockchains operate differently. They don't require there to be trust between the two parties to a transaction. And so they, as I mentioned earlier, represent an opportunity to open up those markets to a broader segment of our society and to make available to individuals who have fewer dollars a fairer interest rate, a real yield on their savings, which they might not otherwise have access to. I mean, if you're a merchant in Taiwan and you have savings, how do you get yield on those savings? If you're a doctor in Nebraska and you have savings in your bank account, they're paying you 0.06%. That's not a market rate in terms of interest on your money. And blockchains represent an opportunity to open those up to fair market rates and real market rates for each one of those individuals.
Does that mean bad things for the legacy banks?
I believe that the legacy banks are smart enough to acquire and partner and evolve their business models over time to embrace the changing nature of how financial entities make money. If you look at banking over the last 10, 15 years, it's very clear what's happened with the introduction of Dodd-Frank and other regulation. Interest rate competition has been introduced into the market. And so the revenue that banks have made from interest has basically been cut in half. In response, what they've done is they've basically doubled their fees. And so they nickel and dime the consumer on these little things that nobody pays attention to, but add up over time. Eventually, that game is going to run out and true market rates. What can you borrow for at what rate? What can you earn on your deposits at what rate? Those will be made available to consumers without the required on-ramp associated with establishing a bank account.
Right.
You will be able to access those rates through DeFi protocols powered by blockchain technology.
As we wrap things up here, I got to ask you some personal questions. And of course, that means I got to ask you about Michael, your older brother, Michael Dell, CEO of Dell. What was it like growing up with Michael? And what about it do you think contributed to the success of both of you guys, your household?
Well, my mom used to like to say that she had 3 boys and she left out food for 2. Michael was always a young man in a hurry. He was always tinkering with something, doing something, working on something, and he was pretty good at figuring things out. And so, I've been very fortunate to have a front row seat to one of the great entrepreneurial success stories in our country's history, and couldn't be, more proud of my brother and what he's done.
Right. Okay. And so, are you still working with him? I mean, you're in touch with him. You guys talk. What's your relationship like today?
We talk a lot, and I just saw him, and he's doing well and working hard and enjoying his role as the CEO of Dell.
Yeah, and it's just watching that kind of come and not go, but it sort of had these different chapters, I guess is how you characterize it, right?
Yep.
All right, and so you've now founded a bunch of successful companies yourself, Adam, and you've sold some to different entities. What have you learned, and what are some mistakes you've made? What are some things you've learned along the way?
Yeah. Well, one is that if you are solving a fundamental problem with a technology solution that appeals to the end customer, that's a pretty good formula. And so I've tried to focus on finding market problems and solving them with technology. The second, and this won't be any deep insight, but it's all about the team and the quality of the people around the table trying to solve the problem you're trying to solve. And so I really focus on that. I'm very proud of the team we've put together at Domain Money. About 25 of my former colleagues from Goldman Sachs chose to join me in this new adventure. And in addition to those folks, we've hired Brad Olson, who is the head of content for Seeking Alpha, the head of trade ops from Cantor Fitzgerald. We hired a COO who ran the crypto business for SoFi. We've established a really solid team that is very focused on our mission, which is to build our customers' wealth.
You have a metaverse part of it, or no?
Well, we will bring additional assets onto the platform over time. I think you'll see us getting into the NFT space sooner rather than later. And so customers can look forward to that in the coming months.
All right, let me know when you get the metaverse thing down.
Okay, I'll let you know.
Headset and go into Domain Money. Final question, Adam. How do you see using your influence on this world?
Well, I don't know how much influence I have other than I like building things. I like catalyzing teams around specific objectives and goals and trying to motivate and set direction there. It is very fun for me to build things. I genuinely enjoy it. I get a real rush out of creating something and then having people use it. And so I'm very focused on making sure that we deliver the best investment platform experience in the market. I remember when Goldman was working on the Apple Card, and there was chatter among the industry and even within the halls of Goldman Sachs. What does the world need another credit card for? And if you've ever used the Apple Card, it's really a delightful, unique experience. And I think the same opportunity exists in investment platforms where there are real improvements that can be made in the customer experience, the customer support, the education process, the journey that we take customers down as we help them try to make better investment decisions. And so I'm very focused on that as well as the rest of the team.
Adam Dell, VC and founder and CEO of Domain Money. Thanks so much for your time.
Andy, thanks for having me.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Welcome back to Yahoo Finance Live. I'm Emily McCormick here with Brian Sozzi. Julie Hyman will be back later this week. The market's been open about 30 minutes now today, and stocks are trading higher after this morning's red-hot CPI inflation report. And here are three other things we're keeping on our radar. Spacs are sputtering. After a blowout year for Spacs in 2021, blank check company deals this year have fallen to the lowest level since 2020. More on the Spac drought in a bit. Plus, sales up, earnings down. That was the takeaway from Conagra's latest full-year guidance, as demand at the food giant stays elevated, but inflation weighs on profits. We'll have more with Conagra CEO Sean Connolly later this hour. And for the same price as a gallon of gas, you can get your hands on a dozen Krispy Kreme donuts. We've got more on the company's new pricing strategy coming up. But we start this hour first with more on the market action. And for that, let's head over to the Yahoo Finance Interactive board for a deeper dive. As we can see here on the board, we're really seeing a rally in some of the technology stocks that had been hit during yesterday's session. Really a rebound here, especially in those mega cap FANG names. I want to zero in on some of the dark green that we're seeing on the screen in Tesla, for example, up about 4.5%. Although if we take a look over the past 5 days, that stock's still down about 6.6%. So again, really speaking to the pressure that we've been seeing in some of these high-flying growth names over the past several sessions. Then, of course, taking a look at some of the semiconductors, we had our own Jared Blickery talking a little bit about the rebound here that we've been seeing as well. A lot of green across the screen. And in the Chinese names, a similar story here, especially when we take a look on an equal cap weighted basis. A big rebound here that we're seeing, despite the fact that China continues to be grappling with its biggest COVID outbreak since 2020. And then taking a look at the commodity space here, again, a big rebound in the risk assets overall. We're seeing Brent crude oil prices up about 5.7% during today's session and about 3.5% over the past 5 days. And when we take a look at crude West Texas Intermediate crude oil prices, I should say, also up nearly 6% during today's session and closing back in on that $100 per barrel mark. And on that note, I do want to stick with the topic of the energy markets and bring in our next guest on the program. Damian Corvalin is Goldman Sachs Head of Energy Research. Damian, thanks for joining us this morning. Crude oil prices have still been elevated, but have certainly come down since WTI topped $130 per barrel last month. What do you think is the path of least resistance here for crude oil in the near term?
Hi, Emily. Yeah, we've seen a large retracement. We think the next move is higher. If you think about the move lower, you've had three headwinds recently. The lockdowns in China, which reduce mobility, hence oil demand. The large SPR release from the US government. And finally, when you look at Russian exports, not as big a decline as initially appeared. So that's provided some short-term relief. But keep in mind, right, the market has been now in a nearly 2-year-long deficit. We're at record low inventories. And all those headwinds are transient. So we really haven't resolved the significant underinvestment. And that's why prices need to recover. We'll probably see short-term volatility, but I guess from this level, our view is the next move is indeed higher.
Damian, do you still see $125 a barrel?
Hi, Brian. Yes, that's our forecast for the second half of this year. So how do you get to such a price level? Well, when you decompose the oil market or any commodity market, you have three adjustments. You have supply elasticity, so producer responding to higher prices. Second, you have inventories. And third, and typically last, you have demand elasticity, demand destruction at higher prices. What is key in today's environment is you don't have one and two. So you don't have supply elasticity. Shale is growing, but that does take time. OPEC is not doing anything in excess of its plan. Second, inventories are record low, so you're really down to having to reduce consumption. Now, we're not saying we're at the point where we need a recession, a collapse in oil demand, but we do need slower demand growth than would have occurred at lower prices and without the Russia sanctions. So I think that's the core of how you get to 125. Now, as you see just the last few weeks, there will be volatility and there is risk potentially to the upside once the loss of Russian exports become clear and more persistent.
And Damian, we've seen, since we last spoke, I think we can argue that the Chinese economy is slowing down, large part because of these new lockdowns related to COVID. What does that mean to the demand environment for oil?
So, China has an efficient lockdown policy in terms of reducing oil demand, and we're seing that today, right? Their local demand is probably down 2 million barrels per day. So that's 2% of global oil demand, which is sizable. But keep in mind, right? We had always assumed that Omicron eventually would go to China and would lead to rolling lockdowns. And they're probably their most acute now. If you look at Hong Kong, for example, or the recent headlines out of Shanghai, we don't expect those to last for 6 months. So, we expect that to be this kind of short-term, call it 3-month headwind. Maybe it's rolling lockdowns, but still doesn't resolve the fact that you've been in a deficit that is now structural. What do I mean by that? Well, oil demand was record high before the lockdowns. Oil investment has been depressed for the last 3 years. So as those lockdowns fade, then you go back to the initial problem, which is persistent underinvestment, and that needs higher prices.
And Damien, switching gears here for just a moment, later today, President Joe Biden is slated to visit Iowa and announce that he will allow U.S. gas to be sold with a 15% rather than 10% ethanol blend to help bring down prices paid at the pump. Is this going to have a meaningful impact on U.S. energy markets?
It likely will be quite small. The first primary hurdle is retail gasoline stations are typically reluctant to sell high ethanol blends from a liability perspective. Most cars historically were not suited for such higher blends. So you may see it in some region in the Midwest where you have more flex fuel cars, for example. But again, it's a marginal adjustment. It really doesn't solve the inherent issue, which is a record long, record large deficit on a global scale.
And Damien, I was reading a good note by Jan Hatzius, the global, the chief economist over at Goldman this morning. Now he's not calling for a recession, but he did highlight how an overheating labor market is raising recession risk. From your camp in commodities, what would a recession in the U.S. mean to oil prices? Where do they go?
I think the key, ultimately, any recession is bad for pro-cyclical goods like commodities. What history shows, however, is the path to a recession typically actually sees commodity outperform every other asset class. Now, keep in mind, right, when I think about equities, this is an anticipatory asset valued over 20 years. Slower economic growth, higher inflation are bad from a valuation perspective. Commodities, however, are a real asset. What matters to them is today's supply versus demand mismatch. And when you're late cycle, so heading into a recession at the economy level, typically that's when those shortages are highest. Consumption levels are high. In fact, they're so high that the economy can't grow at the same pace as previously. So from here, if we were to have a hard landing, which may be driven by labor inflation, it probably is also coming with higher commodity prices. And that's your textbook allocation, right? At this point of the business cycle, one should be overweight commodities to hedge against inflationary pressure and to benefit from the appreciation that is coming with a strong economy, overheating economy.
All right, we'll leave it there. Damien Corvalin, Goldman Sachs Head of Energy Research. Thank you so much again for your insights this morning. Coming up, losing steam. We'll share why Spac activity is hitting its lowest level since 2020 after the break. Honda is revving up its electric vehicle targets. The Japanese automaker plans to release 30 EV models globally by 2030 and spend $64 billion on research and development over the next 10 years. In a bid to compete with Tesla, Honda also wants to set up a production line just for EVs in North America. The company also plans on obtaining special batteries from General Motors made to power electric cars. Making money in the metaverse, Facebook parent company Meta will start testing features allowing creators to sell items within its virtual reality game Horizon Worlds. Select users can sell products ranging from access to a VIP section of the metaverse to virtual items like jewelry. The Verge reports Meta will take a cut of at least 25% of any sale after App Store fees. The game is accessible on the Oculus VR headset, which Meta also owns. And a behind-the-scenes look at Warren Buffett's deal-making. Regulatory filings revealed that the Berkshire Hathaway CEO only needed 2 weeks to put together the company's $11.6 billion acquisition of Allegheny, the largest purchase for Berkshire in 6 years. Interestingly, the deal showed how much Buffett dislikes Wall Street bankers, as merger documents show Buffett slashed the price for the insurer to account for the advisory fee from Goldman Sachs. The Allegheny deal is expected to close in the fourth quarter. And Brian, I know you have some thoughts on this deal as well. What's your take on all of this?
Two quick takes. First, Warren Buffett was in New York City in March to get this deal done, Emily. He did not hit up his friends here at Yahoo Finance. I'm a little disappointed in Mr. Buffett. But number two, only in Buffett land, Emily, where you can get a deal done of this size in 2 weeks.
Absolutely right. And, you know, we should also point out this isn't of course, it is one of the largest purchases that we've seen in a number of years here for Berkshire Hathaway, but not the only deal making, the only purchases that have been happening here for Berkshire Hathaway. The firm's also been buying up shares in Occidental Petroleum, new equity stake in HP. So a lot to be watching out for here with the Oracle of Omaha, Brian.
It is indeed tough to be a billionaire. All right, staying on deals, SPAC activity has fallen to its lowest level since 2020, according to new data out today. Yahoo Finance's Alexandra Semenova has the details. Alex.
Well, Brian, the SPAC party that raged on Wall Street last year officially appears to be coming to an end. The market for SPACs, or special purpose acquisition companies, has gone through some cool down periods here and there, but last quarter, the volume of public offerings through these blank check companies reached the lowest level since 2020, before what has been called the SPAC renaissance began. According to data from PitchBook, only 78 SPAC listings were issued in the first 3 months of this year. This is sharply lower than the first quarter of 2021, which saw roughly 300 SPAC IPOs. The median deal size on SPACs this year also fell to half of what it was last year. There was a major drop-off in activity for de-SPACs as well, which are companies merged with publicly listed SPACs, only about 30 such deals compared to 81 in the same period last year. The slowdown comes as investors more broadly have turned away from more speculative parts of the market, which has caused an overall rout for these types of companies that are often overvalued and not yet profitable. PitchBook pointed out that de-SPACs specifically have significantly underperformed the S&P 500 generally in recent years, but with losses really accelerating into this year. And some of the big names of companies that went public through these types of mergers are electric vehicle maker Lucid, which was down about 47% this year as of yesterday's close, and the sports betting company DraftKings, down about 40% year to date at yesterday's closing bell. Guys.
So I think the natural follow-up question to this, and seeing this data, this drought in SPAC deals, is what is driving this relative lack of deal making so far this year?
Well, Emily, a number of factors are dealing a blow to the SPAC market. The first is just the overall underperformance for these types of companies in these current market conditions. And the second is the market correction that we saw this year has led investors to reprice some of those hefty valuations on pre-IPO companies. The same way that companies pull traditional IPO plans during negative pricing environments, it's likely that plans for new SPAC listings and SPAC mergers have also been delayed until there's more clarity in the markets. And then, of course, also dealing a further blow during an already tough period for SPACs is the SEC, which has proposed rules that would strip the advantages that SPACs have over traditional IPOs. One of those proposals includes stricter disclosures on future projections for these types of companies. Guys.
Yahoo Finance's Alexandra Semenova. Good to see you. We'll talk to you soon.
Good to see you as well.
All right, still to come, BlackRock's Tony DeSpirito is out with some important new calls on the market. Tony joins us on the other side of the break. We continue to highlight big calls on Wall Street here on the morning show, and there is a new one we want to spotlight. Investors should prepare for a longer run regime shift in markets as the low rate environment transitions to a new world order. It's a good word of our next guest. Tony DeSpirito is BlackRock's CIO of U.S. Fundamental Equities and the portfolio manager of the BlackRock Equity Dividend Fund. Tony, great to get some time with you here today. So walk us through this regime shift. What does it mean to investors?
Sure. I think it's a really big deal, first of all. And let me describe what I mean by the regime shift. Post the global financial crisis, we were clearly in a very unique regime relative to anything we had seen in history. Consumers were really licking their wounds. They were unemployed. Their balance sheet was in grave need of repair. Their homes were underwater. They had lost money in the equity markets. And same with companies, as well as banks, importantly. And so what we saw was a period of very low growth and very low inflation by any historical standard. And I think that really came to an end with the pandemic. And so during the pandemic, we obviously shifted to a new regime that was obviously characterized by stay-at-home, tech becoming very much more important. Also, incredible stimulus, more stimulus than we've ever seen when you think about monetary and fiscal policy combined. And now we're in a new period, a new regime, I'll call it the post-pandemic regime, where actually consumers are in great shape in terms of their balance sheets. Their home prices are up 20%, stock market's up. Unemployment's at 3.6%. So the economy is in really strong shape. And instead, the problem isn't low growth, but rather higher inflation. And so we are entering a new world of higher inflation. Now, I don't think we're going to stay at these high inflation numbers that we're at today. It's going to moderate, but we're still going to end up at a higher point of inflation than we saw over the last 12 or 13 years post the global financial crisis.
You make a great point in your note that you sent us, Tony, that it is getting complicated to be an investor. And I hear you on that. Look, we had the CPI print this morning, 8.5% on the headline, and stocks are rallying off of that type of print. It's not what you would have thought at first. So then how do you position your portfolio for this next decade?
Yeah. And so when I think complicated, I actually think that's good. That's good for fundamental investors who are seeking an edge. And we're seeing that today in higher dispersion of stock returns. They're definitely elevated. And so I think you got to really focus on a couple of key issues. One, costs are inflating. So which companies are most impacted by that and which ones aren't? Highly automated companies, for example, are not going to be as impacted by cost increases as ones that are very service and people intensive. So that's one. But then there's a second order question, which is, okay, given the impact of cost inflation, does this company have pricing power? How strong is its ability to raise price? Are there some moats? Is it a unique product, et cetera, et cetera? So that's an important investment question. And then the third order question is what's priced into the stock already? Is there hidden upside or hidden downside? And this is just fertile ground for individual stock pickers.
Where does tech fit into a portfolio now with this new regime, especially given how much they ran up during the pandemic through last year and given the sell-off in many of these names that we've seen this year?
Yeah, so I think it's a fascinating area. It's certainly a big area, an important area of the economy. There are definitely some stocks that I would call COVID hangover stocks that were their prospects were dramatically accelerated by what we saw in COVID, but they're now coming back to normal, right? So there's a group of companies that look like that. But there's also a group of companies, when you think about labor costs and wages inflating, tech is effectively, in many cases, a labor-saving device, all right? It's a productivity tool. And so there are a lot of tech companies that are going to experience actually increased investment in technology because of the need, because of higher wages, higher inflation. And so I think you're really seeing a bifurcation of names.
Tony, every day we seem to be just talking about the rise in yields, rise in interest rates that are likely coming, 7 to 8 hikes this year, perhaps, who knows? But do you suspect there will be some form of day of reckoning for markets at some point? Could be later this spring, could be this summer. At some point, you would have to think the markets adjust for this land of higher rates.
Yeah, so one of the interesting things is the market never fully priced in super low rates. Now, how do I say that? We run a model where we compare the earnings yield on stocks, so think of an inverted PE ratio, and compare that to the yield on bonds. And what we saw was when bond yields went really low, the equity yields, the earnings yield didn't follow them, right? Meaning the equity risk premium rose. And so based on our models, stocks have been very attractive throughout this period of time. And rates would actually have to go as high as 3 to 3.5% before you'd start to say, okay, bonds and stocks are equally as good, right? So there's still a lot of room for rates to rise from here before I'm worried about stock market valuations.
And when you think about the macroeconomic backdrop and what we're going to be seeing over the longer term, of course, heading into the pandemic, we had inflation sub 2% for years. Given the hot inflation print that we saw this morning, where do you see inflation ultimately leveling out here? And how does that factor into how you're thinking about this new regime as well?
Yeah, look, there are plenty of things about the current environment that are just abnormally high. I mean, I'll call it used car prices, which are actually starting to finally roll over. They were up 40% year over year. That's not normal. And in fact, used car prices are going to start to be a negative driver of inflation, actually, because once the supply of cars catches up to demand, you'll actually start to see used car prices coming down, for example. So I think it's important not to look at the headline, look at core, but then within core to look at more sticky measures. And so we look at the Atlanta Fed measure of sticky CPI. That's more in the around 4%. And so what we see is inflation coming down to that 3 to 4% range between the Fed actions and the fact that just sticky CPI isn't nearly as high as what you're seeing in the headline. And of course, inflation in general is just good for stocks. I mean, that's the history. Equities have done very well during inflation. They've done well even when the Fed is raising rates. That's the chart that you're showing now. And so I do think equities continue to be the best place to be when it comes to inflation and rates that we're seeing.
Is recession talk, Tony, anywhere? Are you talking about this amongst your teams? Are you positioning for it at all, or we're just overblowing it?
Yeah, so I think it's important to be talking about it and to be thinking about it. I think it's way too premature. Even if you look at the inversion that happened last week, it was short-lived. And even then, inversions don't spell recessions for usually, stocks continue to go up for another 24 months. So I do think it's early, but
This is a Yahoo Finance All Market Summit Extra, Tax Time, sponsored by Straight Talk Wireless. New rules, new deadlines, and new ways to file your taxes. Over the next hour, we are breaking down all you need to know this tax season. We'll have some last-minute tips and great planning advice for next year. Along with our special guests, we'll tackle the top tax issues affecting individuals and small businesses. New IRS rules, strategies to lower your tax burden, overlooked deductions, crypto, tax-efficient investing, and a lot more. Join us now for this Yahoo Finance All Market Summit Extra, Tax Time.
Hello, everyone, and welcome to our special for this tax season. I'm Akiko Fujita. Joining us now is Ken Corbin, the IRS's Wage and Investment Commissioner. He's also the agency's new Chief Tax Experience Officer. Ken, it's great to talk to you. I know it's a busy time of year for you, but you're coming up on 1 year in this new position, which basically was sort of created to improve the customer experience. 1 year in, what has that entailed for you specifically, and how much of that improvement are we seeing this tax season?
So hello, and yes, I'm really excited to be your taxpayer experience officer. And I think with the pandemic, it's really given us an opportunity to sit back and think about the journeys of the taxpayers as they interact with the IRS. It's given us an opportunity to be innovative, but also to kind of bring together cohesion around how we administer the taxes. A few of the things that I think that have come to light that we've made to help improve the experience for taxpayers is the introduction of things like new technology, like voice and chat bots on our phones and on irs.gov. It also gave us the opportunity to do something we call Taxpayer Experience Days. And this is where our offices were open just this past Saturday, where taxpayers can come in and talk to us on the weekends, which was something that we found that taxpayers were interested in. For us, really, for me, taxpayer experience has been about improving choice and access for the taxpayers that we serve. So it's been an exciting year, and I'm really, really looking forward to the future.
Yeah, and no question that experience is going to be tested this tax season because of some of the numbers that we heard recently from IRS Commissioner Chuck Rettig. And I want to run through the numbers here. He said there are 2.7 million unprocessed individual tax returns from 2021, 2.3 million unprocessed from 2022. I know that's well over the numbers you're usually used to. What kind of delays is that likely to mean for the average taxpayer?
So for the average taxpayers, most of the returns have already been processed. We process almost 163 million individual returns every year. But we have to be sensitive that those taxpayers whose returns have not been processed, it's critical to them. There are refunds in those returns. There are other reasons that people need their returns processed, either for financial aid for college-age students, or maybe to obtain a loan. So what it means for those taxpayers is that their experience has been a challenging one. But at the IRS, we're all hands on deck. We have a plan so that we can get better than healthy by the time we get to the 2023 filing season.
I know, most people have filed their tax returns, those like me who've been procrastinating, still gathering all the paperwork. And your agency has made it very clear that it's important to get all the numbers in line because last year you saw what I believe is roughly 10 million returns with some errors in place. So if there are those who still haven't filed yet, what specifically are you recommending they keep in mind, especially as it relates to stimulus that came in through the pandemic, the child tax credit, these new provisions we're going to have to be thinking about?
Yes, so I've got a couple of tips here, more than a couple that I hope will help our viewers here today. Number one, file electronically and use direct deposit. There are lots of options out there, including our IRS Free File program. I also will say this, if you received advanced child tax credit or you got a stimulus payment last year, you should have received a letter from the IRS around January through February. Now, I know people might look at a letter from the IRS and say, hey, I may not want to open that, but open that letter. Having that information available that we're providing you, we're telling you what you received, will match our records. And so that'll make your filing experience better this filing season. The other tip I have for filers is to make sure you gather all your records, particularly if you received unemployment compensation. Some unemployment compensation is taxable this year, so be sure to include that when you file your return if you received it.
How do the numbers stack up when you compare it to last year in terms of the returns you've received so far and also what the refunds are looking like?
So the numbers stack up pretty comparably here this year. We did start the filing season about 2.5 weeks later last year, but so far, we've received about 91 million individual returns this year, and we've processed 89 million returns. What's great about that is we are seeing that more taxpayers are getting our message. And so we've seen about a 96% electronic filing rate, which is just outstanding. So thank you to everyone who electronically filed. We've issued about 63 million refunds, with the average refund being about $3,200 this year. And that average amount is up over last year.
And are you finding that people are, filing on their own? Are they turning to accountants? Have you seen a difference on that front?
We've seen a little bit of difference this year, but it's been only like a very slight difference. More taxpayers seem to be seeking help in filing their returns, whether they're going to a tax professional or even using our volunteer income tax assistance program, or VITA, where we offer free tax prep for taxpayers.
Let's talk about some of those improved technology, if that's the way to put it, that you kind of alluded to in the beginning, because we have heard the agency repeatedly say that you need additional funding to make this transition from what is an agency largely based on paperwork to more digital. I know you're rolling out your bots. That's sort of the first step here. How is that going to, number one, improve the experience, but improve the wait times for those who have been so frustrated with the fact that they haven't been able to get through the IRS?
So from the taxpayer experience perspective, there are a number of innovations that we're rolling out to help taxpayers ease that frustration, because again, it is about the experience. One of the things that we have rolled out this year and over the past year has been customer callback technology. And basically, that's where if you call our toll-free line and you're in queue and you're waiting for a live assister, you'll be provided the option for one of our customer service representatives to call you back. It is an industry practice standard to offer that technology. And our goal, when we get all of the money and financing together, is to provision 90% of all of our calls to be eligible for customer callback. Last year, we redesigned irs.gov to make it a little bit more user-friendly so taxpayers can navigate and find information, because a lot of information is available on irs.gov. We have an individual account for taxpayers that they can sign up and get personalized information about their tax status, which is very helpful. And we also have launched last year an account for tax professionals. So if you do go to a tax pro, they will be able to manage your account or affairs with the IRS online, which will reduce the need to call in. But we know we have to offer service to one and all. So we still offer walk-in, we still offer toll-free, we offer online.
Ken Corbin, I know you've got a busy few days ahead of you. We really do appreciate the time. He's Wage and Investment Commissioner at the IRS and also the new Chief Taxpayer Experience Officer. Thanks so much for your time today.
Thank you for having me.
Coming up next, how to tackle all the new rules and regulations around taxes this year and tips for planning ahead for next year. We're going to be joined by H&R Block Tax Institute Chief Tax Officer Kathy Pickering. She's going to be joining us on the other side. We'll be right back.
Welcome back to this Yahoo Finance special presentation of Tax Time, sponsored by Straight Talk Wireless. Well, we are less than a week out from that deadline to file your taxes. If you haven't filed yet, though, you're certainly not alone. Roughly 30% of Americans, yes, 30% wait until the very last minute. And fortunately for us, we've got Kathy Pickering. She is the Chief Tax Officer at H&R Block. We've also got our very own Rhonda Lee joining in on the conversation. Kathy, we've got a lot of questions to get through to, but let's start with this because we often hear that most people who wait until the last minute do so because they don't believe they're going to get a refund. What are you hearing in the calls that are coming in?
So right now, we know that about 68% of Americans are struggling with some aspect of their finances, whether it's, saving or spending, having enough money, filing taxes. And this time of year is just so stressful. What people, I think, also are thinking is because the last 2 years that we had extended filing deadlines, they're like not really sure when the deadline is. And so I want to be clear for everybody. Monday, April 18th, is the filing deadline. You need to file your taxes. Normally it'd be April 15th, but because of the way that holiday falls in DC, it rolls till Monday. And then of course, if you're in Maine and Massachusetts, you have until the 19th for their own very special holiday. But what's really important is it's time to file your taxes. And a lot of people are fearful of filing their taxes because they're afraid they're going to owe money or, they just don't know. And for that, we would also say it's really important to file an extension because you can get until October to file your taxes if you're really just not ready. But an extension to file is not an extension to pay. You still need to pay your taxes. And so the final thing I would say there is for people that are just really afraid of owing money, they just don't have the money, there are many options for paying that money, from setting up an online payment account to negotiating, an agreement with the IRS. You can always borrow money from friends and family. And something that people often don't know is that you can pay your taxes with a credit card. There's a convenience fee associated with that. But, if you're somebody who likes to get travel benefits or reward points, that may be, a little benefit for an otherwise difficult situation. So these are some things that are really important to understand at this time of year.
Hi, Kathy, it's Rhonda. I have a question for you. So for our taxpayers who they've already filed, and then they realize that, oh my goodness, I worked this from home, I forgot to get this credit or that credit. How long do they have to amend a filed tax return to make sure they get that extra money in their pockets?
The general rule of thumb is you have 3 years to amend your tax return. The only thing being, if you've got money that is owed to you, the longer you wait, the longer you're waiting for your money. But you reminded me of a really important point, which is for people who didn't file their tax return at all for 2018, you can still file a tax return up until this Monday. And so you may be asking, well, who doesn't file a tax return, or why wouldn't you file a tax return? And if your income is below the filing threshold, which is about, $12,000 for individuals, $25,000 for married couples, then you might just say, oh, I don't want that hassle of just having to file. But what that means is that you're missing out on money that's owed you. So if you had a job with some money withheld, maybe it was a part-time job or a temporary job, something like that, that money is due back to you. And the other thing we know from the last couple of years is that there's been some very important social programs, from the stimulus payments to the child tax credits that were expanded last year, where more people are due these social programs. And so it's a really important reason to either file if you haven't already filed, or if you filed your return, you didn't claim those benefits that you're eligible to. This is a great opportunity to amend your return for up to 3 more years to be able to claim those benefits.
Kathy, one other question. So for the people who haven't filed, can they still file electronically, or do they have to do in a paper return from like the people who didn't file in 2018 and they have a refund due? Can they electronically file? The people who didn't file in 2019 that have a refund due, can they still electronically file?
Sure. And so you were just hearing Ken Corbin talk about how important it is to electronically file. And I would echo that 100%. There's a couple little rules with filing amendments. Your original return needed to have been filed electronically. And if you filed your original return electronically, you can file your amendment electronically, which is absolutely the way to go. And so for your 2018 returns, those would be able to be filed electronically as well, if it was an original return.
Some good takeaways there, Kathy. A lot of people with questions over the next few days. Kathy Pickering, Chief Tax Officer at H&R Block. It's good to talk to you today.
Thank you.
Coming up on the other side, new tax rules for crypto investors this year. Everything you need to know ahead of next week's tax deadline. We'll be right back.
Welcome back to Tax Time, sponsored by Straight Talk Wireless. I'm Rochelle Akufo. Now, we're fast approaching that IRS deadline, tax deadline, and many crypto investors are struggling to navigate the rules for digital currency holders. Well, here to break it all down with us is CoinTracker's Head of Tax Strategy, Shihan Chandrasekera. So, first of all, Shihan, welcome to the show. Walk us through some of these new IRS crypto reporting rules and the changes that filers should be aware of.
Sure. Great to be here. Thanks for having me. So let me kind of give you a quick overview of what kind of guidance IRS has issued so far. So IRS first came into the picture in 2014, and they issued IRS guidance saying that cryptocurrency should be treated as property. So after 2014, they issued another set of guidance in 2019 in the form of FAQs. So since 2019, IRS hasn't issued any new guidance, In 2022 tax forms, we continue to see that infamous crypto tax questions on the front and center of the Form 1040. And that's a question that every taxpayer needs to answer going forward. So to answer your question, nothing new, but the guidance is there for you to file the actual tax forms if you deal with crypto.
There's a number of misconceptions here around crypto. And, we're sort of at that phase still where a lot of crypto investors are just trying to get to know what this all means come tax filing season. But the thinking often is that if you don't necessarily use crypto, trade crypto back to US dollars, you're not necessarily, you don't necessarily need to file. I mean, can you walk us through the specific events that crypto investors need to be aware of where taxes are owed?
Sure. So remember these 5 situations. And if you went through these 5 situations during 2021, you could have a taxable filing. So number 1, cashing out. Pretty self-explanatory. You had a Bitcoin that appreciated in value. You cash it out, you got to pay taxes. Number 2 is when you convert one coin to another. That also triggers a taxable event, even though you're not realizing any actual cash. And this is where a lot of people get it wrong. As a matter of fact, we recently conducted a survey in CoinTracker. We found out that 58% of the respondents didn't know that they had to pay taxes when you convert one coin to another, which is a very common transaction in this space. Number 3 is when you spend your cryptocurrency, you buy a cup of coffee or like a Tesla or something like that, that triggers taxes. Number 4 is when you earn cryptocurrency. You can earn cryptocurrencies as a method of employment, like wages, staking income, interest income, those things are taxable. And finally, if you go through airdrops or hard forks, these are somewhat technical things that are unique to the crypto space. So airdrop is a situation where you have a certain type of wallet or a coin, and the protocol kind of gives you free coins. That triggers a taxable event. So those are the 5 situations. If you went through those 5 situations, you could have a taxable filing requirement.
And as we know, of course, crypto can be volatile. We've seen this year especially. How should filers manage things like capital losses and carryovers if they have lost?
Yeah, so as you guys know, the market goes through ups and downs all the time. I mean, we are pretty used to that nowadays. One thing to note is that whenever you have a loss, you should also file taxes on that situation, because you can claim up to $3,000 worth of capital loss in any given year. And if you have more than $3,000 worth of capital losses in any given year, you can carry those losses forward into future years. And in the future years, when you have capital gains, you can use those capital losses to offset those gains. So again, don't think that you had to file a tax return to pay taxes. You can also file a tax return to report your losses and potentially increase your refund, and also carry forward that losses into future years.
What about tax breaks? I'd imagine that's something that a lot of investors are curious about. What should they know on that front?
Great question. So the tax planning idea. So again, going back to what I was describing earlier, if you have any coins or NFTs that are below their cost basis. In other words, let's say you paid like $50,000 for Bitcoin, but now it's trading at $30,000, for example. What you can do is you can sell that coin and harvest that $20,000 worth of losses and get back into the same coin within a reasonable period of time. So when you do this, we call this tax loss harvesting. First, it's going to benefit you when it comes to taxes, because it's going to reduce your taxable income. And you can claim certain amount of those losses. And if you have amount of losses in excess of 3,000, that's going to go into future years. So tax loss harvesting is something that you should consider doing every month, every other week, depending on the frequency that you have. Another way to kind of save on your taxes is, if you really want to sell coins, make sure you sell the coins that you have held for more than 12 months. When you do that, you're going to get taxed on the more preferable long-term capital gain taxes versus you selling a coin after holding it for less than 12 months. So make sure you tax loss harvest. And second, if you really have to sell something, make sure you sell the coins that you have held for more than 12 months. And that's going to lead you to a less tax rate.
And as we've seen, different countries have different rules on crypto. So how should people navigate some of these crypto holdings that they have perhaps overseas that may have different tax rules?
Yeah, great question. I get this question all the time. The reality is that the US has this thing called a worldwide tax system. So if I have my crypto holdings in some exchange in, let's say, in Europe, I still have to pay taxes on those holdings if I have any disposition event under the US tax rules because I'm subject to US tax rules. So if you have any crypto exchanges in other countries, you don't necessarily have to follow those overseas tax rules. If you're a US resident or a citizen, you still have to follow US tax rules for those coins held in overseas exchanges.
And finally, you've already kind of walked us through the provisions that taxpayers should be aware of, but I'm just curious what kind of calls you're getting. What's the number one question you're getting from those who are having to file on their crypto holdings for the first time this year?
Yeah, I think the number one call that I'm getting is that, hey, Sharon, like, how do I figure out my capital gains and capital losses? Because if you really think about it, if you're like a stock trader, at the end of the year, you get this nice Form 1099 from the brokerage, and your job is just put that numbers into the tax return and you're done. But in the crypto space, it doesn't happen. It becomes your responsibility to look at all the wallets and exchanges that you use, keep good records of all the coins and NFTs that you created, and figure out your taxable gains or losses by applying the latest IRS rules. And a lot of people find this virtually impossible to do, and they get afraid, and then they talk to us asking, hey, how do we go about it? I want to file my taxes, but I don't even know where to get my information. And that's where we help through CoinTracker.
And to that point then, for people who are perhaps either getting paid in crypto partially or fully, what is it that they need to present? And is that something that they would have to sort of go to the platform and get, or is this something some of these crypto platforms would naturally provide for them?
Yeah, so we see some of the athletes getting paid in crypto as well. If the employer were to do this correctly, your crypto wages should be included on your Form W-2. So as the taxpayer, I don't have anything new to do other than just inputting my W-2 into a tax software or just giving it to the CPA. But there are certain situations where your employer pays you in crypto directly, but they don't report that to you in any form of tax form like a W-2. In that case, you had to keep track of each coin that you receive, at what time you received it, and the market value each time you receive those coins, because every day, every second has a different value. So you need like these detailed records to kind of figure out your income to be reported on the tax form. And again, it's a very difficult task to do, but if you're getting paid in crypto, those are the records that you should keep on handy to file your taxes.
Certainly a lot to wade into, but we appreciate you making sense of all of this for us today. Shihan Chandrasekhara joining us from CoinTracker. He's head of tax strategy there. Coming up on the other side, we're talking tech and taxes. Up next, we're speaking with Intuit's Lance Williams about the next big thing in do-it-yourself tax software. We'll be right back. Welcome back to this Yahoo Finance special presentation of Tax Time, sponsored by Straight Talk Wireless. Well, the latest data from the IRS shows that more Americans are turning to accountants to prepare their taxes this year. But if you are looking to go it alone, there are plenty of resources out there. One of the most popular options is Intuit's TurboTax software. And to talk more about that, we've got Lance Williams. He's Senior Vice President of Product Management at Intuit. Lance, we're going to get into those products in just a bit, but I'm curious what you're seeing, because I was looking at the latest IRS data. It does show that people are turning to accountants. I'm imagining because there are so many different provisions they're having to think about as a result of the pandemic. What kind of growth are you seeing on your front?
Yeah, thanks for that question. And TurboTax and TurboTax Live has a full spectrum of offerings, from DIY software to Ask a Pro for expert opinions along the way, or even handing your taxes off to a tax expert to completely do it for them. And we're seeing growth in DIY, and we're seeing massive growth in the TurboTax Live business, both with the Ask a Pro along the way and to hand off your taxes and have the expert do it for them. So I would say, we're seeing the same trends, and we see expert help is really a killer value prop for our customers, and they're seeking that from us through TurboTax Live more and more each year.
So Lance, Rochelle here. Just how much has artificial intelligence and machine learning really evolved since a lot of these do-it-yourself software programs came on the market versus now?
Really, the growth in artificial intelligence over the last several years has been amazing. Intuit, every facet of TurboTax has artificial intelligence infused in it. There's a discipline of artificial intelligence called knowledge engineering, and that is the baseline foundation for TurboTax's DIY software. And we also give a version of that knowledge engineering artificial intelligence to our experts, so they can help customers either by asking questions along the way with the TurboTax Live product, or through the TurboTax Live full service product, just doing the taxes completely for the customer. So there really is an infusion and a backbone all through TurboTax for artificial intelligence, especially with knowledge engineering, and also with machine learning targeted algorithms doing certain jobs along the way.
Well, what does that mean, though, bottom line, from a customer experience standpoint? I mean, I'm reading here that you've got 60 different machine learning models that you've deployed for this particular tax season. What are customers going to see on their end that makes a difference?
Yeah, what they'll see is if they make a mistake, if they don't have a form, or they forgot about a form, or if they made a data entry error, or if they maybe have a cost basis for one of their investments that's not quite right, we will flag that for the customer and help them fix it, either in the DIY software or have an expert walk them through how to fix that for themselves. So it really comes down to simplicity for the customer. Takes away any fear, uncertainty, and doubt that they have with the tax process, because we're always looking over their return in real time with our artificial intelligence and letting them know when things maybe should be double checked.
And so for people trying to gauge whether they should go the CPA route or rely on some of these tech products, what are the biggest distinctions that would help people really decide that?
Yeah, I think if you look at the spectrum that TurboTax offers, from TurboTax Do-It-Yourself, our flagship product, to TurboTax Live Do It With Me, which is this idea that as you go along the way, you can ask a tax expert for an opinion, and then full service. We find that full spectrum customers have more or less confidence in doing it themselves. So folks that are pretty confident in their ability to do their taxes, we give them DIY, we give them all this tech behind the scenes to help them. But what we find with our full service customers, which is our newest offering, just completely handing off your taxes to a tax expert, is customers want the best match. We have thousands of experts. We have an artificial intelligence machine learning algorithm that matches a customer with the best tax expert for them, depending on the profile of their income, investments, and deductions. So we know they're getting, and the customer knows they're getting the best expert for them. So that's one thing that really resonates with these assisted customers who are looking for a tax expert. And then along the way, we make sure that we make it really easy for that customer to hand off work and worry. there's the proverbial shoebox full of receipts, and we digitize those, and we take that work off of the customer's hands, and they can hand that off through photos or import and a variety of mechanisms to give that data to us digitally. And then thirdly, along the way, we have this idea of making sure that a customer knows exactly where they are in tax process along the way. One of the big pain points we've heard from our customers when they deal with a full service tax expert outside of TurboTax is they hand off their documents, they don't hear anything for a long time, and they start getting worried. Will it be done on time? We have this technology, I kind of call it the pizza tracker. So all along the way, you know every step where your tax expert is and when is projected to get done. So we find those three things, the really great artificial intelligence match, the ability to use data import and photos to digitally hand off those documents to the expert, and then this idea of keeping a customer along the way, like those three things really resonate for our customers. And I think broadly, that's what we find customers who are looking for full service tax prep are looking for out of their expert.
Yeah, with that said, you know, go ahead, Michelle.
Akiko. Well, I was going to say, with the tax deadline fast approaching, obviously a lot of times panic can set in. What are some of the last minute tech questions that you tend to get during this period?
Yeah, you know, we get a lot of questions about things like cost basis with investments, self-employed income, forms, data entry. And that's why we have our TurboTax Live experts there ready to help. So I would encourage folks to get started as soon as possible. We're coming up to April 18th very quickly. We have experts with TurboTax who can help you if you need it. And it's as simple as a chat or a phone call to talk with an expert. And you can get them on video, and they can help you out.
Well, a big thank you there to Lance Williams from Intuit. All right, well, straight ahead, we're joined by America's accountant, Dan Geltrude, about some of the most common tax questions that you might have right after this break. Welcome back to Tax Time, sponsored by Straight Talk Wireless. Yahoo Finance's Rhonda Lee is back with us, along with Geltrude & Company founder Dan Geltrude. So Dan, I want to bring you in here. A lot of people are sort of looking at the clock, getting a little bit stressed out. Perhaps their finances, the receipts are a bit of a mess. What are the first steps people should take in sort of deciding whether or not to file an extension or to try and rush to the finish?
Well, you should never really rush through the process of having your tax return prepared because you want to make sure that your tax return is complete and accurate. The last thing that you want to have happen is you file your tax return in a rush, and then in 30 days or 45 days, you get a nice letter from the IRS saying, oh, there was a problem with your tax return. So you certainly don't want to rush through the process. However, if you know that you're going to be getting a refund, you certainly want to file that tax return as quickly as possible because you don't want the government holding your money. At the same time, if you know that you're going to have to pay with your tax return, well, then you truly wait to hit that button or put it in the mail until the last minute possible.
Hi, it's Rhonda. So I want to focus in on our people who they owe, and a large chunk of them wait until the last minute because, like you said, you don't want to hold on, give the government that money. For people who are not paying electronically and they're putting that check in the mail or they're thinking about paying by cash, what tips do you have for them? Like if they're going to do it by mail, it used to be people would run to the post office at 11:59. Is that a good idea? Or should they be sending those mail-in checks via, next day delivery?
Well, as long as the envelope is properly stamped by the due date, in this case, April 18th, sending your check through the mail at that last moment, and by the way, you should also do that by certified receipt to make sure that you can prove timely filing and timely payment. That's really the way to go. Of course, if you're electronically filing, you could have those funds wired directly from your account. So either way, that's preferred. Now, there are people who say, well, I would like to be able to pay by credit card, and certainly you can do that. However, when you are paying your tax bill by credit card, the IRS is actually going to hit you with a service fee. So why do that? They're taking enough of our tax dollars. I don't think that we have to add a service fee into that number in order to pay our tax bill. So I think regular mail on a timely basis by certified mail or electronic filing with the funds coming directly out is the way to go.
Dan, let's talk about a lot of provisions that people are thinking about now. What are we, third year into the pandemic? Work from home was a big one. And I know a lot of Americans claimed deductions last year, whether it was their rent, the equipment they purchased in order to be able to work from home. What's changed?
Well, we actually have to go back to the tax law changes under the Trump administration. And during that time, most of the itemized deductions disappeared. And one of those related to having those home office deductions. Those disappeared. Now, what happened during the pandemic, and this was a question that I got all the time, well, I'm working from home and I am incurring various expenses related to being able to do my job. And that's the most important aspect here, to do my job from home. Well, if you are an employee, meaning that you are getting a W-2 for the work that you do, you are not entitled to take those home office deductions. So that was problematic and a surprise for people going back a couple years ago. It was more of a hurt when they said, well, now I'm working at home because of the pandemic. If you're going to be able to take those types of deductions, you actually need to be an independent contractor. In other words, having your own business. Now, when you do that, you are entitled to take all of those expenses related to your business activity as a deduction against your income. But you can't do it as an employee.
Now, as we stay with this topic of COVID, we saw a lot of generosity, a lot of people giving to a lot of good causes, GoFundMes to help perhaps people who were struggling, charities. But what do people need to know about what does and doesn't count as charitable giving as defined by the IRS?
Well, when you're talking about giving money to charity, that is supposed to be specifically for a charity recognized by the IRS. Sometimes you hear that 501c3 thrown out there. So yeah, that is recognized as a public charity for which, when you make a donation, you are able to get a tax benefit for. Now, what's happened over time, again, I go back to the changes made through the Trump administration. If you are not itemizing your deductions, for example, because the standard deduction was raised so high, people were not getting any benefit for making charitable donations. So what we have there is, if you are single, whether you itemize your deductions or not, you are able to deduct $300 of charitable giving, or if you're married filing jointly, you can take up to $600. So even if you're not itemizing your deductions, there are still some benefits to be had by making charitable donations to recognized charities.
And Dan, one more question here as we stay on the COVID theme, because I understand there's some changes with unemployment benefits between last year and this year. A lot of people still having to file on that as well. What should they be aware of?
Well, I think there's going to be a lot of people in for a surprise this year when they're filing their tax returns related to unemployment benefits that they received. Because if you go back to 2020, because of the pandemic, the federal government said, you know what, we are not going to be taxing unemployment benefits. Okay, great. But that expired going into 2021. So what happens is that there were people obviously still receiving unemployment benefits last year, and they didn't consider that it was going to be taxable. Therefore, they didn't make estimated tax payments or have the appropriate withholding. Now they go to file their tax return, let's say this week or into next week, and what do you know? I thought I was getting a refund, but now I have to pay because my unemployment benefits are now taxable. So that's one thing that people have to be aware of, that they could be in for a surprise.
All right, Dan, we're going to have to take a quick commercial break here, but I know you are sticking around. Much more with Dan Geltrude on the other side. We'll be right back. Sponsored by Straight Talk Wireless. We are back with Geltrude & Company founder Dan Geltrude. Dan, we've got, 6 days left to go until those taxes are due. What's the number one question you've been getting?
The number one question by far is, when am I getting my refund? Of course, anytime people know that they're getting a refund, they want that money as quickly as possible. So right now, the IRS has actually been pretty good this year, and for the most part, getting refunds has been taking place within about 21 days, about 3 weeks for those refunds to be issued. So that's really positive. But if you want to make sure that you're going to be getting your refund as quickly as possible, there are a few things that you can do. First, you should be filing your tax return electronically. That speeds up the process tremendously because it's basically instantaneously that you hit the button and your tax return is received by the IRS. The second thing is that you want to notate on your tax return that you want direct deposit, meaning that your refund is going to be deposited directly into your bank account. Now, doing those things will significantly speed up the amount of time to get your money. Emphasize that, your money. Now, to answer the question of where's my refund, there is actually a portal on the IRS's website, irs.gov, called Where's My Refund? So you can go into that 24 hours after your tax return has been received, and let's assume you file electronically. Now, the next day, the IRS is now tracking your refund and the process for which you can go on the portal and actually see where your money is.
So here's a question. You're filing your taxes and you thought you were getting a refund. You find out you owe, and it's much larger than you anticipated. You don't have the funds. Is an extension to file the same thing as an extension to pay? What do I do if I'm in this situation?
Well, there's two pieces to this question. First of all, let's talk about when the tax is due. So just because you don't have the funds to be able to pay what you owe with your tax return, and you say, oh, no problem, let me file an extension. The extension is only for filing the actual return. It doesn't apply to paying your taxes. So in other words, this year, your taxes are due April 18th. You could file an extension in order to actually send the return in, but you must make that tax payment. Now, the second part of this goes back to, okay, I didn't expect to owe this much. I don't have the funds to pay my taxes. What do I do? First thing, file the tax return anyway. Send the return in because you don't want to have a situation where you have a failure to file penalty along with interest. So send in the tax return. Also, whatever funds you do have to make a payment, do that as well. Now, you do have a couple of options. You could apply to go on an installment agreement, which is through Form 9465, and that will give you 72 months in order to make that payment for your taxes. Or you could also file for what's called an offer in compromise, which is basically to say, I don't have the money. This is what I have right now. So how about you accept this number, which is less than what you owe, as full payment? So those are what your options are if you don't have the funds to pay your taxes on April 18th.
And in terms of perhaps major life changes, say you got married last year and you're trying to decide whether it's better to file jointly or separately, how do you maximize your returns and avoid any marriage penalties?
Yeah, that marriage penalty, that really bothers a lot of people, which it should. I mean, I don't think people want to look at their marriage as a penalty, do they? But it can turn out that way with taxes. So what you really have to do, and this is where it comes into, you have to consider whether you want to have a professional actually prepare your tax return, is that you prepare your tax return and you input all of the numbers based upon which person earned and which person incurred the various deductions. And then when you're talking about, I know before you were talking about the technology and filing tax returns, so now you have the ability to actually switch back and forth to say, if I file jointly, what's the impact for my taxes? If I file separately, what's the impact on my taxes? And being able to compare the two is what will determine what's most beneficial in how you file your tax return.
We do want to thank you for your time this afternoon. Lots of great advice there. A big thank you to Dan Geltrude there. Well, from all of us here, thanks for watching. Do stay tuned for more Yahoo Finance Live coming up after this break.
Inflation, inflation, inflation. Now, rule number one in the economy. We'll have reaction from the economy. I'm not. We will have White House reaction to the latest CPI number and the president's plan to reduce prices at the pump. Plus, proof TikTok is much more than a bunch of trendy viral dances. It's become an advertising behemoth. Some eye-popping numbers ahead, and your summer vacations are going to cost a lot more this year. Why airline prices are rising and the potential impact on consumer spending. That's all straight ahead before we see how markets reacted to the CPI numbers. Rochelle?
Well, let's get you that market check less than an hour before the session closes for the day. What started in positive territory has descended into the red, as you can see there. The Dow down just slightly, about 0.2% there, down 64 points. The S&P 500 dropping by 1/3% there at 4,400. And the Nasdaq down the most about 1/3%, down 42 points. Well, to break down what's been happening this afternoon's session, let's bring in our very own Jared Blickery at The Interactive. Jared.
That's right, and just taking a look at our global indices, you can see, as we've been talking about, the majors in the U.S. under a little bit of pressure here, nothing too major, except the Russell 2000 is actually in the green. And I just want to spend a little time looking at a longer-term view of the market. Here's the S&P 500 year to date. We have come back 50%, the halfway back from this rally, from this low in here to up here, and that would be the ideal place for longs to enter again, to re-establish some of their fuel in the tank. Interesting to get some comments from the Bank of America Global Fund Manager Survey this morning. Asset managers who manage $1 trillion worth of assets, pretty bearish on the economy, as you might think, but it's really about the Fed. Now, here's the VIX. You can see it's a little bit elevated over the last few days. Also taking a look at the bond market, the 5-year T-note yield is down 11 basis points. Pretty big move to the downside, except still firmly within this uptrend. You have to imagine how long can this move upward in yields last, and really gets back to what the Fed is going to do. And looking into that Bank of America report one more time, the biggest concern, in fact, the top 3 concerns are all related: recession risk, inflation, and also hawkish central banks. And this gets to what's been happening in the financials. Financials, the biggest laggards today. Healthcare also a laggard. Energy in the green. But we want to stick with financials, because we get banks earnings season kicking off with JP Morgan and some of its cohorts tomorrow. Going to be a lot of focus on the M&A space. Pretty interesting to see what's happened in terms of declining volumes there. Also with IPOs really not up to par this year. But trading fees may be going to be a bright spot, as we have seen elevated volatility. So here's JP Morgan Chase. You can see down 17% year to date. Here is a 1-year look, and you can see down about the same percentage over that time period. Also want to take a look at the retail sector. Interesting news on Amazon. Well, guess what? They're going to be tapping the high school market with youth unemployment at basically 60-year lows. Maybe going to drive it further down. So we'll have to see what comes of that. Anyway, guys, going to kick it back to you, Brad.
All right, thanks so much, Jared Blickery at the Wi-Fi Interactive. To continue this conversation and joining us now for more on today's market activity, we've got Jack Manley, who is the JP Morgan Asset Management Global Market Strategist. Jack, good to have you here with us today. You know, first and foremost, I hearken back to what the Fed had said most recently following their March meeting. The probability of a recession within the next year is not particularly elevated, is what we heard from Fed Chair Jay Powell. It would certainly seem that the economic data is starting to point us in the direction that that propensity or that possibility for a recession, with some of the added factors since that meeting, certainly does point towards the looming risk of one.
Well, I think there certainly always is a risk of a recession at any given point. That's just sort of the nature of business cycles. There's never a zero probability that we will have a recession in any given year. But when we think about what's going on right now, I would generally speaking agree with that sentiment that there isn't a whole lot of outsized risk in terms of recessions, at least for 2022. Obviously, there is a whole lot of concern about what's going on with the war in Ukraine at the moment, the impact that that is having on commodity prices in particular. But we see that the American consumer in particular is reasonably insulated from this. You know, we just consume less fuel than we had in the past. We are more energy independent than we had been in the past. When we think about what's going on with inflation, certainly a whole much more broad conversation to have on that front. The impact that that may have is on confidence. It's not good for the consumer, certainly. But again, we think about all the money that we have saved up over the last couple of years, the high standards of living that we have been able to develop. We should be able to absorb this risk. You know, frankly, to me, the biggest threat to this economy right now is the Fed overstepping, the Fed playing its hand too aggressively, raising rates too quickly. That is the thing that I think could potentially throw us into a recession, or at least an economic slowdown this year. Not really some of these other exogenous factors we've been talking about.
On that point then, Jack, what would be too aggressive? What would be overplaying its hand? Everyone expects 2 50-point basis rate hikes the next 2 meetings. What would be too much?
Well, I mean, it's hard to point exactly to what too much would actually be, but the way I'm thinking about the interest rate trajectory this year is that it is very easy to make the case that the Fed is behind the curve at the moment, right? We should not have had real yields being deeply negative for the better part of the last 15 years. We should not have been adding stimulus in the form of quantitative easing up until just a couple of months ago. We are far behind this story in terms of getting policy back to normal. But the question I think we have to ask is, why is right now the time for that normalization? And especially when you look at what's going on with inflation at the moment, so much of that is being driven by supply chain issues. Energy having an outsized impact on this morning's inflation reading, having a whole lot to do with that ongoing war in Ukraine. Not a whole lot the Fed can do about that story, right? The Fed can't fix supply chain issues. It can't end this conflict. What it can do instead is make the supply side problems not matter, because the demand story starts to go away. And it does that by making borrowing costs go up, such that as consumers, we just kind of throw in the towel. So I don't know if there's a specific number we can point to, but I do want to say that if the Fed hikes rates twice consecutively by 50 basis points a pop, as you said, I don't know how much that's going to actually do to inflation. It may just make our lives as consumers more challenging than they would have otherwise been.
So then as we look at that 8.5% headline number there, coming in even higher than a lot of people expected, still we were expecting the bad news. Did that overshadow perhaps any good news, any good changes that we're seeing that are offsetting inflation within this data?
So there isn't a whole lot of good news in this inflation data, but there are a couple of things that I think are worth pointing out. The first one, as I already mentioned, is that energy in particular had an outsized impact on this inflation reading. Fuel prices up around 18% year over year. That, of course, going to have a pretty dramatic impact on that 8.5% reading we saw earlier. And I think very easily tieable to exogenous geopolitical factors, right? Nothing really domestically going on that is causing oil prices or fuel prices to spike that aggressively. The other thing that is worth pointing out, sort of one bright spot in the inflation print, is that used car and truck prices moved down around 3% year over year, reflecting some of the easing in global supply chains. Now, it's very good news if it is a bellwether that supply chain issues are getting resolved, and I think it frankly is. But we can't take it as being too exciting, because prices for these things are still extremely elevated, relative to where they had been pre-COVID, relative to probably where they should be. So a couple of glimmers of hope in this otherwise pretty dismal report. But I do think that when it comes to the inflation outlook, this 8.5% reading may be the peak.
Do you expect there to be any reprieve offered by earnings season coming up?
I think the earnings season this quarter is not going to be great, but I think that markets are already anticipating that and looking beyond it. You know, we look at the first quarter season, we see that margins in general are coming under pressure. We see that high-flying, high-growth technology names have come under a lot of pressure on the back of rising interest rates. We see that financials are likely coming under a lot of pressure on higher costs, on reduced volumes because of poor markets. A lot of challenges that I think we'll be dealing with in the first quarter, but not challenges that are going to persist much beyond that. We still believe in the cyclicality trade this year. I think there is more room to run, not just in financials, but in industrials and materials and even energy this year. And as long-term investors, we continue to like that technology story and those tech adjacent names. This is where growth in a US focused portfolio is going to come from, maybe not over the next 6 to 9 months, but certainly over the next 10 to 15 years. So maybe not so great for the earnings season this quarter, but I think 2022 should still be a reasonably good year for earnings.
Well, take that, and you had me at inflation has peaked, Jack Manley. We appreciate you being here with us. Thank you, sir. Coming up, not just TikTok users, but executives have a lot of reason to dance today if, in fact, these staggering ad revenue projections for TikTok are right. We'll tell you what they are, plus with or without Elon, some changes could be on the way at Twitter. That's coming up after a short break. In the app and frankly in the C-suite, everybody's got to be dancing at TikTok right now, given these new projections over their ad revenue that suggest they have become an advertising juggernaut. So much for those concerns over data collection and privacy issues. No longer a concern. Let's talk about the numbers with Deborah Aho Williamson, principal analyst at Insider Intelligence. Deborah, nice to see you. This app that most people just associate with these trendy viral dances has become so much more. What are the projections for ad revenue, and how do they compare to Twitter and Snap?
Yeah, so this is our inaugural forecast for TikTok's ad revenue, both worldwide and in the United States. We are estimating that this year, TikTok will make $11.6 billion worldwide. To put that in context, that is more than Snapchat and Twitter combined, which to me is absolutely incredible. You think TikTok wasn't even around like 4 years ago. It was formed by the combination of a small app called Musical.ly that nobody basically remembers, with some other assets that TikTok's parent company ByteDance owns. And suddenly now here we are 4 years later looking at a company with 11.6 billion in ad revenue this year. That's, to me, incredible. It really is. To put it in a little bit more perspective, it's nowhere near what we're expecting for Meta, the parent of Facebook and Instagram, which is leagues ahead still and remains to be that way. But more and more, we're really seeing TikTok coming on strong as an advertising vehicle that advertisers around the world are starting to clamor to be on, just like users.
You're not kidding. These numbers are eye-popping. I almost fell out of my chair when I saw them. What makes TikTok such an ad-friendly environment?
You know, there's a couple of things. So the user base, right now, we're estimating that about 1 in 5 social network users worldwide is using TikTok. But more than that, it's really about the amount of time these users spend. In the United States, we estimate that just among adult TikTok users, so not including those teens, among the adult TikTok users, we're estimating that they spend 40 minutes a day watching TikTok videos. And that's absolutely the testament to how TikTok is set up. Its algorithm shows you videos of all types that they think you're going to be interested in, and in a scrolling feed that's pretty much endless, and it just keeps you going, and the advertising ends up being interspersed in that. I think another factor that's driving this growth is that TikTok really has a lock on the youth market. So we just saw a major survey from investment company Piper Sandler last week, where teens now say that TikTok is their favorite social media app ahead of Snapchat and Instagram. And then in our own numbers, we estimate that about 2/3 of all teens in the United States and about 3/4 of young adults 18 to 24 are monthly users of TikTok. So we're seeing a huge audience spending a lot of time on the app and really being engaged watching videos for what seems to be hours, if not minutes, if not hours on end during the course of a day.
And correct me if I'm wrong, Deborah, but it seems one of the effective attributes of TikTok is that some of these ads are actually original content that people aren't clicking out of. They're watching voluntarily and even sharing.
Yeah, I mean, one of the really unique things that TikTok did is to involve creators or influencers in the advertising. So a creator might partner with a brand, they might create their own video of supporting that brand, and then that creator will turn to their followers, which oftentimes number in the millions, and say, okay, now you guys create a video using these similar assets, this similar hashtag, you put your own spin on it. And these kinds of things have spread virally across TikTok. We've seen this over and over again. And this really tight partnership between creators, brands, and then the followers of creators is really what's helping TikTok advertising tick.
It's been a large driver in the name, image, and likeness rules in the NCAA. A lot of players making significant money. So I mentioned in the intro those concerns about data collection and privacy, given this is a Chinese-owned app. What happened to those a year ago? There was a big movement to push people off of that app and to get children off of it entirely.
I don't think those concerns have gone away. To be honest, I think they certainly have diminished in terms of the public awareness, but I do think that there are still studies that have come out about the effects of TikTok on people's health, just like on other social media apps, but TikTok isn't immune to some of those concerns. We're also seeing pretty regularly investigations into how the data is used. Is it going to China? TikTok says no, but that's really hard to prove. So I wouldn't say that advertisers or users, for that matter, should disregard the privacy concerns or the concerns about data usage. But at this time, TikTok's momentum is really strong. And I think that both advertisers and users are really just willing to overlook that right now.
Conversely, we don't have a lot of time here, Deborah. What's happening over at Twitter in terms of their growth, their ad revenue? Do you expect changes regardless of whether or not Elon Musk's Twitter takeover eventually succeeds, or whether he just hangs on to that 9%?
Yeah, it's hard to sum up what's going on in Twitter in a short period of time, but let me see if I can do that for you. So before all of this started with Elon Musk, we forecast that Twitter will have another really good year for revenue, with revenue growth of advertising revenue growth about 25% year on year, getting to be about 5.6 billion. That's after 41% growth last year. So right now we're looking at very strong performance for Twitter. What's hard to predict right now is the effect of Musk. Is he going to push for subscriptions? Is he going to, as he tweeted over the weekend and then deleted, push for an ad-free Twitter? These are some concerns that we have. We're obviously going to be paying a lot of attention to it because anything that someone like Musk does to change how Twitter is experienced by its users does have a ripple effect on advertisers, and that's something we have to pay attention to.
Yeah, whether he's on the board or not, he's going to push for change and may push Donald Trump back onto the format. We shall see. Deborah Aho Williamson, Insider Intelligence Principal Analyst. Enjoy talking with you. Thanks so much.
All right, coming up next, the tickers that we're tracking today on Triple Play, from meme coins to the mega caps. That's next. Welcome back to Yahoo Finance Live, everyone. It is time for our triple play. The three tickers that we're watching today that caught our eye for one reason or another. So we're going to start with me. My pick is Shiba Inu, the ticker symbol SHIB USD. Now, this meme crypto token was soaring this afternoon before dialing back slightly. As you can see, it's still up about 10% at the moment. Now, this was after it was included as one of four new cryptocurrencies on Robinhood's platform, and that was along with Solana, Polygon's Matic, and Compound's COMP. Now, Shiba is yet another example of a meme coin, which typically does tend to appeal to retail consumers. But as we saw with the rise of Dogecoin, once you get the blessing from someone like an Elon Musk, that does get taken more seriously. A lot of people wondering if that might be the difference here with Robinhood. Now, obviously, Shiba's still down year to date, though, but Robinhood shares also got a bump today on that news, while more broadly, other cryptos, except for Bitcoin, seeing some green today, but still a little bit on the struggle bus as well.
Yeah, and this is the key for any new coin that gets added to some of the major exchanges, whether it be Coinbase, whether it be Robinhood, and the amount of sales that we do see, or at least the new players that decide to get into the crypto space, either via Robinhood or one of the other platforms that I mentioned a moment ago, is for these coins, it just adds more of the viability for them. If they're getting picked up by a major exchange, then ultimately you see this type of price action on that day of the announcement. Interesting to note, though, that Shiba is still well off of some of the highs that it had seen in late 2021. So we'll see if it gets back to those levels. But as of right now, this no doubt a good move, not just for the price action, but additionally for having more of that that viability as a coin. And we'll see exactly how that creates even more demand for more coins to be added as well through Robinhood's platform. Also, another ticker symbol that I'm tracking here on the day is AAPL. It's a very common one for our viewers here. And this is as Tim Cook spoke today in Washington, D.C. with the International Association of Privacy Professionals and really reiterated the Apple App Store privacy pillar here, or pitch, that they've continued to go out to consumers with over the past several years, saying that Apple is deeply concerned about app stores that essentially would, quote unquote, circumvent the Apple App Store. And they're afraid that there would be a potential risk or exposure that users would see because of some of the hungry companies that are trying to get their data. And that is something that Apple has created an entire marketing engine out of, is the privacy play, and asking for regulation, but asking it to be regulation that, to no surprise, also benefits them at the end of the day. So it'll be interesting to see where Washington and some of the broader techlash and looking under the hood with regard to the antitrust and the monopolies that some of these companies seemingly hold over consumer data, where that continues to kind of break up the availability for Apple to just sell further into that install base, and also kind of be a detractor for some of those other smaller players that are looking to monetize those users via the App Store as well.
Yeah, as usual, I think the answer lies somewhere in the middle. Certainly, he's right about privacy concerns, and they have been leaders on that front, as you know, Brad. I mean, put their money where their mouth is late last year and really hurt the ad revenue over there at Facebook, making those changes, in particular to the iPhone. But I think those app developers have a great point. If they met somewhere in the middle, that 30% fee for people like Epic Games is going to continue to be a thorn, and it's going to continue to focus that lawsuit. So it sounds like the UK, they're going to get a deal. The U.S. is where they have all eyes, and they need some sort of middle ground to help out those app developers so they don't take that side door. My play is Starbucks, SBUX, Citi downgrading the stock to a neutral buy, citing several concerns. Analyst John Tower said broader inflation, management issues, China COVID lockdowns, and of course, the unionization push is the reason for that downgrade to neutral rating on Tuesday. Speaking of the unionization drive, in Boston, 2 Boston stores became the first 2 in Massachusetts to unionize, and they are batting near 1,000 right now, 18 of 19 when that has come up for a vote at last check. As for the stock, it is down just a bit, about 1% on the day. Year to date, it's been hammered down 31%. And guys, I want to get your take on some reporting from the New York Post that Howard Schultz at a California store that was attempting to unionize reportedly said to a store worker, if you hate Starbucks so much, why don't you go somewhere else? Now, context, this comes from a very pro-union news site, More Perfect Union. Schultz responded. He's the interim, now current CEO. He's back again. He offered a statement, but didn't really explain whether or not he said that. I think it's rather inconsequential whether he said it or not. If he did, it seems relatively on brand and innocuous. Not sure how you feel about it, Brad.
You know, it's interesting because Howard Schultz coming back to Starbucks at a time where this is a very different green siren than the one that he left and turned over to Kevin Johnson previously. And so as of right now, with all of the labor shortages and labor issues that they are confronting, both on the union side, but also in just being able to retain employees in the face of hourly employment that can be payment, they can see payment far better at other places. It all depends upon how they're working with that existing labor and workforce and those team members that they have done so much over the years to try and create this compelling and competitive positioning to be employed at Starbucks versus other places through some of the benefits as well. And so now, if you have an intermediary on one case that you have to continue to interface with on the union side, you know, how does that change up some of the benefits and other places that they're able to offer as well? But I think for Howard Schultz, it also comes with the recognition that at the end of the day, you have to know some of the headwinds that you're facing as a company. And of course, he does know that. But this just doesn't sound great on headline, of course, right now in that interfacing, in this interaction at least. But we'll continue to track shares of SBUX going into the end of the trading session. Everyone, we've got much more Yahoo Finance on the other side of this short break. All major averages in negative territory with just about 30 minutes left in trade. Welcome back to Yahoo Finance Live, everyone. On Monday, OPEC expressed to the European Union that current and future punitive sanctions directed toward Russia may result in one of the worst oil supply shocks ever. Tuesday, crude oil prices surged back above $100 after less than a week below the level. Joining us now is Tamar Essner, who is the Vectis Energy Partners principal. Tamar, great to speak with you as always. Perhaps more long-term, as OPEC is signaling here, what are some of the implications if current sanctions are never lifted, or at least in the near term, not lifted?
Hi, Brad. Great to see you again. I think we're looking at structurally higher prices for the long term as a result of this war. Even if the sanctions are lifted, and let's say there is a magical ceasefire tomorrow, I don't see Western energy companies as being all that keen to go back to Russia to do business, unless there is some sort of real regime change at the top and the country seriously reorients towards Western democracies, which I'm not a political analyst, but I don't really see that happening. So you're basically over time going to be taking a good chunk of Russian oil and natural gas off the market, and you really have the potential for Russia to be geologically extremely significant in terms of oil and gas reserves, but similar to a pariah state like Iran or Venezuela in terms of it being irrelevant to the market in terms of productive capacity.
Certainly. And as Putin has said today, he's called peace talks a dead end, and says that war will continue until its full completion. That's just coming out this afternoon. And so that kind of gives us a sense that you're not going to see sanctions lifted, and you're still going to see a sharp punitive sanction that could be continued to be unveiled by the EU. So where else could supply come from for the EU in that instance?
It's going to have to be an all of the above strategy, and certainly it will change over time. So we think by the end of the next decade, the U.S. could actually fully displace Russian natural gas exports to Europe. So obviously that will take time. In the interim, Europe will have to look to source from other places, and have to look to rely on other sources of energy, not just natural gas. So they have decommissioned a lot of nuclear plants, so that could be something that they'll have to revisit. Unfortunately, they are already revisiting coal because they just need the power. So in the short term, it will be messy to replace oil and natural gas from Russia, particularly natural gas, because Russia's oil is much more easy to transport. But in the meantime, I think that European countries are going to significantly ramp up their ability to import from other places, and they're going to have to look at other sources.
And so for the type of demand that it would create for the U.S. as a supplier in that instance, how would we have to ramp up production? To what percentage, perhaps, would we even have to ramp up to meet that new demand?
Yeah, so it's a great question because it's a function of ramping up production, which we can do. The Marcellus field and the Permian fields, Permian obviously in West Texas and New Mexico are known for being big oil producers, but it also has a huge amount of natural gas associated with it. So it's not just the productive capacity in the U.S. that needs to be ramped up, but perhaps even more significantly is the infrastructure associated with that production to pipe the gas from the fields to terminals where where the gas can be processed and liquefied and exported. Up until now, we've seen that the permitting process for getting those projects up and running takes very long. Sometimes multiple years. Sometimes projects are operational or about to be operational, and then they can be nixed by the administration for political reasons. So we're going to need to see a little bit more green lighting from the administration. And I think we have started to see that a little bit, but just to give companies more and investors more confidence to invest in those export terminals and particularly the pipeline capacity to get gas from fields to end users. I mean, there's no reason why consumers of natural gas in Massachusetts, so close to Pennsylvania, which is one of the most prolific natural gas fields in the world, they have to import natural gas from Trinidad and Qatar and even Russia at times in the past because there's no pipe to get the gas from literally just from Pennsylvania to Massachusetts. So that's a really big problem. I think even more so than the regulatory regime with regards to production.
Tamar, always a great pleasure to get your context and insights around this ever-changing environment. Tamar Essner, who is the Vectus Energy Partners principal, joining us today. Tamar, thanks again. Appreciate it. And guys, coming up, President Biden is in Iowa today as the White House has rolled out new measures to curb fuel price pressures consumers are feeling ahead of the summer travel season. We'll speak with a member of the President's Council of Economic Advisors on the other side of this short break. Welcome back to Yahoo Finance Live, everyone. The president announcing today that the EPA administrator plans to allow E15 gasolines to be sold this summer. The gasoline type uses a 15% ethanol blend and is the latest affordable fuel supply effort from the White House. And that, as the latest consumer price index data reveals, continued pressure at the pump leading up to the summer travel season. For more, right now we have joining us Jared Bernstein, who is the White House Council of Economic Advisors member. Great to have you here with us today, Council member. What net effect does the White House calculus believe that this effort will have on the fuel cost pressures that are showing through the economic data?
Well, our estimate is that this waiver allowing stations that happen to be particularly located in the Midwest could shave around 10 cents a gallon off the price of gas through increasing the supply through allowing the sale of E15 ethanol between June and mid-September. That has to be added to the impact of the release of oil from the strategic reserves. I think probably this audience is quite familiar with President Biden's release of 1 million barrels a day for 6 months, 180 million barrels in total from the strategic reserves. Probably less familiar is the fact that he has now worked with some of our partners and other economies we trade with to kick that 180 up to 240 million barrels. If you look at the impact of that already on oil and gas prices, you can see that in the data. So basically, we're doing everything we can to try to help relieve some of these price pressures at the pump.
Nice to see you. Jared Brad, of course, mentioned the CPI data out 8.5%. The rising inflation has been the signature issue in the economy, and that shows in the polls. The president at 42%, 33% on his handling of inflation. Jen Psaki, the White House press secretary, asked about that ahead of the data release. Here's what she said.
We expect March CPI headline inflation to be extraordinarily elevated due to Putin's price hike. And we expect a large difference between core and headline inflation, reflecting the global disruptions in energy and food markets. So core inflation doesn't include energy and food prices. Headline inflation does. And of course, we know that core inflation, energy, the impact of energy, of course, on oil prices, gas prices, we expect that to continue to reflect what we've seen the increases be over the course of this invasion.
Inflation, of course, has been soaring since President Biden took office, and COVID certainly played a role. Supply chain issues played a role, and certainly the trillions of dollars in stimulus that the Democratic Congress put out in the economy. Is it oversimplifying things to call it the Putin price hike?
I don't think so in the following sense. If you look at inflation in the report we got this morning, that's the CPI for March. Over the month, inflation was up 1.2%. 70% of that increase, a full 70% of the increase in that monthly inflation rate is attributable to energy prices, and 63% is attributable to gasoline itself, which was up historically very steeply over the month. That is very directly connected to Putin's unprovoked invasion of Ukraine. I don't think that's a particularly debatable point. Now, if you want to argue that the broader inflation that's been going on in this economy since we've seen very strong demand interact with insufficient supply, and I agree with you, that has a lot to do with the pandemic, and those impacts are still ongoing. Sure, that predated the invasion. But Jen is, I think, spot on when she's reflecting on what we see in today's report regarding energy and gasoline in particular. And again, my earlier comments reflected on some of the actions that we're taking here to try to lower prices at the pump, which, by the way, are down about 11 or 12 cents per gallon in April. This, of course, was a March report.
So with that in mind, then, obviously, you do have this inflation number, but when people are paying for their gas, even though we are seeing the prices come down, but they're also seeing food prices elevated, it can be hard to feel like you're doing well economically. How does the administration plan to really change this, perhaps this narrative, especially going into a midterm election year?
Well, when people ask me how to change a narrative, I very lamely have to just say, I'm an economist and I think about data. And I guess that a smart narrative is one that's informed by data. And so let me tell you something that I think is getting a little bit lost in this discussion. As you well know, you talk about this a lot at Yahoo Finance, we have one of the tightest labor markets ever. We have historic job creation numbers, almost 8 million jobs since this president got here. We have labor demand that's as strong as I've seen it, and I've been looking at this for decades. We have an unemployment rate at 3.6%. If you actually look at the labor market opportunities people face, and you look at that in the constant context of commodity prices, you'll find that what really hurts households and economies is not just high commodity prices, food and energy, but it's relative to their incomes, relative to their earnings. And here, the strong labor market is really a tailwind just because it's so much in our scope that we don't necessarily often appreciate it in this context. Again, look through history where high commodity prices have really damaged an economy. You'll see it's a time when the labor market hasn't been providing people with some of the incomes they need to help meet those prices. Now, none of that excuses us from trying to do much better on the economy supply side and relieving these household constraints. But let's not leave out that it's not just commodity prices, it's prices relative to earnings and income. And in that regard, households are doing better.
What hurts future household growth as well, though, is high debt in comparison to income. Should inflationary pressure persist beyond the Federal Reserve and even the White House targets, is there a point where the economic advisors would elevate the recommendation to the president to even cancel a percentage of student loan debt, perhaps, which the president campaigned on and has repeatedly pushed the timeline for reassumption of the responsibility for borrowers back?
Well, of course, what the president campaigned on is very much a legislative endeavor. And so we continue to work with legislators on these issues. We've actually done a great deal in terms of rule changes, in terms of extending the pause in student debt payments to help hundreds of thousands of borrowers get through this period. But here's, again, speaking from a macroeconomic perspective and getting back to the point I was making a second ago about the issue that it's not just high prices, it's prices relative to incomes. Here we actually, if you go in and look at the data, you will see that household debt burdens are at historically low levels and that household net worth is at historically high levels. This is what we mean when we say household balance sheets are in good shape. Now, look, I really don't want to come across at all as if I'm being even the slightest bit unsympathetic or dismissive to what households face. We are working as hard as we can to alleviate supply side pressures, whether it's at the pump, whether it's in the ports, whether it's getting goods from ship to shelf, to try to help families make ends meet. But it's really important to think about the backdrop here and how families would be doing if we didn't have healthy balance sheets, if we didn't have a 3.6% unemployment rate, if we didn't have millions of job openings helping to create strong labor demand and good worker bargaining power. All of those have to be considered in the mix. If you try to reduce this economy to one variable, the rate of inflation, you're missing a whole lot.
Well, we do thank you so much for joining us this afternoon. Jared Bernstein there, White House Council of Economic Advisors member. Thank you so much. All right, unlocking opportunities in the metaverse. Meta is testing virtual sales on its Horizon World platform, but creators could face up to 47.5% in fees. That's just ahead. Welcome back to Yahoo Finance Live, everyone. Facebook parent company Meta is on track for its longest streak of daily declines since May of 2019, as after shares fell for a sixth straight session today. Now, this is happening as Meta is just announcing it's testing several new tools in the metaverse and how people can purchase digital goods, services, and experiences. And this may come at a hefty cost to creators as well. For more on this, let's bring in Yahoo Finance's own Dan Howley. Dan, what can you tell us?
Yeah, basically what Meta is doing here, and Mark Zuckerberg announced this late on Monday afternoon, is they're going to begin testing. This is just testing the ability for creators in its Horizon Worlds software to begin selling some things along the lines of in-app products. So think, perhaps some kind of avatar shoe, or so you don't really have legs in Meta World, so I guess shirts, sunglasses, things along those lines, branded stylized things that you would have your avatar wear, or even events in the worlds that you may want to be able to visit. So, for instance, maybe a virtual concert. We saw that the Foo Fighters had a concert that was offered for free after the Super Bowl through Meta's Horizon World. And so maybe we could see some things along those lines. I think one of the other things that's interesting here is how we're already seeing other companies take advantage of this. For instance, Roblox allows developers and companies to offer things for sale through its own platform. And then that trickles down to both Roblox as well as the creators themselves. Decentraland, that's also a place where we're seeing certain sales, although that really seems to be more to do with the real estate than actual goods. So we could start to see potentially, this pick up with Meta. And this really just builds into the idea that trying to create this own virtual world that they want to have control of, but also build off the idea that creators will help create this world even more so than just Facebook could possibly, or Meta could possibly do on its own. So this, again, is just at the early phases, but expect this to really kind of pick up steam as Meta begins to build this out even more so.
All right, we're taking a look at the metaverse stocks here, all down on the day, and what's a largely down day on the markets. Our own Dan Howley, thanks so much for breaking all of that down on the Meta platforms front and the broader metaverse. We appreciate it. And everyone, we've got just minutes left in today's trading activity. Taking a look at the major averages, as I mentioned, it's a down day across the board. Major averages in negative territory. The Dow down 0.3%, S&P 500 down 0.4%, and then the Nasdaq Composite also down fractionally by about 0.3% right now. We've been continuing to track these major averages, which were higher across the board earlier in today's trading session. And so we'll see exactly where things net out as we get closer to the end of today's trade. Closing bell, and the countdown to that is up next. Welcome back to Yahoo Finance Live, everyone. Hey, we're just minutes away from the end of today's trading session. Let's sprint on over to Yahoo Finance's Jared Blickery with the key levels to watch going into the close as we're down across the board. Jared?
That's right. Just taking a look at the Wi-Fi Interactive here. S&P 500 off 0.4%, pretty close to session lows, but 0.4%, not that big of a loss here. However, we have been in a downtrend for the last 10 trading days. You can see down about 5% over that period, a little bit more substantial if you think about it. Now, let's take a look at the sector action for today. Energy in the forefront, that is XLE. Up over 1.5%. Crude oil, WTI closing over $100 a barrel for the first time in days. Also got those hot inflation numbers this morning. Talk about a little bit about that in a second. Kicking off big bank earnings tomorrow. Ahead of that, XLF, the financial sector ETF for the S&P 500, that is down 1%. Healthcare also down a similar percent. And then communication services and tech, those mega cap Latin heavy sectors, those are down too. But Apple finally climbing the green. That's up over 1%. Tesla up 1%. And just taking a look at the biggest winners and losers inside the Nasdaq 100, we can see more losers than winners, but it looks like DocuSign taking up the bottom position there, down 3%. NetEase also down a similar amount. Want to take a look at Chinese stocks because we got a few new names added to that list of companies that the SEC has trouble with their financials with overseas. Sohu is the latest, and we've seen a lot of these names pop up on that list. We can see a lot of these names under more pressure today. Also want to check in on our leaders, and this is our sentiment index here, our sentiment heat map, and we can see KWEB. That we were just talking about those Chinese ETFs, Chinese stocks, that is down over 1.75%. Also looking weak today, we got the FDN, that is the U.S. internet stocks, along with biotech, rounding out some of the bottom performers. Also KRX, that is the KBW regional bank index, that is down about 0.8% today.
And speaking of down performers, we're taking a look at Bitcoin under $40,000 today. What's happening there?
That's right. Well, we've seen a bit of volatility over the last few days in Bitcoin. I just want to show you what's happened over the last 10 days. You can see a definite downtrend right there. But if you look at the longer term basis, we got 20 seconds or 30 seconds to the closing bell here. You can see we've come down a substantial amount from these lows, but nevertheless, technically in an intermediate uptrend. And just tracking stocks as we head into the closing bell, we're going to get a quick check on our crypto stock heat map, and we can see again more red than green here today, guys.
And there's your closing bell for this Tuesday, April 12th. So much for Bitcoin being a hedge against inflation. Quick look at those numbers Jared just talked about. A lot of red on the board. Dow, S&P, Nasdaq all dropping. Again, it is the Nasdaq once again leading the fall, down just 0.3%, but muted losses for the indices on the day. And with that, another hour of Yahoo Finance Live. Dave Briggs, Rochelle Akufo, Brad Smith here, breaking down the markets, how they reacted to the CPI number. Let's bring in our panel. Melissa Brown, Contigo Managing Director of Applied Research, and Sean O'Hara, President of Pacer ETF Distributors. Nice to see you both. So, Melissa, let's start before we dive into the markets with the CPI number, 8.5% up, a highest since 1981. Is there any good news here? Has inflation finally peaked?
It's not clear that inflation has peaked. Maybe it could level out at this high level, but I don't see any particular evidence that it's peaked out. And so it's really been hard for me to find good news in this inflation number.
So, Sean, as we look at this then, obviously the markets were already bracing for a high inflation number, still came in slightly higher than they expected. But were you expecting this much of a sell-off following that announcement?
Thanks for having me first off. I think there's going to be some difficulty going forward. There's almost an inverse relationship between rising rates and rising inflations and PEs. And so for the last decade prior to the last year or so, we've had a free ride, loose money, low interest rates, no inflation. You could expect to pay higher multiples for stocks. I think going forward, we know the Fed's going to tighten. They're going to start reducing the balance sheet, and inflation looks like a challenge. And so what I would say to investors, it's time for you as an investor to lower your overall portfolio's PE ratio, price to earnings, before the market does it for That doesn't mean you need to get out of stocks. There are places to go in this market to make profits. We have two large funds that are ours that just peaked before we went on air. That our large cap U.S. fund was up for the day, but that's because we own low PE, high free cash flow names in that portfolio. And so I think that's the general view from our perspective, is that it's going to be difficult unless we can get inflation under control, because it looks like the Fed's going to continue along their path. And it's kind of a scary thing to me if we're sort of sitting here hoping that the Fed chickens out and stops raising rates. But it's not a surprise what happened today. I think there's more tough days ahead as inflation and interest rates continue to persist. And what will really be a challenge is if we don't get the 5 to 7% earnings growth that we expect after the robust earnings growth of the prior year. But things come in a little below that, then I think things will get even more difficult.
So a lot of the market activity today, for sure, pricing in what the Fed may or may not do, especially with the economic data reading that we did get on the CPI front. But then additionally, on the international conflict side, around midday, you actually had Russian President Vladimir Putin speaking at a joint press conference with the Belarusian president and saying that the invasion of Ukraine is going to proceed as planned ahead, and peace talks have reached a dead end. To what extent, Melissa, do you believe that the markets were actually paying close attention to that as well?
Well, I'm sure the markets were paying attention to that as well, although that inflation number is just so eye-popping that I think investors had a hard time knowing what to focus on, because I think those are two pieces of very bad news. But I think in terms of the markets, the inflation is the important number. If not, maybe not for tomorrow, but looking out, because it typically, historically, wartime has not necessarily brought markets down. Now, obviously, there are many horrible things about war, but it typically hasn't been so horrible for markets. But high inflation has been.
So let's get back now to those earnings you talked about, Sean. And tomorrow we start seeing the first of the big bank earnings come in. JP Morgan will be the first. How important are those? What are your expectations? And how important is the language that we hear from execs like Jamie Dimon?
Yeah, so, we're coming off of really easy comparables, and we had earnings growth of 30, 35, 40% in some cases, but that was because we were coming out of the pandemic. I think what will be most important to see is, number one, do we get that 5 to 7% earnings growth over last year's number that everybody expects? And then I think we should be listening particularly closely for guidance, as you mentioned, because guidance will tell us what they see that is going on day to day on the ground in the companies. And that guidance will tell us whether things are going to get better or stay the same or perhaps turn worse.
And Melissa, to that point then, as we look at the picture, as we see perhaps inflation persisting, we know that consumers are still willing to spend, but depending on how long that lasts, at what point do you think we might start to see that eating into earnings?
Again, as Sean just said, I think we'll have to listen very carefully to what the guidance is, because it may already have started to eat into earnings, and maybe not necessarily for the banks, but when the consumer companies start to report, and we're seeing some evidence actually underlying that, particularly in consumer companies have become much more volatile recently, as compared to where they ended last year, for example. And so I think there's already some concern about the consumer. And so, if it doesn't show up in earnings, that will be good news. But if it does, then I think we'll have to watch that very carefully.
Sean, from your perspective, what do you believe the best portfolio positioning is heading into an earnings season where you could see an impact to some of the forward guidance that companies are offering like this?
Yeah, I think on the consumer side, you buy staples versus discretionary. I think the consumer is going to get tapped out at some point. High inflation, high gas prices, high food prices, which are not going to get better. So overweight staples on the consumer side. I would overweight energy. That's just an obvious thing to me with what Putin said today, that war is not going to end anytime soon. It doesn't look like. So I think more potential global disruptions on the energy side. That's good for the energy companies in terms of their profits and their free cash flow. Overweight materials, which is, an inflationary hedge. We own U.S. Steel, for example, as one of our names. It's not a cocktail party name like, I own this great stock. U.S. Steel is a boring old company, but it's up like 22 or 23% year to date. It still trades at 3 times earnings. And then lastly, healthcare. Healthcare has grown its free cash flow lockstep with technology for the last 15 years. It's grown its earnings almost as much as technology, up 130% the last 6 years versus 162%. But its stock prices only went up 130%, whereas technology went up almost 400%. And so that's a safer equity portfolio given some of the turmoil. So again, lower your overall portfolio PE, find the places to be that make sense in this environment before the market does it for you, because if inflation continues, interest rates continue to rise, we're going to go back to normal PE ratios, which are not 20, 22, 24 times. They're going to be 18 times, 16 times. And so if you're an investor in the markets, find the place to go and get a portfolio that works for what's going on today. Don't go away from stocks entirely.
Melissa, Fed Governor Lael Brainerd stated the obvious today: getting inflation down is going to be our most important task. The question being, will they find that soft landing? How big a risk do you think a recession is next year?
I think, either, maybe the Fed didn't act soon enough, or the consumer, as consumers pull back, they're going to cause the recession, even excluding what the Fed does. So I think it's going to be really tough to find that soft landing. Just, maybe they should have tried to do it sooner, but it's tough. I think they've got a very fine line that they need to walk.
Indeed. And as you mentioned, that late start, they're certainly not helping. A big thank you to our market panel today: Melissa Brown, Contigo Managing Director of Applied Research, and Sean O'Hara, President of Pacer ETF Distributors. Thank you so much. All right, coming up on the show, Yelp becomes the latest company to respond to restrictive abortion laws in Texas and other states, offering workers travel benefits to access those services. Yelp's Chief Diversity Officer joins us next. Welcome back to Yahoo Finance, everyone. Yelp became the latest company to announce it's paying for employees and their spouses who need to travel out of state to get abortion care. For more on this, I'm joined by Miriam Warren, Yelp's Chief Diversity Officer. Thank you for joining me so much today. So why did Yelp decide to make this move? And talk about some of the conversations that led up to it.
Absolutely. In the wake of Texas's SB 8 law passing, we started to recognize that as a company with more than 4,000 employees distributed across all 50 states, that this would be an issue that we would need to start looking into. And the conversations inside of Yelp were pretty clear from the beginning, which is to say that our insurance providers have always allowed for reproductive health care to be covered. And in order for us to be able to extend that coverage to every employee, regardless of what state they live in, as well as their dependents, it would become clear that we needed to be able to provide this travel reimbursement as well, so that if someone needed to elect to move to another state or travel to another state in order to get the kind of care that they needed, we would want to be able to provide them that. And that's really what led to this decision.
And perhaps for other companies who are looking at this and wondering what the blueprint might look like, are there sort of any limitations or exceptions that come with this sort of coverage?
I think as different companies are considering this, it's very important to consider where employees are based. So for us, as a distributed workforce where most all of our employees are working remotely, it is really key to consider the geographic location of all of these employees. I think it's also important to really connect with the insurance providers that will be a key stakeholder in this process. Obviously, employers do not want to deal with the confidentiality issues or to have employees feel like they need to tell anyone else inside of the company. And so because this type of benefit is really processed through an insurance provider, it's very important to get into lockstep with them.
It's interesting because it's framed as sort of this natural broadening out of healthcare expenses. How are employees responding to this?
We've received a really positive response from both employees and also consumers. And I think what they're telling us is, hey, this is an issue that matters to us as employees. It matters to us that the company is also caring about it. And it matters to us that you're speaking out about it. So no longer are employees in a position where they think that just a paycheck is enough from their employers. They are really challenging the employee-employer social contract. And I think what a lot of that means is that they are asking for their employers to not only provide benefits that consider the entirety of their lives, but they're also asking for employers to speak out on social issues that impact their lives.
Now, obviously, when you do take a stand, especially on an issue like abortion, you're going to have backlash. In fact, we did see that after Citigroup said it would cover travel expenses for abortion access, that Texas legislator Briscoe Cain threatened to introduce legislation to bar local governments from doing business with companies that have such policies. Has Yelp received similar backlash or responses from some of the states who do not want this sort of access?
Up till now, we haven't. One of the things that I think is important to note here is that often the backlash gets much more press coverage. But what often doesn't get much coverage is the fact that so many consumers and employees and others that see these types of moves in the press really thank us for them. In fact, I've already seen a number of these thank yous come through various aliases at the company as well as on social media today, which really gives me a heartened feeling in the sense that this isn't an easy thing to stand up for a lot of companies. And for us, it really is an obvious choice on so many levels, not least of which is the issue of diversity, equity, inclusion, and belonging. And when you start to think about those issues, as companies that care about them, we absolutely had to take a stand in this instance and in many others.
And as you mentioned, this is the latest example of companies increasingly weighing in on some of these political issues. We had Disney, obviously, with the Don't Say Gay bill. So are we now in a time where companies cannot afford to sit on the sidelines or perhaps not take a stand?
I really don't think they can. And I think that really comes back to that change that you're seeing in the employee-employer social contract. And I think the reason for that is particularly for knowledge workers in the last 2.5 years, where their work has come home with them and has lived in their home with them and has been there all of these days that all of us have experienced. It really is a situation in which we can no longer have that separation between our work and our lives because our work is in our lives, literally in our homes. And so it becomes all the more important that people are aligned, and employees especially are aligned with the companies that they worked for in terms of their values. And I think consumers are increasingly telling us that as well, that they want to be able to vote with their dollars. They want to spend money with companies that align with their values. And I think that we're seeing that so much on the Yelp platform, in addition to seeing that, as corporate stewards and leaders inside the company as well.
We do appreciate getting your context and your insights there. Thank you so much. Miriam Warren there, Yelp's Chief Diversity Officer. Thank you so much. All right, up next, breaking down today's record high inflation data and what it means for the markets, the Fed, and your household. That's on the other side of this short break. Welcome back to Yahoo Finance Live, everyone. A painful punch in the gut is how our next guest described this headline inflation number that came out at 8.5%. So let's get right to it with Greg Darko, EY Parthenon's chief economist. So as we look at this headline number then, break down the main culprits and some of the sectors that are also cooling off as we look at what's within these numbers.
That's right. I think it's important to look at the different components of the latest inflation print. We have, on the one hand, international factors related to the war in Ukraine, to the renewed lockdowns in China that are putting additional upward pressure on the energy front and on the supply front, which we know are two key culprits of the higher inflation that we've seen in recent months. But there's also signs that there was stronger activity on the services side, with leisure and hospitality sectors and prices for these sectors rising faster. But we also saw some declines in used car prices, which we know was a key driver of inflation up until now. So there's really a rotation in the spending mix and in the price mix that is influencing inflation and will likely continue to influence inflation in the coming months.
Expectation from the FOMC is that inflation is still going to begin to come down during the second half of this year. When in the second half of this year would you forecast inflation starting to subside?
Well, I think we're not too far from a peak. I think it's always difficult to call a peak in inflation, especially in the given context that we have today on the international front. But I think we're not too far from a peak. I would expect inflation to gradually cool over the second half of the year. But I think from a Fed perspective, gone is the perspective that this passive moderation in inflation from cooler demand, from a rotation in the spending mix, and from stronger supply is going to ease inflation on its own. The Fed really wants to take control of the inflation narrative. It wants to tighten monetary policy, bring the Fed funds rate closer to a neutral stance, and normalize the size of its balance sheet in an effort to cool demand and to tighten financial conditions to be able to bring inflation back down under control. So there's going to be that passive element, but also, and very importantly, that active Fed element to try to regain control over inflation.
And you expect 250 basis point rate hikes the next two meetings. But on that note that you just mentioned, the balance sheet reduction, what are your expectations there, and how key is that going to be in the Fed getting down this number and somehow avoiding a recession?
Well, I think that's a very delicate balancing act from a Fed's perspective. The Fed is bringing out its full arsenal in terms of combating inflation, which it sees as a key threat to the longevity of this economic expansion. So it will want to tighten monetary policy fairly rapidly. Doing so will involve faster rate hikes, and we do expect to see back-to-back 50 basis point increases in the Fed funds rate over the next two FOMC meetings. But the balance sheet normalization process is going to be a key part of the Fed's normalization program. And the idea there is to try to tighten financial conditions, to try to essentially reduce economic momentum via that channel as well as the credit channel. And by pushing on both levers, trying to exert a certain form of policy brake to cool inflation on top of the passive cooling that I just mentioned.
And keeping an eye on what we're seeing with mortgage rates as a result, making it even harder for a lot of home buyers to get out of renting. But for renters who are hoping for some reprieve as wages still aren't keeping pace with inflation, break down your expectations for the rent and real estate markets.
Well, I think what we're seeing on the real estate front is a couple of developments that are going to be quite interesting. There's certainly going to be still some pass-through from higher housing prices into the CPI components for rents and owner equivalent rents. So we're going to see some upward pressure on that front. But as you stated correctly, the higher cost of credit with mortgage rates rising rapidly will put a damper on housing activity. And I would expect that as we look into the very latter part of 2022 and into 2023, we're going to see cooler housing activity, which will put likely downward pressure on prices going forward. So there's going to be a two-motion step here in terms of the real estate activity. Initially, still some upward momentum through the end of the year on the housing price front, but I would expect that as we look into 2023, the cooler activity from the latter part of 2022 will weigh on prices over the course of next year.
Greg, ahead of the summer travel season, where we know that there's going to be a ton of demand to get back on the roads, the president, of course, in the White House announcing today the EPA administrator planning to allow E15 gasoline. To the extent that you've been able to really parse through the details of this, what net effect do you believe that it will have in curbing some of the higher costs for fuel that Americans have been seeing right now at the pump?
Well, I think the rise in gasoline prices is certainly a key element driving up inflation. We know that gasoline prices are up about 50% relative to last year. Just in this past month alone, the 1.2% increase in the headline CPI index came, nearly 2/3 of that came from higher gasoline prices. So certainly an area of concern. I have my reservations as to whether the plan that was suggested by the administration will work to really significantly curb gasoline prices. But what will likely weigh down on gasoline prices is the fact that crude oil prices have come back down from their recent highs in March. That will take some time to filter through the gasoline prices, but I think we should not be expecting some further significant increases in gasoline prices, and that in itself will act as some form of relief for households across the U.S.
Some good news for the American consumer. Greg Dacco, EY Parthenon Chief Economist. Thank you, sir. Appreciate it. All right, coming up next on the show, one major U.S. mall company says they want to sell all of their properties, more than 30 million square feet by the end of next year. Is that the final nail in the coffin The American Mall will also tell you what is the new program Lulu Like New. Would you wear it again? The answer after the break.
Welcome back to Yahoo Finance Live, everyone. Lululemon is debuting a resale program called Like New later this month. Now, under this program, customers can trade in the Lululemon items they're no longer using in exchange for a gift card to be used in-store or online. Now, customers are able to purchase used items on the retailer's website as well. And this program comes as the company makes a commitment to sustainable purchasing. Brad and Dave, I'm sure you're big Lululemon fans. So first, Brad, I'll start with you. What are your thoughts on this move? Would you be comfortable buying used workout gear or used athleisure gear?
You know, I'm not really comfortable buying used workout gear, but maybe some of the other technical fabric-based athleisure gear that I can wear in office, the ABC pants that have become amazingly popular in the men's line particularly, and then some of the other pieces of apparel as well. But particularly, I think this speaks directly to the fact that Lululemon's apparel across categories had been looked at as so durable and for such an extended period of time that it was also almost barring them from seeing future sales in some other apparel categories. And so if you had people who were buying pants that lasted so long that they didn't need to buy another pair unless they went back in to just get another color, you know, that could potentially be a hit on future revenue. But I think this also speaks to the durability over not just the second owner, but even a third owner potentially, and the price points. Notable that they're launching this as well in correlation with Earth Day on April 22nd as well.
Got a lot of detailed economic analysis, so I hope you're both taking notes on this one. Ew, no, I would not ever wear workout gear from another human. I thought that maybe was just me, so I asked my wife and texted several females who all wear Lululemon, who all said, no way, no how, no chance. No way am I ever doing that. But I think the bigger question for me is if you have something that's in good enough shape to resell that You have it sweat a lot in. Are you going to sell it for the prices they're offering right now? $5 for tanks, tees, shorts, short sleeve and long sleeve shirts, $10 for hoodies and sweatshirts that cost you probably 120, 130, and then the highest number is $25 for jackets or coats. Are you going to sell those back to Lululemon, or are you going to find another outlet, an online retailer that already does that already sells secondary clothing? And my presumption is you're going to want a little bit more than that. On the other note, I do wear a lot of Lululemon stuff, and I will tell you the stuff lasts forever, so I can't imagine a huge market for this. I've had this thing for like 10 years, guys, and it still looks new. So the stuff is high quality. I'm just doubting the success overall of this program.
And I mean, you both raise good points, because I mean, you have that sustainability. Perhaps Lululemon, being a victim of its own success, perhaps didn't have a lot of choices other than sort of going into this sustainable market. I'm not a person who wants to buy anybody's used workout gear either. Some things you just need to, like a mattress, sometimes you just need to just get it fresh. But things like jackets, maybe I could do that. And it does depend on just how much they give you on these gift cards. If you're going on instead to like another reseller, like Poshmark, you're seeing some of those things for sale for at least $40 for certain leggings and things. So I'm sure a lot of buyers will be weighing their options. But yeah, for me, it's a hard pass on some of the more intimate workout gear. I'll just buy it fresh.
I think we all three went the hard pass there, with the exception of the coats and the jackets. Lululemon in a lot of malls across this country, and some major mall news coming in this week. The owner of Westfield Malls, who has 24 shopping centers across the country and more than 37 million square feet, says they plan to sell all of their malls by the end of next year and get out of the U.S. entirely. Is that the final nail in the coffin of the American mall? Let's talk about it with our guest, Natalie Cutler, BDO National Managing Partner. Natalie, thanks for being here. Is that officially the death of the mall?
So, thanks for having me. We've seen the discussion, is retail dead? Is the mall dead, for years now? So this is certainly nothing new. This whole conversation about the mall and are we moving away from the mall? So I am here to tell you that the mall is not dead. Retailers or consumers are still going into the malls, and they will continue to go into the stores. It'll depend, obviously, on the location, geographically, but I do believe that we've seen a significant increase in movement into the brick and mortar over the last maybe 6 months, 9 to 6 months. Obviously, as the pandemic somewhat subsided, consumers were more comfortable going to the stores. And in fact, we've seen a significant uptick in foot traffic over the last, again, 9 to 12 months in the malls, as consumers became more comfortable with going out into the physical locations. So I do think that there is a need for malls. Are there going to be fewer malls? Perhaps, but there is certainly a need for malls, and the mall is not dead.
Now, it's interesting because, as you mentioned then, with this increase in foot traffic, with the restrictions coming down and people returning to the mall, I wonder about the timing, because the company says it wants to shed most of its U.S. properties by 2023. That's a pretty aggressive timeline. Why do you think it's such a fast turnaround, considering that people are starting to come back to the malls?
So I can't speak for them specifically, but based on what we have seen and based on the research that we have done, there's going to be, as the economy unfolds, and as we see the effect of inflation, the effect of the higher wages for the employees, continuation of supply chain, there's going to be a lot of stress that's being put on the retailers today. And retailers are primarily the brick and mortar are in malls. So there's that. And as the economy unfolds, as the effects of inflation take place, there's going to be several factors, right? So there's going to be a buildup of these issues on the retailers, and it'll depend how they react to it. retailers today that have had a significant increase in revenue over the last year. 2021 was a great year for retail, for many retailers, as we know. And obviously that came on the heels of whether it was the stimulus package, whether it was pent-up demand, whether it was back to school, which we haven't had in-person school for quite a while. So we did see this big increase in foot traffic, consumers going out into the malls. In fact, we even saw a decrease in bankruptcies, as Retail in the Red report states. So the question is going to be, well, what will happen going forward?
Exactly. And let's talk about that, because I mentioned the numbers, 24 shopping centers, more than 37 million square feet. So what becomes of those? Is that a massive commercial real estate graveyard across the country, or is some company going to come in and fill that void and actually build new malls?
So we've seen this already happening, perhaps not to this extent, but we have seen some malls became, whether they be hospitals, housing, nursing homes, warehouses. Obviously, there is a need as e-commerce increases. There is a need for additional warehouses because we all want our stuff right away. So this is nothing new. Perhaps this is a little bit more of a drastic, quicker change to shut down the stores, but this is nothing new from a mall perspective.
And just very quickly, we have about 30 seconds. What sort of reimagining of these spaces could we see in the future then to really reflect how we're changing, how our lifestyles are changing, so that people can still use these spaces and some of these commercial realtors can still get their rents?
So I do think that they're going to, as I mentioned before, they're going to turn into whether warehousing, which doesn't really affect the consumer unless it's going to be closer to their home, they'll get their products faster, whether they become gyms, whether they become urgent care centers in all of these various areas. So there's definitely a thoughtful conversion of these malls.
All right, well, so the mall not dead yet. According to Natalie Cutler, they're BDO's National Managing Partner in Industry Groups and Retail and Consumer Products National Industry Leader. Thank you so much.
And before we go to break, everyone, take a look at Coinbase shares here in after hours. The stock closing at a record low after an analyst at Mizuho cut its price target for the second time in a week. The analyst citing increased competition, notably from Crypto.com. So far this year, Coinbase shares are down roughly 41%. We're going to continue to keep a close eye on shares of COIN going forward throughout the rest of this week, and even more so from there. More Yahoo Finance Live right after this. Welcome back to Yahoo Finance Live, everyone. Tesla is reopening reservations for its Roadster, the same car model that Tesla CEO Elon Musk allowed to be sent into space. And the price for the deposit alone can exceed the full cost of the mass market Model 3, depending upon what types of upgrades you're getting. Joining us now with more is Yahoo Finance's automotive and mobility reporter, Praz Subramaniam. Praz, help us break this down. Eye-popping deposit figure alone.
Yeah, Brad, this sort of got new light here after the Giga Texas Rodeo, where Elon confirmed that new Roadster, I say new, it actually was debuted in 2017. It's actually going to come out in 2023. People noticing on the site that now you can actually go back and reserve this car that at the time when it came out cost $200,000 plus $50,000 deposit. And then there's also a $250,000 Founders Edition that's no longer available. So now you can actually come back here, put down that $50K for that car, and then put down $5,000, which is a refundable credit card deposit, and then on top of that, within 10 days, wire $45,000 over for a total $50,000. Want to note that we don't really actually know what the actual MSRP for this car is. It's not set on the site. You just got to put that deposit down, and when your time comes up, order that car. Now, this car, like I said, debuted 5 years ago, right? And it had some pretty cool features. It had air thrusters that allowed to kind of a turbo boost. It could go to 0 to 60 in less than 2 seconds. So it had a number of really cool things. But at this point in time, it has to be the case that if you're going to actually put money down for this, you kind of have to buy into Elon's vision of the company. And maybe 5 years ago, you thought about that company is sort of on thin ice here and there, but now they've exploded in value. Is this car actually going to come out? The Cybertruck was announced in 2019. That hasn't come out yet. So it's more of do you have faith in this company that they're actually going to do this by 2023? It remains to be seen. But if you're betting now on Tesla versus 5 years ago, I think you have a better case for this car actually coming out.
Yeah, I'm not even booking on the hotels tonight deal of the day without seeing where I'm staying, let alone putting down the deposit and not knowing the full MSRP. So when we think about this more broadly, can the Tesla Roadster retain the title that it had amassed previously of most luxurious sports car electric vehicle on the market now that other competitors have begun unveiling and producing their high-cost, high-value EV plays?
Brad, on paper, it's a pretty compelling looking product for that potential 200,000 plus price and what you get for it. But, you have cars like we saw the Polestar Precept concept. That's an electric roadster. That looks really compelling, looks really cool. And also has remember the deployable drone that flies out of it. So I'm thinking that's going to cost around that, if not a little bit less. And on the highest end, Brad, you have the Pininfarina Battistutta, which is $1 million plus EV. You have the Lotus Evija, which is also $1 million plus EV. So you have some really high-end EVs out there that are going to compete with that Roadster when it actually comes out. So it's a pretty exciting space to be in. And right now, you don't really have that many sports cars that are EVs. That's really, I think, an exciting space that might actually generate more enthusiasm for EVs in the future.
Praz, I want to ask you quickly about the decent news inside the inflation. CPI numbers up dramatically, but cars and trucks down 3.8% in the most recent month. Are we getting close to return to normalization, or is this just a one-off?
Brad, I've been watching this figure a lot, the CPI figure on used cars and new cars. And as you mentioned, right, used cars actually dipped this month. They dipped the prior month too, slightly. But year over year, used cars are up 35.3%. New cars up around 12.5%. So year over year, it's sort of not a good trend, but in the last few months, it has been sort of declining. We also just saw CarMax put out earnings today. They missed Wall Street estimates. Are we seeing that the values of cars are starting to kind of dip down as Americans sort of balk at wanting to buy these really high-priced used cars? Are we seeing a return of supply in that used car market? It's potentially true as people unload what they think are really good investments, saying, hey, this is a good time for me to sell my used car. Do it now. Are we going to see that? Are we finally seeing that surplus of cars come to the market? I think it's still a little too early to say, but the last couple of months have been promising, especially in this March CPI report, where we saw prices, jump 8%? It's crazy.
Yeah, absolutely. We're going to continue to watch this automotive space very closely. Big week as well, especially here in New York, where we know the auto show is taking place. Praz Subramaniam going to be there. Praz, we appreciate the time here this afternoon. Yahoo Finance's own automotive and mobility reporter. Appreciate it. And everyone, switching gears here, the stock of the day, or at least the stock that we're going to be watching going into tomorrow, stocks to watch, is DAL. They're going to be reporting earnings and really kicking off the earnings season alongside some of the other bank names, of course. But taking a look at DAL and how they ended on the day, ended higher by about 1%. And we're going to be watching closely for this earnings report, especially at a time where we do know that airfare, according to an Adobe report, had actually surged by about 20%, airfare surging by 20. And that's in comparison to some 2019 and early 2020 levels as well. And so with all of this in mind, the big question, of course, for the airlines more broadly over the course of this earnings period is where they're seeing either upgrades or re-entry from business travelers who were looked at as the most heavily or profitable type of traveler, have a propensity to spend. If you need to go, you go. And so at the end of the day, for some of those upgrades that you typically see that comes in from the business traveler, and I think for airfare, it also comes back to where they're seeing the opportunity to pass along some of the cost pressures that airlines are seeing through to some consumers, as they are also seeing their own fuel cost pressures for the airlines as well. And so this is one company I'm going to be watching going into tomorrow for sure when they do report earnings. But DAL on the day, year to date, down by about 20%. We'll continue to see how investors react tomorrow once the company reports their official earnings. The estimate is calling for an EPS of a loss of about $1.22. We'll see where the exact figure comes in at as well.
And speaking of Delta, the question for a lot of American consumers is, will they continue to pay these rising ticket prices? The numbers are astounding. Ticket prices on airlines up 40% since January, and some expect them to rise another 76% by the summer. Right now, the average ticket domestically costs $330. And why is it going to get worse? Well, some of these airlines are going to have to cut their flights. In particular, JetBlue has already announced somewhere around the ballpark of 10% cut. So it is getting to the point, like a lot of elements of our economy, that people are starting to ask themselves, can I save some money? Can I cut out some vacations this summer? Am I willing to? The number still indicates that people are not. But I got to tell you, anecdotally, Rochelle, I was online trying to plan a summer vacation with my family, and not only were the frequent flyer miles impossible to use, but it seems like the routes had been reduced, and it was more difficult than I've ever had to just plan a very simple family vacation, in part because of cost, in part because of availability, and the impossible task of using airline frequent flyer miles today.
It's like you feel like you're in that GIF where the guy's like pointing at all the charts as you're trying to like map out how exactly you're supposed to navigate all this between high prices for hotels, for the airfare, and I have like a million apps open trying to now track everything just because it is so hard to keep track of all these high prices. I mean, so hopefully, we were trying to get some summer travel on the way. Some things I'd booked last year when a lot of these travel apps were like, just put a small deposit down and you can fly within the next year or so. I think that's going to end up paying off, as a lot of people are just unable to find what they need for travel.
Was that Rochelle with a Charlie Day smoking the cigarette, standing in front of the entirety of the mapping that he was putting together? Okay, so I 100%, number one, love the reference. But number two, I think it really does spell out a lot of the headache that consumers are facing going into this summer travel season, especially in Dave's case, if you are trying to plan for a family trip and you're looking across some of these prices and trying to get ahead of it, but also realizing that the airlines for themselves and how they're operating, some of the pressures that they're facing, higher fuel prices. Also, you've got the labor front where they're trying to ensure that they're retaining enough people to make routes possible. And so with that, we've seen some of the reduction in specific routes that they are running. And for the airlines, we're going to increasingly hear across the board, whether it's from Southwest, whether it's from Delta, as I was mentioning a moment ago, American Airlines, and the list goes on, especially with United as well, how they're seeing that business traveler also come back so that those profits can also be reassumed to be reinvested back into that passenger experience, especially for so many of the leisure travelers that have just been looking for the opportunity to travel and travel safely right now, too.
Certainly make your plan, and good luck to everyone trying to make travel plans this summer. We want to shift gears now and take you to some breaking news coming out from Walmart, the company naming a new chief financial officer, John Rainey, who will assume those responsibilities on June 6th. He comes to Walmart from PayPal, where he currently serves as CFO. Rainey said, "I'm excited and humbled to join such an iconic company at a time when the retail industry continues its transformation." As we see in after hours, the stock in positive territory after ending in the red during the regular trading session. Now, this is coming as Walmart looks for new streams of revenue, as well as working on its fintech startup that it launched last year. Do stay with us on Yahoo Finance. We'll be right back. Welcome back to Yahoo Finance Live, everyone. We're never going back to the 4-day work week. That tweet from Bolt's executive chairman after piloting a 3-month test to see how effective and productive it is for the unicorn startup. Now, he said he saw heightened productivity, engagement, and wellness, and he rejected what he calls theater work that looks good but doesn't actually move the needle or make an impact. You know, and sometimes you'll see someone sort of walking around busily with a coffee cup and scheduling a ton of meetings, but are they actually being productive? Does he have a point? Dave, what do you think?
I am much more productive away from this house and in an office. I might stand alone on that. I'm okay with businesses making that decision. Where I draw the line is what they're doing in California, proposing legislation in the state assembly that would mandate 32-hour weeks for businesses of 500 or more employees. That's 1 out of 5 California businesses, and the Chamber of Commerce calls it a job killer. They also would require, if this law were to pass, you to pay time and a half, anything over 32 hours, pay double time, anything over a 12-hour day, over a 7-day week. I have to agree with the Chamber of Commerce in California. That, to me, Brad, is a job killer.
You know, when you started off your answer, I mean, I totally agree, because the fact that we've already seen businesses need to stand in the gap for so many things that the federal legislation has dragged their feet on, whether that be on trying to make sure that even Election Day is a federal holiday, or making Juneteenth a holiday, or even making sure that your workers have certain rights internally. A lot of businesses have needed to step up to that task prior to the public sector actually doing so. And so how is a 4-day work week any different in this instance? And so as we move forward from here, you're going to hear all the different test cases and studies of how businesses have taken this onus upon themselves to see how it's better for productivity, where they're seeing better work-life balance and camaraderie among their workforce and their team base, and also how they're able to still retain their revenue that they've come to expect over time. And all of that is going to be the basis for whether or not they decide to move forward. Of course, it's going to be harder in certain industries and roles and talent sectors than others, but it's all about seeing exactly where we can start to draw the framework. And coming back to that Charlie Day reference, that's the CEO's job or the C-suite's job to be that Charlie Day and figure out, okay, how can we make sure we're adequately mapping to see how everything can still get done, how we can still retain our profitability and be a successful business while also having success within the ethos and the corporate culture within our company as well.
Yeah, I think it's just to each his own when it comes down to the businesses. Mandating it is a very slippery slope. It works for Kickstarter. They've mandated it. All right, that'll do it for us. For Rochelle Akufo and Brad Smith, I'm Dave Briggs. Have a wonderful rest of your afternoon. Yahoo Finance back on tomorrow, 9 a.m. live. We're right back here at 3 p.m. to 5 o'clock Eastern time tomorrow. Have a great Tuesday. We'll see you on Hump Day.